All right, 9 o'clock on this Friday, April 16th. Welcome to Yahoo Finance Live. I'm Miles Upton, joined as always by Brian Sazzi. Julie Hyman is on the final day of her week-long assignment. Can't wait to see her back live in studio on Monday morning. All right, let's take a look at futures here. We see all three majors pointing to gains at the open, coming off of a record close for the Dow, the S&P, and the Nasdaq 100. The Nasdaq comp still about a percentage point below its record close. See if we can get there during today's trading action. Again, about a 25 basis point gain in futures across the board here. Let's also take a look at shares of Coinbase. Second full day of trading for the crypto exchange coming up. Stock is up about 1% in the pre-market. Again, $250 on the reference price ahead of that direct listing. As we've mentioned, $343 was the average price the stock traded for in secondary market, private market transactions ahead of the direct listing. So Coinbase basically trading right where it was valued ahead of this direct listing. Again, giving the company a valuation somewhere in the ballpark of about $60 billion. Morgan Stanley wrapping up bank earnings earlier this morning with its latest quarterly report. Brian Chung's going to join us to break down the numbers for that firm, as well as takeaways from the banking sector's results at large. And we're going to be joined by the CEO of Bed Bath & Beyond later on in this half hour to talk about that company's latest quarter and the continued turnaround under Mark Tritton's leadership over there at Bed & Bath. But let's begin this morning with the latest on the financial sector. Morgan Stanley out with its quarterly results. Yahoo Finance's Brian Chung joins us with those numbers, as well as what we heard, Brian, from BNY Mellon.
Well, guys, we made it through the end of banking earnings season. Well, of course, that means that all the other companies are about to report. But at least for me, I'm about to wrap up. But Morgan Stanley reporting their earnings this morning. Their investment banking revenues up, get this, 128%. That was to $2.6 billion for the quarter. That explains why they were able to beat on the top and bottom lines. $15.7 billion in top line revenue on the bottom line. Earnings adjusted per share of $2.22. Now, keep in mind, Morgan Stanley had a pretty noisy quarter when you consider that this is the first quarter that they had announced that covers the Eaton Vance acquisition that it had finished on March 1st. This is also the only the second quarter of earnings reflecting that E-Trade acquisition. So Morgan Stanley obviously having a very big hand now in the retail trading and brokerage platform space. But one thing I want to point out that's very unique about their earnings report was this little footnote that said they had a loss of $644 million, quote, related to a credit event for a single prime brokerage client. There was also another $267 million of subsequent trading losses related to the same event. And guys, you can kind of read between the lines. Who might that be? It might be Archegos. But one other company that I want to highlight here in the earnings for this morning is BNY Mellon. Their revenue did decrease 5% year over year. So not a rosy story for all of the banks. And that's the reason why I want to point them out. They did have revenue on the top line, $3.86 billion. They had earnings adjusted about 97 cents per share. But keep in mind, this is a custody bank. So when we're talking about the banking industry, you're not going to look at loan pipelines for this bank or State Street for that matter. Money markets have had a really weird time. Negative returns have forced things like fee waivers, which have impacted BNY. It's worth noting, however, that their investment and their wealth management did appear to do pretty well. And Catherine Keating, the CEO of the wealth management business over at that bank, was telling Yahoo Finance's Andy Serwer earlier this week that the stimulus from the Fed and Congress was really helping the banking industry at large. But again, BNY and Morgan Stanley wrapping up the round of bank earnings that we've had this week, guys.
Brian, a long week for you. A lot of bank earnings calls to get through. What are some of your takeaways?
Yeah, well, I think the big takeaway from the banking industry, if you're looking at specifically the big four banks, Citi, JP, Wells Fargo, Bank of America, the story is those tepid pipelines. Loan books have not really grown that much when you look at JP Morgan Chase Consumer and Community Banking Division down 8% or 7%, Bank of America loans down 8%, Wells Fargo average loans down 8%. So we're seeing a lot of those loan pay downs. A lot of the stimulus has helped consumers and also businesses manage their debt, but whether or not that's going to kind of decrease the pressure valve for right now so that later on in the year, maybe in the second half, we can start to see more levering in terms of getting more loans out there as the economy reopens. That's really what these banks are hoping. When you hear a net interest income guidance from a lot of these banks kind of guide on the higher end towards this year, that is definitely part of the optimism, although you're not seeing it in those loan pipelines right now. And then one other thing that's worth mentioning, of course, everyone's got their eye on the reserves for loan losses. This is the buffer that the big banks had built up in the midst of the pandemic last year to sustain any sort of non-performing loans. That really ballooned to as high as $97 billion, at least at those four banks. We've seen some releases over the past 2 quarters. Those allowance for loan losses are now about $78 billion at the back of the napkin, Matt, for those four banks specifically. So it's definitely lower, but that level is still almost double where it was pre-pandemic, which shows that there's definitely still a little bit more wiggle room for the banks to release further reserves in coming quarters, something that I'm sure the bank analyst community is going to be very dialed into in coming quarters.
That the SLR thing, I couldn't keep that straight.
Well, the SLR thing is very interesting because basically it didn't necessarily impact the quarter of, because the exemption that the Federal Reserve had put into place expired at the end of March. And basically what this means is that the SLR ratios will probably go down for a lot of the banks. We've heard some commentary from CFOs at a lot of these large banks about what that impact might be, but all of them have said at large, this is not going to impact our ability to lend into the economy. And for those that are wondering, what the heck is the SLR? It's a supplementary leverage ratio. It's a banking regulation that determines the capital levels that a bank can have before they're ultimately punished by regulators. But JP Morgan Chase was the closest, I believe, to the regulatory minimum, about 5%. I think they were at about 5.5%. So I think they're all well above those regulatory minimums. Although Jamie Dimon, I think, had some colorful commentary saying this is going to hurt the economy, but not JP Morgan. But of course, who knows what that means.
All right, we'll spare the audience the full Yahoo U on SLRs there. All right, Yahoo Finance and Brian Chung with the latest on bank earnings season. All right, let's turn our attention back now to the COVID-19 pandemic and the rollout of the vaccine. Of course, earlier this week, we saw Johnson & Johnson's vaccine recommended that it would be paused in the rollout. Yahoo Finance's Anjali Kamani joins us now with the latest, Anjali, on this continuing and developing story. And as we wrap up this week, I guess trying to get a sense of where we stand with booster shots, additional trials, where Johnson & Johnson fits in here, and an evolving picture, I think, in the fight against the pandemic.
Absolutely, kind of like the evolving pandemic itself. So right now, what we know is that we've heard from both the CEOs of the mRNA vaccine companies, Pfizer's CEO, Albert Bourla, saying just yesterday that there is going to be a need for a booster shot. We also had Moderna CEO Stefan Mansell earlier this week say the same thing to us, and also explain why that would be. Listen to what he had to say.
You have a mixed bag, I would say, between people that are young and healthy and maybe 100% efficacy, and people that are older with one or several comorbidity factors. And then to your point is the variant. We do worry about the variants.
All of it put together between sort of waning efficacy, waning protection in certain individuals, as well as the threat of variants. We know that we're already seeing the beginnings of another wave right now in the country. All of this put together is giving all the companies a reason to push for a booster shot, and they're currently working on trials to make sure that that's going to happen. Meanwhile, in the background, of course, more pressure on these mRNA companies to produce, as Johnson & Johnson is on pause. That pause was elongated after a advisory panel to the CDC did not vote for any recommendations on what to do, waiting instead to collect more data on these reports of blood clots, very rare instances, but similar to what we saw in Europe, and could result in sort of an age or gender restriction on who gets to get those vaccines. We know that this is really important, not just locally, but also globally, as Johnson & Johnson remains the only single shot vaccine that can be stored at relatively normal temperatures, and is really important for rural communities, remote areas of the world, as well as just generally for easier use of vaccines. And so it's going to be really interesting to see how this all plays out. We know that the mRNA companies are definitely getting a lot of phone calls, their efficacy numbers as well, playing a role in why there's so much interest. So a lot going on. We know that vaccinations are continuing here in this country, and the Biden administration believes that even with the J&J pause, they will still meet that 200 million doses in 100 days. Back to you guys.
Yeah, Anjali, and it's interesting. We're kind of at this inflection point where we're starting to wrap up all the vaccine-motivated vaccine seekers getting their appointments and actually getting their vaccines, and into this phase that we all knew was coming. We're trying to reach harder to reach folks, people who are skeptical, and just with an easier process. And certainly this hiccup in Johnson & Johnson complicating that somewhat. All right, Yahoo Finance's Anjali Kamlani with the latest on the COVID-19 pandemic. All right, we are off for a short break here. On the other side, we're going to be talking to Bed Bath & Beyond CEO Mark Tritton about the company's latest quarter and the continuing turnaround at the home goods retailer. We're back with all of that coming up right after this.
Bed Bath & Beyond reported another quarter of progress in its turnaround this week. Same-store sales rose for the third straight quarter, and earnings handily beat analyst estimates. Yet, Bed Bath stock was hit on the company's outlook. On the week, shares are down about 18%, bringing the year-to-date gain in the stock to 38%. Bed Bath & Beyond President and CEO Mark Tritton is here with us now to talk more about the company's outlook. Mark, always good to see you here. There's a lot going on inside the company. I don't have to tell you that. Is one of the takeaways for investors is that the turnaround of the company, it won't be in a straight line.
Look, I think it will be in a straight line, but impatience is required. I mean, we just come out of a COVID moment. We've gone from 4 years of sales declines and performance to growth, and we're seeing consistent performance in our business, and we're exactly where we believe we should be and poised for a strong 2021. I think there's just impatience around us getting there faster. And I think that we look forward to coming out in Q1 and sharing our results and again, providing another consistent quarter of growth and performance against our estimates.
To that point, Mark, consumers have been out there spending very aggressively in the past few weeks. A lot of stimulus checks going through at retailers. Have you seen that in your business?
We've seen overall growth that's very, very strong. I mean, we saw the results yesterday for March come out at about 10% growth. We're dramatically exceeding that growth rate in the month of March. So we see good things lie ahead for the quarter. We're seeing general consumer confidence is strong. And that's strengthening both in digital formats as well as store formats in that true omni always shopping experience. So I think that the COVID moment is still omnipresent in customers' minds, but confidence factors have changed definitely.
And, Mark, it's Miles here, and I know we've discussed this previously. Certainly the stores, when I go into my local bed and baths, they're a lot cleaner. They're not as cluttered as they were, maybe three or 5 years ago. Are you guys having any supply issues, though, with things that you'd like to have in stock that you can't get because of issues? We hear that from a lot of industries, and I'm curious if it's impacting, any of your mix.
We're actually doing really well on our recovery of out of stocks. They're down to their lowest point in over 18 months. So we feel really good. We did curate the assortment miles down and actually create that focus in stores with new signage and new presentation and new flow. That's really paying dividends as we take each room and category and reset them sequentially in stores. So we're seeing some level of change in the inventory and the placement as we get settled in to bring in our new own brands. We'll see that really stabilize through Q1, but no major supply issues at this point. And in terms of our own brand launches, we brought in that product ahead of time in the right quantities to make sure that our setup was on point. A few areas where port delays are affecting a few items, but in general, we're looking good.
Mark, how much inventory have you pulled out of the stores? I know you've been actively just reassessing what a Bed Bath & Beyond store should look like. And when I walk in there, perhaps there's categories that no longer make any sense to have in the store.
Yeah, we're actually reducing inventory in stores by about 20 to 30%. Now, the flip side of that is the customers are coming in the store, particularly where we've remodeled, and saying, wow, you have more assortment than ever. And so I think it creates focus. It creates the ability for the great merchandise to breathe. We're able to resonate clarity on value and our unique offers and the differentiated offers that we'll show with own brands. So, definitely curating, definitely reassorting, definitely upgrading our assortment. All those things are taking hold as we speak.
And then, along with that assortment, Mark, certainly stay-at-home trades have influenced what people have been purchasing. I mean, when we've talked about your company on the show, I've heard from a lot of folks who are spending a lot more money on coffee in their house. And when I go into a Bed Bath, that's a very robust section of the store these days. How has the mix changed in the store? And do you see things starting to shift as life maybe normalizes and people aren't home, 7 days a week anymore?
We're actually seeing a solidification of those trends. And I think these are, I've been using we've seen a moment that's now become a muscle. I think that customers do enjoy having that cup of coffee at home and the value that it brings. They got the great coffee maker. And we're seeing that continue through. We're seeing customers really stay in love with their home for comfort, for safety, for style. And so we see the discretionary side of the business really continuing with strength as part of people's lives and their modus operandi, whether it's inside the house or now moving to the backyard. So we see a strengthening of that trend. Everything we see in trend reports and NPD shows us that part of the market will remain buoyant. We think we've got new offers and new assortment and new storytelling throughout the year that will only fortify that.
Mark, a lot of focus after the earnings calls on how many stores you're looking to prune. So far over your store closing campaign, you've closed about 140. Look to have 200 total closed as part of this campaign by the end of the year. Is this just the first round?
No, it's the major round. I think, Brian, we've done an assessment using data and an outside group to really assess not just what we needed to do to take out underperforming stores or where we had duplication in an existing market, but really looking at a 3 to 5 year horizon of growth and demographic growth, population growth, and seeing how we would also digitally fulfill orders for our customers across the nation. So this is a bold move to really restructure those approximately 200 stores based on that long-term criteria. But we'll always remain open to tweaking that where we see performance improve or slow. That's actually part of our criteria. But I think this is the major thrust, and it's not a series of major changes over time.
And Mark, finally, I want to ask about the stock, but about the end of January and beginning of February. You guys kind of got caught up in that sort of meme market. The stock went from, somewhere around 20 to in the 50s. Certainly leveled out kind of at a more, stable valuation, let's say. How did you guys think about that as a management company, if at all? I mean, again, it sort of came and went inside of a couple of weeks, but interesting to see those kinds of those spikes on a longer term.
Yeah. That was a roller coaster ride. I think for us, a couple of things. It's a great question, Miles. I think for us, we knew the reality of our financials, our stability. We're incredibly liquid. We had cash. We've already factored in our investments. We had our story out in the marketplace. the end result of that is I think it made people actually look at Bed Bath & Beyond again and go, hang on a minute, there is a strong story here, and this isn't like everybody else. That peak was very, very sharp, as you can see, and then it faded very, very quickly. And so our goal as a company was to understand what was going on, but stay focused on our deliverables. So we didn't let it distract us. We stayed focused on our prize, and you see that through our Q1 results and the reinforcement of our 2021 guidance, which is in line with our plans and in line with our 3-year plan. So moment in time, not a distraction, definitely an interesting time to live through.
Yeah, that was quite a few weeks, but we'll leave it there. Bed Bath & Beyond President and CEO Mark Tritton, always good to see you. Good luck this quarter.
Thanks, Brian and Miles.
All right, it's been another record-setting week for the markets. Interactive Brokers Chief Strategist Steve Sosnick joins us next to chat about what could be next for stocks.
All right, welcome back to Yahoo Finance Live on this Friday morning. Again, the Dow and the S&P coming off record closes and set for gains at the open. Let's stay on the markets and talk about everything that's been happening this week and some trends to watch going forward. Joining us now is Steve Sosnick. He is the Chief Strategist over at Interactive Brokers. Steve, always great to talk with you. Let's start with something that I know is near and dear to your heart, and that's the VIX. We have really started to see some of the steam come out of the vol index. We're now kind of solidly below 20. How are you seeing that trade, and how does it play into the overall setup for market?
Well, good morning, Miles. I think what we've seen is, I guess, to be expected somewhat. I mean, we've gotten back into one of these patterns where we just seemingly go up every day on relatively light volume. That is not something that bodes well for VIX. Traders who trade volatility like to see a little more volatility than that. And what's fascinating to me is the biggest reason for the decline in VIX is really a lack of hedging activity. to get a bit more, what we all like to call the skew, and that's basically if you plot all the implied volatilities versus the moneyness, out of the money, in the money. We've seen the biggest declines in out of the money puts, meaning that people just don't want to hedge. And right now, I guess if you haven't been hedging, that's probably, it hasn't hurt you for the most part because we've been up pretty steadily. What's very interesting also is we're not seeing any declines really in out of the money calls, despite the fact that volume in those calls has tended to ease off quite a bit. I think that the memory that writers and market makers have is still there, and realize that, hey, we weren't charging enough for some of these calls. Let's keep our offers relatively high. And what volume is there seems to be still buying them. So it's calmed down. I think it's to be expected, although we're starting to get into an era of complacency potentially, but I don't see it there yet.
Steve, we have gotten some pretty big earnings beats this week from the banks to kick off earnings season, but the stocks haven't done much. If anything, they've in some cases they have sold off. How big a red flag is that for you from a trading perspective?
Well, Brian, in this case, actually zero. I was a market maker in bank stock options for the better part of my career. And there was one more or less truism, and that was that banks rarely blew up higher after earnings. It took a quarter like you saw from Goldman Sachs, where they hit literally on all cylinders to get that stock moving. Otherwise, the problem with the banks is that the analyst crowd tends to be a bit fussy. I'll blame it on them. As a trader, it always bothered me that trading results more or less get pushed aside. Oh, you guys made however much money trading this month. Yeah, try doing that again next quarter. So that doesn't really count. You tend to see that over time. Plus, in a quarter like this where you had big expectations built in, I think you would have had to been fairly crazy not to think that there would be some good results. I think that's partially why you also didn't see much of a reaction. To me, the most interesting reaction was Wells Fargo, which had its that one actually finally rallied for the first time in ages on earnings. So I'm not reading too much into it. The banks always go first, but the banks I found can be a pretty weird bellwether, and I don't like to read too much into earnings season based on what we see, in the first 3 days of bank earnings.
I will leave the conversation for whether trading or asset management is "quote unquote" real banking for another time, Steve. But let's talk a little bit about crypto. Of course, flavor of the year, flavor of our lives. It seems Coinbase comes public this week, and I'm just curious how you're thinking about what that does to the crypto market in the context of some of these assets getting a larger slice of the pie in traditional institutional type allocations.
Well, I think Coinbase listing its stock doesn't really change any of that. I think if you were inclined to trade crypto, you would have done so already. I think, I got an email yesterday from PayPal saying, hey, you could buy crypto in your PayPal account. So there's ways to do it. I just think Coinbase is doing a great job right now of monetizing that. One thing that does kind of raise an interesting little question is, by revealing how much they actually make per transaction, does that invite competition? Is that a case sometimes of being careful what you wish for? But I think, my thing about Coinbase is, it sort of fully legitimizes, I guess going public, sort of fully legitimizes crypto as a legitimate asset, and when you think about it, it was really had a very sketchy beginning. Sort of something only done by weird computer geeks and then adopted by people trading illicit stuff on the dark web and using that as your means of payment. And now we've really come full circle in terms of adoption. I found the biggest irony was that it went public and became fully legitimate on the day that the most legitimate guy turned sociopathic criminal died. So I think that was an interesting coincidence. But I think crypto, it's here to stay. Is it here to stay at $60,000 a coin? Well, that's a different story. But I think it's here.
Steve, is it inevitable that trading fees goes to zero and Coinbase gets hit?
I'll refrain from calling it in terms of the stock price, but let me just say, yes, I think the valuation of Coinbase, putting it on a par with some of the biggest exchanges, CME and things of that nature, ICE, in terms of market cap, is because of two factors. One is because people are projecting all kinds of crazy stuff onto crypto. I don't necessarily see that, but they really do. Their exchange fees are enormous compared to the other exchanges. Their volume, of course, is a minor fraction of that. What happens in these situations a lot of times is if there's a business that's spectacularly profitable that can be replicated. Once you've gone public, you've given your competitors a roadmap for how to replicate your results. To the extent that there are competitors who can beat Coinbase at their own game, I'm not enough of an expert in that part of the mechanics of crypto market to say that, but that would to me be the biggest risk, is actually that they become a victim of their own success by going public and releasing results.
And, Steve, finally, let's talk a little bit about the rates trade now and the state of that trade. When we've talked over the last few months, it has been about the speed with which we are seeing a steepening on the long end of the curve. This week, interestingly, we've started to see a bit of a rally there. How are you thinking about the status of that trade, which, again, really defined major market moves? Let's leave the meme stocks out of it, but really defined the market flavor as we got through the first quarter.
Yeah, well, I think that the rise in rates was somewhat inevitable. When you see what's happening in commodity prices, when you see the rebound in the economy, sure, it makes complete sense that longer term interest rates, which are essentially reflect inflationary expectations, you'd expect them to move up higher. The fact that we did it so fast also means that you're more likely to get sort of a snapback of the sense we got yesterday. I think the trade got very stretched, particularly going into quarter end. I think you had asset allocations. I think you had factor trades going in. I think there was some freak out about SLR, which I won't define the term because I think you did it with Brian a few minutes ago. And I think that all combined, and I think this week, you hit a resistance area. The market's more or less traded in the 175 range for months prior to the COVID crash. And I think we ran into some natural resistance. I think the Huarong story out of China, which didn't get a lot of thought in the U.S., I think that did put a lot of demand into the market. Yesterday was sort of that snap because it moved completely counter to what you'd expect. And now this morning, at least when I last looked at it, we were giving back some of those gains. I think that's a normal course of events when you've had a market, any market, bonds, stocks, commodities, move that far, that fast. Catching that many people offside. And yesterday was the sort of day where you resolve the people who were caught offsides to a certain extent.
Steve, I think I could ask Brian Chung to explain the SLR to me every day, and I still would not be exactly sure what he's talking about. But I'll try, and maybe we'll get there someday. All right, Steve Sosnick is chief strategist. Yeah, that's right. That's right. I mean, who really knows, right? Who could really say? Yeah. Steve Sosnick is the chief strategist at Interactive Brokers. Steve, thanks for jumping on. We'll talk soon.
Take care, Miles.
All right, let's go to Jared Blicker now for a look at how markets are opening. Dow and S&P at records. Jared, what's the take telling us?
That's right. And we have the Nasdaq slightly red right now. And let's go to the Wi-Fi Interactive, where we see a lot of green across the global indices here. Russell 2000 up 1/3%, S&P 500 a little bit less than the Dow is the outperformer of the day, as we have materials and financials leading. You can see it's up about 176 points right now. Well, Steve Sosnick was just talking about the bond market, so I'm just going to touch on this briefly. We got the 10-year T-note yield up 6 basis points. That's a big jump, and that's after yesterday's huge drop, which was about double that. So the bond market maybe not signaling or off signaling. It was sending some mixed messages yesterday. Let's put it that way. We got the best housing starts number, the second best in about 4 or 5 years. And that had an effect on the yield curve, which is more in line with what you would think that would do, which is to expand it, which is to see longer term rates rising. All right, so the Nasdaq 100 here, the components under a bit of pressure on the left side, those are the mega caps. You can see Apple, and Microsoft each off about 0.5% almost, and then Tesla down 1%. But taking a look at the Dow, we have a little bit of a different picture here. We have JP Morgan up 1%, and I'll take a look at the bank stocks separately in a minute, but Cisco's up 2%, Caterpillar up 1%. So really the value in cyclical trades being represented among the winners here. And got to just touch on Morgan Stanley real quickly, up about 1/3%, blowout quarter, record profits. So the banks this week that reported record profits, Morgan Stanley joins JP Morgan, Goldman Sachs, Citigroup, and the stocks, let's check out what they've done over the last 5 days, because a lot of these guys sold off. So you can see kind of a mixed picture here, although Goldman Sachs and Wells Fargo are standouts. Goldman Sachs up 3% for the week, Wells Fargo up 6%. And the other thing out of Morgan Stanley is it dropped about 2 or 3 percentage points on the announcement because I think of the stated exposure to Archegos, $911 million. Credit Suisse still has about $5 billion in total exposure, and they're reporting in 1 month. And I'd be remiss, didn't check on crypto here. Bitcoin up for the week, but let's check out today. The last 24 hours down 2%. It's tested the 60,000 level. This is the breakout level. So if we go to the year-to-date chart that I have been kind of annotating here for couple weeks, we did get the breakout. We've tested the downside. Now we want to see liftoff over the weekend. We start getting some price action, too much price action below 60,000, probably a false breakout, guys.
Didn't even mention Doge up 180% today because, that's just a thing that happens now in the market. Doge breaking the dollar. Congrats to everybody betting on that trend. Very exciting times for everybody in Doge land. All right, Jared Blickery, thanks for the update on everything happening in the markets on this Friday morning. We're off for a short break. On the other side, you're going to take a look at what's happening over in European markets. Back with that right after this. All right, mixed market here in the U.S., though the Dow and the S&P are pushing to record highs. Let's take a look at stocks over in Europe as we see a rally across the board there. Latoya Harding joins us now for the latest on European markets. Latoya.
Well, stocks in Europe are pushing higher today, following Asia's lead after China revealed record first quarter growth of 18.3%, and that was led by strong industrial output. Now, the FTSE 100 finally pushed above the 7,000 point level for the first time since February 2020 today, and the FTSE 250 also on a roll, having risen by 26% in value over the last 6 months as vaccine programs continue, stimulus packages roll out, and business confidence surveys hit record highs. Now, the FTSE 100 has been a bit of a laggard compared to international markets on both sides of the Atlantic for us, having, of course, a bigger exposure to commodities and banking than Wall Street and Frankfurt. But it's now 40% higher than what it was at the worst of last year's self. We've also seen today the DAX and the CAC both pushing higher on the day today. Also, banks being amongst one of the top performing sectors today across Europe, as well as oil producers and miners joining the rally, as well as travel stocks too. And this all comes as new data from the ONS today showed that around 1 in 480 people in private households in England had COVID-19 in the week to April 10th, down from 1 in 340 last week. And that was the lowest figures that we had since the week to September 19th, 2020, when the estimate stood at 1 in 500. So that's very positive news in terms of getting those infection rates down across the country. And it follows some 32 million people now having received the first dose of a COVID vaccine in the UK, with around 8.5 receiving their second also in the country. And of course, the vaccine rollout program as well is gathering pace in Europe this week amid a third wave of infections. So again, pretty positive news there, and that's again boosting stocks in Europe today.
All right, Yahoo Finance's Latoya Harding with the latest on everything happening in European markets. All right, we're off for a short break here. On the other side, we are going to hear from Brian Sazzi's conversation with Wendy's CEO, Todd Penegor, on the state of that company's innovation pipeline. Back with that conversation coming up right after this.
Wendy's has no plan to slow down its attack on breakfast rivals McDonald's and Burger King. I talked at length with Wendy's CEO Todd Penegor on what the company is cooking up next.
Yeah, well, pleasure to see you again, Brian. It's hard to believe it's been a year since we've last chatted. Time really flew through the whole pandemic. You know, breakfast, we could not be more pleased with how our breakfast business is performing. You know, when you showed up here back in February, we were getting ready for the launch, had all our national media cranked up. We had an unbelievable first week. We were plus 18%. And then the pandemic hit and we pulled all our media and we shifted our marketing plans because we were going to be the official breakfast of the NCAA last year before the tournament got canceled. But I'll tell you what, you know, throughout the pandemic, we've been getting into people's morning routines. Our business ended last year at mixing at about 7% mix, so exactly where we thought it would be in the first year. We supplemented that with some strong support from company-funded advertising, as well as the franchise support that we've had throughout the year. And we're really excited about where this business can go in the future. And as part of our earnings, you know, we just talked about, we do believe it can be a 10% mix of our business by the end of 2022 with the momentum we've seen, because it's doing well, but mobility's down. People don't have their morning routines. And we know we have a lot of opportunities on awareness and trial, which can drive the business like crazy in the future.
How close so 10% of sales by 2022, how big a business in terms of sales would that make breakfast for Wendy's?
Yeah, so what we've been talking about is, you know, how is it $1 billion plus incremental sales layer to our business? So we're a $12 billion system today. So at 10% mix, you know, $1 billion, $2 billion, $3 as we continue to grow the rest of the day part too. So that's a sizable business to pick up in the course of a couple of years.
That's almost, if I'm just crunching some numbers here, that's almost 200 million more than when we initially talked. You were targeting, I believe, $1 billion goal within short order. To me, that sounds like market share gains. Where are you taking market share?
We do, you know, in the data that we see, we are picking up our fair share within the business. You know, you got some sourcing from all the traditional big players. You know, the smaller mom and pop and other folks have had a little more challenge through the pandemic. And you've had a lot of restaurants closed unfortunately, during the course of the last 12 months. But, you know, we think there's just a huge opportunity. You look at where other traditional QSR players, they're all mixing much higher than 10%. So it's a journey for us. We think there's a lot of growth for us into the future. But to be able to establish a business that's already at 7% with a line of sight to be 10% by the end of next year, we're well on our way to really have a day part that's driving a lot of growth and really helping fuel the restaurant economic model for our franchisees.
And the franchisees, they're still committed?
Fully committed. We had an opportunity, as we had talked about in the past, after the first year, we were going to allow folks to take a look to see if they wanted to opt out, if they were in a trade area that just wasn't working. We've had literally less than 5 franchisees asked to opt out. And the only folks that have asked for a little bit of hiatus are those that are in a trade area that has been completely shut down. If a mall or a athletic venue was right near them and not driving a lot of business during that into that trade area. So no, they're all in. And what they really loved, it's driving additional frequency to our restaurants. It's incremental to our rest of day business, and it's profit and margin accretive to the business. So they're feeling good about it. And the pleasant surprise, Brian, it was a lot easier to staff than they thought that was going to be. So we were able to hire up staff and have a very effective and efficient model for the morning day part.
You mentioned mobility. Mobility data, that has started to come back a little bit. I watch a lot of the Google Trends data. People are going back out, likely after they're getting vaccinated. What have you seen in your business?
Yeah, we're in that quiet period right now. We got earnings coming up in a couple of weeks, but just in general mobility trends, we're seeing the same thing. Folks are getting a little more comfortable getting out. Everything we look at is seeing mobility pick up. You still got about half of the folks still working from home, so the routines are a little different on the mobility. You don't really have that dedicated morning routine with the big rush to get to school, big rush to get to the office. But people are out and about during the course of the morning. And what we've really seen in our breakfast day part is it continues to build all morning long. So our biggest peak half hour in breakfast is between 10 and 10:30. And I think a lot of that is folks are doing a little more grazing, getting the late morning snack, getting to be out behind the Zoom camera and grabbing a biscuit and a frosticino to keep them going throughout the day. And how that changes over time, we will see as the routines come back. But, it's not that dedicated mobility. It's not a routine yet, right? We're all willing to get out a little bit, but it's not like we're on that every morning we're heading to work or every morning we're heading to the gym, but it's starting to pick up nicely.
So Todd, I know you as a pretty competitive guy. We're both Pelotoners, but what are some of your thoughts on McDonald's entry into the chicken sandwich wars, so to speak? We all love to say chicken sandwich wars. They launched 3 new sandwiches in mid-February. What have you seen?
Yeah, no, everybody's been launching into that space. A lot of discussion with everybody that plays in traditional QSR. And, the good news is it's created a lot of discussion and a lot of noise around chicken. And we've been very pleased with our chicken business. It goes back to the fourth quarter of last year when we renovated our home-style chicken and renamed it the classic chicken sandwich. We've done work to have a more tender, juicy grilled chicken sandwich. I know we had sent you some over today to have for lunch. And we continue to do work on our spicy lineup to make sure that it's got the spice that holds. But we're not just doing things on our base sandwich. Our Made to Crave lineup allows us to truly innovate on chicken sandwich business. The jalapeno popper chicken sandwich is the one that, as we talked about on earnings, was off to a nice start in its early days. We can continue to win in the chicken space, not with high quality base protein, but with the toppings and the fixings that we can put on them with the Made to Crave lineup. So we feel really good that we're in a position to compete. No matter what McDonald's does, no matter what Popeyes continues to do, no matter what KFC decides to do, we're in a great position to continue to win and get our fair share of that business.
Why is the industry? Why do they love chicken sandwiches? What is it about chicken sandwiches?
Well, chicken sandwich, you think about it's from an entry perspective, you got a fryer. If you're going with the fried chicken, it's easy, quick to make. You can serve it fresh and hot. And you can do some unique builds along the way. And if you look at where the protein markets have been over the last couple of years, the chicken protein has been very predictable on a cost pattern. I know it's been creeping up a little bit more recently, but I think that's why folks love it. It's a great eat. It's got a healthier perception to it from a consumer perspective. So I do think that there are a lot of folks gravitate to it. And with all the news that's been created, it does drive a lot of trial, and it gets folks to really think about, maybe I need to have a few more chicken sandwiches in my routine. So it's been good for the industry.
Is Wendy's seeing inflation? You mentioned chicken, but are you seeing inflation in meat and other commodities? And how have you overcome that?
Yeah, we are seeing a little bit of inflation, especially as the economy comes back and demand starts to pick up. Some commodities we have covered, others are uncovered, but not insurmountable. We're seeing a little more labor inflation along the way as access and cost of labor is a little bit more. But with all of the productivity that we've been able to drive through the pandemic, with getting more cars through the drive-through, the work we've done around labor positioning, the work that we're doing on technology to drive higher average checks. Both with mobile grab and go, curbside, as well as delivery. All of those things have helped us, along with a little bit of pricing, to really overcome those headwinds and still drive a strong restaurant economic model for the system.
Todd, you scan the industry right now, and there appears to be a lot of folks trying to rethink what the restaurant of the future will look like. A reinvention of the insides. Taco Bell recently came out with touchscreen ordering systems inside of one of their Times Square restaurants. You had some companies now dabbling in autonomous delivery of their pizza or their burgers. What do you think about those moves?
Yeah, they're all out there in the future, Brian. At the end of the day, why QSR has always been so successful, and we've talked about this in the past, is speed, convenience, and affordability. And those are basic human needs that we can deliver in the QSR space. Wendy's, we can differentiate on quality. We talk a lot about how do we create a frictionless experience at the restaurant, fast and fun. And how do we really turn our parking lots into frictionless transaction centers? And you think about coming to the drive-through lane, and the line's been long lately, which has been great for the business. But how do you skip the line? How do you do a mobile order ahead of time and go in and do a mobile grab and go, or go to the other side of the building and do a mobile order and have a curbside pickup? Those are all the near-term things that really solve for a customer need. It is around that speed and how do I skip the line along the way. We'll continue to look at where things go into the future, and you can start to dream up all these other things with drone deliveries and autonomous vehicles. Those are further down the pike to really drive the business. our business is really driven by two things, personal disposable income and miles driven. And, those things are still core to our business today. So how do you make sure that that restaurant is set up for that success? And then we'll think about those future items. The great news is we've been ahead of it, right? Abigail Pringle, who's been leading our development team, we've had a smart suite of designs. So we've had 65 seaters, 55 seaters, 40, 30. We're dabbling in drive-through only restaurants right now. We got a nice pipeline of those. We're doing a lot of conversions. And we've been playing in the dark kitchen, our ghost kitchen space, which is getting us more access in some of those locations where we don't participate today, especially in the urban location.
Drive-through only, so no seats inside?
No seats. I mean, there's certain trade areas that, we've learned through the pandemic that we do think a drive-through only would make some sense. It could be complemented with delivery along the way. We would have never thought about that if you go back pre-pandemic. But for the right trade area, those are solutions that can actually get us into different footprints, into smaller parcel sizes, and could be a good complement to the business where we're not.
And your international expansion, we've talked about this in the past. Is that, how many restaurants do you plan to open this year internationally? And are you still targeting UK as an important market?
Yeah, I'll start with, as you think about where we're going, we just talked about at earnings that we'll be 7,000 restaurants across the globe, US and international by the end of this calendar year, on a way to drive to 8,000 restaurants by 2025. And, the international business is growing about 10% a year on units. They'll quickly pass the 1,000 restaurant mark, which will be quite exciting for us. UK is a big market for us to really entrench ourselves in that market so we can start to build out the rest of that market with other franchisees in the UK, and then allow us to get back into Europe, where we haven't been for a long, long time. We'll open about 5 restaurants this year in the UK. We'll probably open another 10 next year with the pipeline that we have. We really thought we'd have about 20 company restaurants and then really fill out the market with franchisees and then allow us to have a franchise model across the rest of Europe. But what we're really seeing is our business internationally was so strong pre-pandemic. It got paused a little bit with some of the challenges in various countries, but they really feel great about where the Wendy's brand could go. So as the economies are opening back up, a lot of our franchisees really are eager to start developing and provide more access to our brand in a hurry across the globe.
And you can watch my full interview with Wendy's CEO Todd Penegor now on the Yahoo Finance homepage. I also have some articles hitting off this interview. You can catch those on the Wendy's ticker page on Yahoo Finance. All right, Miles Sutherland has some trending stocks he really, really, really wants to talk about. That's coming up next.
All right, welcome back to Yahoo Finance Live on this Friday morning. Let's take a look at the major averages here about 30 minutes into today's trading session. Coming off record closes for the Dow and the S&P, we see both of those averages currently trading in green figures. The Nasdaq under a bit of pressure, off about 0.4%. On yesterday's close, should note the Nasdaq 100 hit a record high, but the Nasdaq comp still below its prior record close. Let's also take a look at what's happening in Dogecoin. That is the main story in crypto. Obviously, an interesting week in the crypto space with Coinbase coming public on Wednesday. The Doge up nearly 200%, because that is just a thing that happens. The market cap of Dogecoin, which again is mostly just a joke, closing in on that of Ripple, which does have some underlying projects on that network. All right, off for a short break here on this Friday morning. Back with a lot more, including conversation on the state of the U.S. economy with Bank of America's Michelle Meyer coming up right after this break.
Welcome back to Yahoo Finance Live on this Friday morning. I'm Brian Sozzi. Miles Udland is on the box right next to me. Julie Hyman will be back from assignment on Monday. All right, let's get a quick look at these red hot markets 30 minutes or so into the session. The Dow and S&P 500 hit fresh records this morning. And over on the Nasdaq, yes, you guessed it, it's also nicely in the green, or it was, now slightly in the red. Things move fast in these markets. All right, all eyes remain on the volatile trading in crypto exchange Coinbase. After a blistering debut on Wednesday, Coinbase shares fell 2% on Thursday, and the stock is seeing mixed action so far today. Fun fact though, the crypto Dogecoin is the top trending ticker right now on the Yahoo Finance platform as its value simply explodes higher. Markets are also digesting another impressive quarter out of a big bank. This time, investment banking giant Morgan Stanley. The company clobbered analyst estimates on the back of recent acquisitions of E-Trade and Eaton Vance and strength in the M&A department, but it did disclose a $911 million hit from the Archegos debacle. Economic data is also top of mind after that impressive retail sales report on Thursday. And Miles, let's get to you here because I know you dove into some economic data of your own in this morning's morning brief, and that would be initial claims.
Yeah, I just wanted to take a look at initial claims after yesterday's print. 576,000 folks filing first-time claims for unemployment insurance. This is the lowest number we've seen since the pandemic began. It's also the first time since the pandemic recession began that we saw claims print a number below the high hit back in the financial crisis. Now, of course, during the financial crisis, it took several years for the maximum pain in the labor market to be felt. The unemployment rate didn't peak for a couple of years and peaked after the recession had ended. Certainly a very different situation that we're seeing in this recovery, but did just want to flag this claims data. And there are some Easter distortions. It's a noisy data series. We may very well see claims on a weekly basis back up a bit in the coming weeks. But this, to me, was not only to me, to everybody, this is the first place that we started to see the impacts of the pandemic show up. And when you look at that chart we just had up, this is, to me, the most shocking piece of economic data that is out there. I mean, 6.3 million people filed for unemployment insurance in a single week, almost exactly 1 year ago. We had 20 straight weeks where more than 1 million initial claims were made. The total number of claims made during the pandemic is almost half of the U.S. workforce got there if you add them all up. And again, that's kind of a crude number and maybe not exactly representative of how much stress there was. But again, this was really the pain point through which I think a lot of people started to see the impacts of the recession play out. I remember in March of 2020 or April of 2020, like the Today Show was reporting on initial jobless claims. If you want some context into just how far and wide this mostly overlooked, largely arcane piece of economic data had gone as a signal of where things were. And so I think it is important to mark its improvement and also gives us a decent backdrop for thinking about other parts of the economy that are roaring back to life. Obviously, that retail sales number we got this week off the charts. And you see the growth that's happened in retail sales over the last several months. Just one piece of what is looking like a very strong bounce back through 2021. So again, just trying to keep tabs on all the data as they improve, and initial claims not something we talk about a lot in the morning brief. Emily McCormick covers it every week. So again, just felt the need to flag it this week as we finish up the reference week for the April jobs report, and we'll see what that spits out in about 3 weeks.
Yeah, Miles, on that jobs report, this dive into initial claims, what do you think? What do you think it says about the next jobs report coming up in a few weeks?
Sally, look, I'm a professional, so I'll say we can ask Michelle Meyer at Bank of America about that right now, because I am not going to dig into the Excel spreadsheet here on what exactly this claims number is going to spit out. Again, could be distorted. We have to seasonally adjust all these things, but we only have to wait 3 weeks, fortunately.
Hey, you stole my tease. All right, let's bring in Michelle Meyer. She is Bank of America's chief U.S. economist. Michelle, always good to see you. Let's just stay on this point. We've seen the initial claims data improve a good bit, retail sales data improving. What do you think these data points say about the next jobs report?
So it's setting up, I think, to be a very strong report. We already saw in the March report, 916,000 jobs were created. I think we'll likely beat that in the next report. So it should be in the order of 1 million, maybe above. We're still getting data that will help to inform what we will expect to see in the next report. But the data flow has been tremendously strong. We saw, a dramatic increase in retail spend. The claims numbers are improving. Confidence measures are picking up. Manufacturing activity is still roaring. If you look at the ISM surveys, and just yesterday we had Empire State and Philly Fed for April. So that's more of a forward-looking indicator. Both improved. So, yeah, I think job creation should be quite robust in April.
So, Michelle, let's go back to the retail sales report that we got yesterday. Obviously, the February report in hindsight was kind of a strange one, and we got some give back. But as you look at the trajectory for retail sales, how much runway do you think there is given stimulus, given some reopening trades, and given just the specific sector areas that stood out yesterday?
Sure. So a lot to kind of unpack there. I would say the first point around stimulus, certainly the stimulus payments contributed quite a lot to the gain that we had seen in retail sales in March. There was a big jolt to consumer spending, particularly for lower income individuals, and particularly to buy things with those stimulus checks. we think the next kind of stage in consumer spending will be much more about the reopening. It will likely be more driven by higher income consumers who have kind of unintentionally been saving because they haven't been, living their life in the typical way they have. So they haven't been spending as much on service activities, certainly not on leisure. As people feel safe to re-engage, as they become able to re-engage from a restrictions perspective, we think that will help to unleash consumer spending. But it's not going to be the same type of pace as we saw from stimulus. Stimulus is a jolt. The reopening is much more of a kind of steady upward pressure that will keep consumer spending running at a very healthy clip in our view.
Michelle, you are at 7% GDP growth for the first quarter. Where are you at now?
Yeah, so we're down a little bit. 6.5% is our real-time tracking, but that changes pretty much every day. When we get more data, our tracking will move. So somewhere around the 7% range seems fair for Q1. And I think as you look forward to Q2, that's where it actually gets even more interesting. We think it's going to be double-digit growth in the second quarter. We're forecasting 10% annualized increase, which will be kind of peak quarter of the year. And a lot of that growth actually comes from the handoff from March, because this incredible data throughout the month of March kind of kickstarts the second quarter and translates to what we think will be very, very strong performance from a quarterly perspective.
Wow, 10% GDP growth in the second quarter. Where does that take you overall for the full year, Michelle? Are you optimistic on the back half? And so much so, are you at 10% GDP growth for the year?
No, so we're at 7% GDP growth for the year if you're measuring on an annual average. If you measure on a Q4 over Q4 basis, just to align to the Federal Reserve, we're looking for 7.7% growth. So that does suggest, as you can imagine, some slowing in the second half of the year. And a moderation makes sense, right? We know that it was kind of this perfect storm of economic activity in the spring, from stimulus, from pent-up demand, from people just getting back out and being able to spend. And that creates that kind of level shift higher, which is what's showing up in the data. Into the second half of the year, we think growth will remain supported. We think we will see further consumer spending. And importantly, we think we'll see CapEx pick up, business investment pick up. And that creates, a sustainable, healthy cycle. But nonetheless, you can't continue to grow at 10% growth indefinitely when the trend in the economy is close to 2%. So we do think we'll see some moderation, but above trend growth through the rest of the year.
And Michelle, how are you guys thinking about the housing market right now? Obviously, the rate story presents one picture, inventory another. Where does that fit into the recovery?
Yeah, so we just saw housing starts today, which were, kind of a blowout number, for lack of a better word. Very strong housing activity in terms of home building. The home builder sentiment survey released yesterday is holding close to a record high. So I think the landscape is very favorable for housing construction. We know inventory levels are at historically low rates. If anybody out there is trying to buy a home, you're probably experiencing this firsthand because homes are flipping very quickly. They're moving very, very fast. And that's been creating a lot of upward pressure on home prices. So there's a need for more building. That said, as we look into the rest of the year, we do think we'll probably see some moderation in home sales relative to the very strong pace we had last year. So some moderation in demand, strong supply that's necessary to rebalance the market and take some of the momentum out of home prices.
And then, Michelle, finally, obviously with this kind of growth, we're talking around the issue, but just on the exact data that you expect to come in on inflation and where you expect to see some of those biggest price pressures come from, and how you're, I guess, preparing through a summer where you're going to have to talk clients through, here's why the Fed might not all of a sudden be raising rates against print X.
Yeah. So the next few months, as you noted, will remain interesting because growth's at a strong, inflation picking up, and yet the Fed's going to still have this very asymmetric reaction function. And I think that there's going to be two things to look at. One is the components that are driving the increase in inflation. And you can discern that pretty quickly from the data. Is it driven by a level reset of prices for airfare, for lodging? All of these categories that were deflating last year because of weak demand, they should be inflating this year. We know that's a correction that's going to happen. Even core goods prices, we know there's supply chain issues. Those are somewhat temporary, though. It will create upward pressure, but it shouldn't remain. So I think it's going to be important to look at the drivers of inflation, and you can kind of discern whether or not they're temporary or more persistent increases. And then on that note, the second thing I would say is very important to monitor is inflation expectations. What do people expect going forward? Because if expectations are rising, transitory becomes permanent because people expect higher prices in the future. So far, inflation expectations have been well contained. We just got the University of Michigan Consumer Sentiment Survey, which showed long-run inflation expectations actually tipped back down a bit to 2.7%, which is well within the range. But if that becomes, kind of outsized on the upside, then I think you have more concern about transitory inflation becoming more sticky.
Point well taken. Michelle Meyer, Bank of America Chief U.S. Economist. Always good to see you. Have a good weekend.
Great to be here. Thanks, Brian. You too.
All right, coming up, we are live with Stifel's Chairman and CEO following his latest annual letter to shareholders. It was a real good one. More on it straight ahead. Bank earnings season is still raging on, and so far, so good. Deal volume has been solid. Same goes for trading activity. Outlooks, not so bad either. Amidst this backdrop, Stifel stock has hit a record high. Let's talk all about it with Stifel's Chairman and CEO, Ron Kruszewski. Ron, always good to see you. I was thinking briefly, we haven't talked much about the infrastructure package this week. How big a economic driver do you think that will be if it does, in fact, get passed this year?
Well, when your previous guest talked about all the things that are happening in the economy and the stimulus, and we have over $2 trillion of excess savings. We have almost $1 trillion of excess business investment opportunity. You've seen all the numbers come in, and it points to a very strong 10% GDP in the second quarter. Yet on top of it, we're talking about $2 trillion in additional infrastructure spending. And that is going to have a real impact on the unemployment rate. I think it could push it to sub 3%. And then the real question is while all this is going on, you have real interest rates that are negative. And while the Fed is on one hand trying to get inflation back to over 2%, I personally believe that these set of financial conditions are creating some asset bubbles. I hate to use that word because no one ever knows when they're in a bubble, but we're really pushing some asset values when you look across the board with what I think is a suppression of interest rates and done so really by the Fed on purpose.
Ron, to that point, do you think we're now at the point where investors would be wise to reassess valuations and maybe stocks do pull back from here?
Well, I'm not. I think that we're in one of those periods, and no one ever rings a bell to either tell you to buy stocks or to sell stocks, and I'm not trying to do that. What I understand, and I think investors need to understand, is what happens to very, very high PE stocks when real interest rates, if real interest rates start to rise. There's convexity to that curve, and you can see some of these PEs get halved. I mean, it halved easily. And I'm just not sure that investors are really focusing on the correlation between low rates and these high growth stocks. And, I think you sort of ignore that at your investing peril.
Ron, it's Miles here, and this gets to something you were writing about in your annual letter about the role that Reddit and some of these social trends have played within the market, and you guys have seen that play out a certain way in your business. It seems like some of that steam has come out of the market just in the last few weeks. But what do those trends signal to you about this phase of the cycle in the context, certainly of everything we've just chatted about?
I was more talking about almost the convergence of social media and investing, and I see a lot of good things about that. Certainly, investor education, getting people into the market. There's some good things, but there was a time there when these certain stocks were really just trading with no basis in underlying fundamentals, and my comment was that our investors should be careful to not have a fear of missing out on, like the GameStop just frenzy. So it's here to stay. I do think it's calmed down a little bit, but there'll be another one. Make no mistake.
And Ron, you also write in the annual letter, and your peers in the financial services industry have weighed in this as well. You're bullish on the return to the office. You view it as important. Why is that?
First of all, we have successfully been able to work remotely. There's just no question that the technology and what we were able to do. We had a record year last year, record revenue, record profitability. I do feel fortunate about that. But with that times 90% of the people not coming to work. But I noticed rather early on the cost of that in the reduced level of collaboration, esprit de corps, training. In our business, we're an on-the-job training shop. That's how you learn the business. And we have lost a lot by not being together. So I said in our letter that we will come back safely, but make no mistake about it, other than a few situations where we might be able to accommodate someone, one-off situations working at home, we're coming back to work. I think that is in the best interest of everyone, and I look forward to that. We're not doing it today, but we're close.
And Ron, in that vein, we've seen some competitors of yours in the investment banking industry have, let's call it, upheaval among their junior staff and thinking through what people want to do with their careers. And I'm just curious how you've communicated with your staff and from where you guys are at today with, again, what's been a challenging period, but one that is hopefully normalizing soon.
Yeah, well, I think that is certainly I've read some of the stories about the 100+ hour weeks, and I'm certainly hoping that we're not driving our staff, to those levels. That said, most of the people in our investment bank aren't working 40-hour weeks right now. We are very busy, and and my partners are frankly pretty thrilled to have a lot to do. There was a few years ago when we wanted to work 40-hour works, we just didn't have anything to do. So there's a balance, and I don't want to overly. We've not had that issue really at Stifel about people, complaining that we have too much to do.
Ron, you mentioned also in your letter before we let you go, 25 years as Stifel CEO. I mean, you're the only CEO of Stifel I've ever known. What have you learned as a leader the past year of the company? The
past year, I think that, as much as things appear to change, they remain the same. The issues in the industry, whether it be the GameStop, that's occurred before, whether the recent hedge or family office blow up, that's happened before. Markets are very volatile. People, fear and greed will take turns running the market. And, when you really want to understand what might happen in the future, often all you have to do is look back at the past and you will see that. And I think that's instructive today, because I do believe we're running into a period that we will look back and understand that that investors bid up some assets and non-fungible tokens, the digital art, some of these things. We're going to look back and recognize that this might feel a little bit like '99, and we'll say, how did this ever happen? Well, it's happened before. So I just learned that as much as I worry about the future, I get my answers by sometimes just seeing what's happened in the past.
Yeah, I'm still trying to figure out what an NFT is, Ron. Let's leave it there. Stifel Chairman and CEO Ron Kruszewski, always good to see you. Stay safe. We'll talk to you soon.
Thank you. All right, bye.
Okay, Intel stock was just hit with a tough downgrade. We're back shortly with the details.
All right, welcome back to Yahoo Finance Live. Sazi, you are taking a look at shares of Intel today, coming off of a downgrade from the folks over at Raymond James. Intel's had an interesting last couple of months here. Pat Gelsinger now in as the company's CEO. And we've really seen some enthusiasm, as we can see on the year-to-date chart, around the story for Intel. Talk us through what the commentary is today.
Yeah, Miles, Intel shares are up about 22% since Pat Gelsinger was announced as Intel's next CEO on January 13th. So a lot of optimism on his leadership. But Raymond James is stepping in here. Chris Caso is the analyst at Raymond James, saying, no go. Downgrading the stock to an underperform from market perform, really for two reasons. First, it says Intel won't reach its goal of opening new foundries and making chips for other companies. And then to that point, point number two is that Intel will continue to see pain financially as it invests billions of dollars in CapEx and other costs to help build out more internal manufacturing capacity to address the chip shortage. But I do want to remind people what exactly Intel is in fact spending $20 billion on. Here's a clip from my chat with Intel CEO Pat Gelsinger just a couple weeks ago.
When we think about the world situation today, there's an extraordinary demand for semiconductors, right? As we've seen, basically, the world is becoming more digital. Every aspect of that runs on semiconductors. And then COVID put us into a higher gear, right? It just accelerated, remote work, remote education, telemedicine, automotive. All of these are now seeing the shortages of semiconductors. So the world needs more of these capabilities. Also, the world wants a more balanced supply chain. There's an extraordinary concentration in Asia, right? So US and Europe, and we're one of the few companies that could step into that.
And fairly common sense here, Miles. Chip shortage, you have to increase production, and Intel's going to spend the money to do it, which again, I don't think Gelsinger is under, that this is going to be an easy job turning the company around, but he's an optimistic guy. He gets up really early in the morning. He's working hard. He's trying to turn the company around. But I will note this too. This is not anything new. An analyst coming out negative on Intel. Out of all the analysts on the sell side that cover Intel, the stock already has 8 sell ratings or underperforms here. And you just look at the multiples on the stock. Intel trading at about 15 times forward earnings. AMD 41 times. NVIDIA 43 times. So AMD and NVIDIA, a lot of optimism there. If Intel could just get past this investment cycle, maybe it fetches a multiple like an AMD and NVIDIA over the next couple of years.
Yeah, and it's just interesting when any of these names come up, because it feels like the same story in the last 4 years has gotten remixed 5 different ways, and the ultimate answer is we like NVIDIA more than we like Intel. We like AMD more than we like Intel. We like Micron more than we like Intel or Qualcomm, whatever it is. I mean, it seems that we sort of end up coming back to Taiwan Semi, Micron, NVIDIA, AMD, even though, as we discuss on the show all the time, everybody this side of the Mississippi knows there's a bull case for semiconductors and chips and anything adjacent to that. So Intel has at least caught a bit on that side of it.
Yeah, Intel's been, I would say, a whipping boy on Wall Street, and they've taken a lot of beatings the past year and a half, even though they have put up some pretty good performances. They have Mobileye, that division is doing pretty well. But again, Gelsinger was brought in to turn the company around, and it's going to take some time to do it. And ultimately, he's probably the right guy to do it.
Yeah, certainly a very interesting story to follow. Just a storied name for a number of reasons, not the least of which the role that Intel as a stock played, back some 20 years ago, and then thinking about where Pat Gelsinger, another veteran of the Valley with a lot of success under his belt, can take the company. That is at a mature stage, but certainly trying to re-accelerate some of those growth engines, get people excited about Intel once again. All right, off for a short break here. On the other side, we're going to be talking about another play on the stay-at-home trade. We're going to talk to the CEO of Lovesac about the furniture that they're putting in homes across the country. Back with that conversation coming up right after this. All right, well, the stay-at-home trade continues as people continue to remake their living spaces that they are spending more time in than ever. One company benefiting from that is Lovesac, and the company's CEO, Sean Nelson, joins us now to discuss a record year for the business. Sean, thanks for jumping on this morning. Just talk us through what trends you guys have seen really in the last year and how you're now thinking about those as the world starts to normalize and people are maybe not, panic buying a couch or a chair and maybe thinking about life going back to normal.
Yeah, that's the question everybody's asking. Our view is that life has been forever altered, and like it or not, people are working at home, staying at home, contemplating where they want their home to be as company policies come down, just like the interview before, speaking about where people are going to be working. Are they going back to the office? In our case, we'll be primarily remote, and I believe a lot of the country will be that way in corporate America. So we're bullish on the housing market. We're bullish on people moving. That's the number one driver for couch purchases is people changing places, and we have the only couch that can move with you in the back seat of a Honda if you want, because of the way Sactionals pack down and are shipped FedEx and delivered to your door and reconfigured and can be with you the rest of your life.
Sean, what type of couches, what are some of your top sellers right now during the pandemic?
Yeah, so our business began with these giant not bean bags filled with shredded foam called Lovesacs. If you've ever seen like an 8-foot not bean bag filled with foam, that's probably a Lovesac. But our Sactionals have just caused our business to explode. We have been the fastest growing furniture retailer in the United States for a few years now based on this product. It's furniture that could literally be with you the rest of your life, not just because you can move it easily and it can be delivered easily, but because you can arrange it, rearrange it, reconfigure it, and recover it. Machine washable, kid-proof, life-proof couch. And so that's the core platform. And we have numerous products we've layered in over the years, a couple new introductions this year that allows people to grow and expand, add technology, charge their phones, charge their devices, embedded, hidden in the couch, reverse compatible with the pieces they already might have bought a few years ago. We continue to put out reverse compatible accessories that go with these Sactionals. And I think that's what's caused us to build the following we've built.
And so, Sean, if I go in today to one of your showrooms or go online, how long is it going to take me to get a couch? Because if I've had this conversation with one friend, I've had it with all of them about 4, 6, 8 month waits for some couches. Where are you guys at in that point?
4 to 6 days in our case, maybe, depending on how close you are to one of our warehouses. We are always in stock. Sactionals are special. It's just seats and sides. You buy any number of these seats and sides that can be configured and reconfigured, covered and recovered any way you like. And we've got covers ready to go in any fabric you want, and 200 others you could have custom ordered. If you feel like waiting 4 weeks and need stripes or polka dots or what have you, we can do that too. But typically they're ready to go, they're in stock, they're moving rapidly, and we keep them in stock because that's literally all we sell. We're a very unique company in that way.
Notice, Sean, you have more showrooms open now year over year. Why is that showroom having that open? Why is that still important?
Yeah, so during the pandemic, we were able to actually prove our thesis that these are not retail stores. These are truly showrooms for the internet. We're a direct-to-consumer business. We're totally direct-to-consumer. No wholesale, no distribution per se. It's all our own showrooms, even where we collaborate with, say, Best Buy. We're doing shop-in-shops. They're little Lovesac shops inside of their footprint. And during the pandemic, we got to close all of them all at once. And we saw all of our business move online. We didn't miss a beat. We continued growing 30, 40% all the way through. And now out the other end, all the business has moved back to the showrooms. We're comping at incredible rates. Q4 was a 45% same showroom sales comp, but they're all internet sales at their core. They're people that have researched online, checked it out, understand what they want, but come into the showroom to sit on the thing. I mean, we're selling $3,000, $4,000, $5,000, $10,000 couches. They love to sit on it, try it out, pick their fabrics in person. But really, they began as internet customers, and the pandemic helped us prove that. And so these showrooms play a tremendous role in conversion. We're long on showrooms. We'll continue to open, around 20 this year, as well as another 15 of these Best Buy shop-in-shops. We're really excited about, making this available to customers. But our ultimate goal is to have as few showrooms as possible, but be able to be available to everyone. We're not trying to build some kind of retail chain.
So how many locations are you in Best Buy, and are you still in Costco?
So with Costco, we've moved to an all online format. We were doing pop-up shops within Costco. We've also got some interesting things brewing there and possibly with other retailers as well. But in the meantime, we are focused on only putting showrooms where we can be available to people within like a 25-minute drive. And so we're not trying to be everywhere. We're not trying to be convenient. We're just trying to cover the map. We've got a long way to go. And so Costco is a great partner. And these partnerships like Costco and Best Buy will allow us to reach more people more ways.
And then, Sean, something you guys talked about a little bit in the earnings release was the impact that tariffs are having on the business. How are you thinking about those pressures, and do you have any visibility or any hopes on how those situations may change as the new administration kind of breaks in here?
Yeah, so Lovesac became a bit of a poster child for tariffs at the beginning of that entire saga because we had all of our production in China. Luckily, we had already been working on diversifying, and we did so very rapidly. We're now producing in 4 different countries across Asia. We even have plans in the future to be able to produce all in the United States. But that's a longer term focus of ours on the manufacturing side. In the meantime, that diversification has very lucky timing with everything that's happening in the world today in the global supply chain and containers piling up here and there. Having redundant production of these same 2 SKUs that power our whole business, like the same 2 SKUs that you might buy for your basement would be the same 2 SKUs that someone might buy for their cabin or whatever, just wearing different covers, right, and configured differently. And so all of our containers coming over from each one of those geographies have those same items on them, which allows us, even if we run into stoppages here or there, has given us great flexibility, and is why we're always in stock right now, ready to go. And we ship FedEx, so it's just days away.
All right, there you go. Word to all the viewers out there who are getting a 6-month quote at their local mall, Lovesac, 4 to 6 days. Sean Nelson, CEO of Lovesac. Sean, thanks for jumping on. Really appreciate it.
Great to see you guys. Thanks so much.
All right, off for a short break here on this Friday morning. Looking at a mixed day in the markets. Back with more on what's moving underneath the surface coming up right after this. All right, welcome back to Yahoo Finance Live on this Friday morning. Mixed day in the markets. The Dow and the S&P, though, trading in the green, coming off of record closes on Thursday. The Nasdaq remains just slightly in red figures here. A name that's on the move underneath the surface here is Bed Bath & Beyond. We talked Brian Sozzi to the CEO, Mark Tritton, earlier on in our program, telling us a bit about his view on the business heading into 2021. Now, of course, Bed Bath stocks sold off hard after its earnings release earlier this week, but repairing itself a little bit today.
Yeah, Miles, interesting to watch this. Bed Bath & Beyond shares now up close to 4%. You can see the stock gaining pretty sizably after our interview this morning with Tritton. Also, the clip of that interview gaining a lot of steam on Twitter right now. But I think what it might reflect is what Tritton told us about sales in March and trends so far in the most recent quarter. Sales in March up 10%. That's a big gain overall. But it's also a big sequential acceleration from the fourth quarter. Same-store sales were up close, I believe, a little bit close to about 5%. So Bed Bath & Beyond looks to be off to a decent start so far for this quarter. Also, pushing back on the notion, I think, that a lot of analysts had coming off the quarter earlier in the week, that the recovery in the business won't be a straight line. He told us it will be a straight line. So it will be very interesting to follow that story in the coming weeks.
Yeah, Sozzi, I found that interesting because to me, look, I'm not a corporate executive. I'm not managing street expectations. But to me, what a great fallback line to say our turnaround plan will not happen in a straight line. And I understand that it's disappointing as a management team to come out of a quarter and see your stock off 15 or 20% the next day as you jump off the call. But I feel like that's not something that we're going to hear a lot from executives who are doing a turnaround. When we say, hey, is it going to be a straight line? Is it going to be lumpy? They're usually going to go with the lumpiness because that's usually the way business works. So I thought that was an interesting kind of bet, really, that he's making on the plan his team has in place.
Yeah, going up at a straight line is usually good, just like those markets, right, Miles?
That's right. Well, look, stocks do usually go up. And of course, been plenty of content on that from me and Sam Rowe over the years. We'll see what Sam has to pull out of his back pocket when he gets back from his vacation and writes Monday morning's morning brief. All right, coming up on the other side of this break, Brian and I will talk about the top 3 things that we learned during this first week of earnings season. Back with that right after this. All right, welcome back to Yahoo Finance Live on this Friday morning. Again, a mixed market here. Dow, S&P in the green, Nasdaq still slightly in red figures. But Sazi, it's been the first full week of earnings season. Banks certainly leading the way. Let's go through some of our top stories. I think as viewers of this program are well aware, my top takeaway continues to be the way that Wall Street is underestimating both the corporate recovery and the economic recovery. We just saw it yesterday with the retail sales data for the month of March, blowing away expectations. We have seen it from each of the banks. We saw it out of Delta earlier this week. Estimates are just too low. And now we've talked about some of the dynamics that are going to be driving that. As an analyst, you can't just come out and raise your estimates for a company by 50% because you think that's where it's headed, right? You have to have all kinds of inputs to your model. And those inputs have so far been leading to estimates that are too conservative. Steve Sosnick of Interactive Brokers also told us that banks are not a good tell anyway, because banks are complicated. And as Matt Levine famously wrote in Bloomberg, no one can really know what a bank earns in any one quarter, including the bank. They just sort of put some numbers down and here are the earnings. And I think the complication that goes to running a major financial institution, I think we all understand how those dynamics play out. But as we get into the teeth of earnings, Netflix is coming up next week. In a couple weeks, we're going to see results from the likes of the Apples, the Amazons, the Facebooks. I suspect that we're going to see the same story, Sazi. We're going to continue to see estimates too conservative, and I'll be very interested to see as we get into those real market bellwethers how much the street does or does not react to those kinds of results.
And Miles, what's not so complicated here is the read so far this spring on the U.S. consumer. And look, you had American Eagle Outfitters, primarily a mall-based retailer, coming out this week with a large upward guidance revision for the first quarter, approaching $1 billion in sales in the quarter, and saying its sales now exceed pre-pandemic levels in the first quarter of 2019. That is a big release. Also in consumer land, outside of the retail sales data, Louis Vuitton coming in somewhat under the radar screen here, Miles, with an upward guidance raise of its own strong handbag sales. And on Monday, we're going to be talking with Coca-Cola CEO James Quincy and McCormick CEO Lawrence Kurzius. I'm interested to see what both of these executives say about strength in the consumer. Are they going out there? Are consumers still shopping aggressively in supermarkets now that the pandemic is starting to turn the corner? By all indications of the data we have gotten, at least in apparel land, the consumer is pretty strong right now, thanks in large part to those stimulus checks. They're out there spending.
Yeah, and Sal, we heard from Pepsi CFO Hugh Johnston earlier this week talking about the view that they have, that they, as Pepsi, can kind of have it both ways. They continue to benefit from some of these grocery store, at-home kind of trends. Certainly the Frito-Lay business, a big part of that for them, with a different portfolio than Coke. But they're also getting the benefit of the food service, as they call it, food service line coming back. Restaurants come online, stadiums are reopening with more attendees. So big part of Pepsi's business. That's a even bigger part of Coke's business. So I'll be interested to see how those results shake out when we get them next week. The third thing, Sazi, that you flagged for us this morning, and this is really happening underneath the surface with earnings starting. We saw Coinbase come public, all very exciting in markets. The SPAC market has really dried up here. It's a great stat from the Wall Street Journal earlier this morning. Until last month, the Journal notes that roughly 5 new SPACs hit the market every business day in 2021. And over the past 14 days, there have just been 12. So we're going from a pace of 25 at least per week. And now we're half that over a 2-week period, or more than 2-week period if those are business days. And Sazi, kind of expected to some extent, right? We've talked to so many SPACs on this program. We only talked to one this week. A lot of them have no business. They're just putting these projections out. But to see the boom really slow down, you do wonder how many sponsors came to market that are never going to find a company to buy, and what's going to happen to some of those stocks and some of the ones that have now broken the $10 price after their combination.
Bottom line here, Miles, the SEC lurks as the dark cloud, as they should. Some of these projections that a lot of these companies have put out for the next 5 or 10 years have been absolutely absurd.
Yeah, and look, I mean, you could probably make an argument DraftKings started this whole boom because DraftKings is a good company and the stock's done really well, and it made everyone think maybe the SPAC is the way to go. But there's only one DraftKings, and there's not been nearly as many successes in their wake as I think a lot of SPAC sponsors hoped there would be. All right, for Brian Sazi and Miles Ludland, it's going to do it for us this week here on Yahoo Finance Live. Back Monday morning. Julie Hyman rejoins the crew, 9 a.m. Eastern. We'll see you then.
Welcome into Yahoo Finance Live. Happy Friday, everybody. I'm Zach Guzman alongside Akiko Fujita as we have the Dow and the S&P 500 once again this week, wrapping up the week with new record highs. You can see here the Dow enjoying a nice 130-point pop. The S&P 500 enjoying about a 10% pop as the Nasdaq trades about break even right now. Morgan Stanley, though, continuing the stream of earnings beats among the banks. We'll break down how that impacts the rest of earnings season. Still early yet, but some nice movement there. Plus, COVID vaccines starting to pile up in some states as enthusiasm appears to wane. Why that could pose a major problem as we are nowhere near herd immunity that doctors are talking about. And Pfizer's CEO says a third booster shot appears likely just 12 months down the line after that final second dose. And Google pouring $200 million into a housing project in San Jose to build 4,000 new homes, a quarter of which will be rent restricted and affordable. The highest percentage any private developer has ever agreed to in the city. San Jose's mayor will join us to break down how that deal might set a new precedent. But first, I want to start out the show here on the vaccine front, since that's becoming even more important to the state of the reopening here after the CDC paused Johnson & Johnson's vaccine following issues around blood clots. The CDC panel now looking at a timeline to revisit that pause in just about a week from now. And for the latest there, let's bring in Yahoo Finance's Anjali Kamlani to kick us off today. Anjali?
Hey, Zach. Yep. So we just found out that the CDC's vaccine advisory panel did set a date of April 23rd to reconvene and discuss Johnson & Johnson's vaccine pause. We know that they had an emergency meeting this week and that had no conclusion whether or not to recommend restarting. And we do anticipate there might be, similar to the AstraZeneca vaccine, some sort of advice or alert for women, especially under the age of 50. So that's going to be really interesting to see how they handle that in comparison to Europe's handling of the AstraZeneca vaccine. Meanwhile, we also know that they are calling for more vaccinations in the meantime and trying to get more vaccinations out there. We know that there's definitely a discussion of booster shots. We did hear from Moderna CEO Stefan Mansell about the same thing earlier this week, but we also know that there's really a look at sort of the dynamics right now at play between the mRNA vaccines as well as the Johnson & Johnson vaccine, and why the mRNA vaccine companies may not be willing to look into blood clots or any other adverse events. That was reported today in the Wall Street Journal that the Johnson & Johnson did reach out to these companies. AstraZeneca was on board to take a look at clots specifically, but because the CDC has identified that there are no clots associated, no one's really willing to look into it. So listen to what Stefan Mansell had to say about that.
I think it's very wise for the regulator to be careful. What is clear, I think, is you have countries now that are getting worried because you have some vaccine like ours at a 90+ efficacy rate. Some are already in the 60s. So of course, 90 is better than 60. And then you have this question about potential side effects. And so indeed, governments around the world are placing a lot of phone calls.
So as you can hear, and as we saw with the stocks, really a boost for these companies. And Stefan Mansell also pointing out to the difference in efficacy, which health experts have taken a lot of time to try and downplay, saying that all vaccines are equally efficacious. And that should be the concern more than anything, to just get a vaccine. And so to your point, Zach, there's definitely a lot of commotion going on with what the rate of vaccine hesitancy is going to look like while we try to pursue herd immunity. Back to you guys.
Yeah, we've heard that from a few doctors, especially even around the discussion happening around Johnson & Johnson's vaccine, that still, even though the CDC is waiting, we've heard a vaccine, generally when you look at the stats, better than no vaccine. But let's bring a doctor into the mix to help us continue this discussion here, Anjali. I want to bring on Dr. Ali Raja, co-founder of Get Us PPE, as well as a Harvard Medical School professor. And Dr. Raja, what's interesting is we're kind of looking at what Bloomberg's pointing out as potential waning when it comes to vaccine enthusiasm right now. Of course, close to 40% of the U.S. adult population has gotten at least one dose, but it sounds like, according to their data, states are now piling up some of the vaccines there, and that would seem to be a bit of a concern considering how far we have to go before we hit herd immunity. So where are you in terms of grading where we're at right now, given the new concerns around variants in Johnson & Johnson?
Well, Zach, I'm really disappointed. I saw that report as well. And the fact is that even when we look at the state level, that doesn't give us enough information. It's important to think about getting down to the local level, because even within a state, especially if there's a large metropolitan area, there can be a lot of really diverse vaccine acceptance throughout a state. So if you look at some of the southern states, in larger cities, the vaccine is getting used and people are waiting in line for shots. But out of large metropolitan areas, there are a lot of vaccines that aren't being put into patients' arms. And that's really disappointing, because especially in those more rural areas, they don't have a lot of healthcare resources either. And so if patients do get sick, it's a real strain on healthcare resources in all of those areas.
Having said that, Doctor, we're looking at some states that have now passed that 50% mark in terms of those who've gotten at least one shot. Now we're talking about potentially a third shot that's going to be necessary down the line. I mean, does that change anything in terms of the timeline that we've been looking at for trying to get most Americans vaccinated by the end of May?
It's a great question, Akiko. I don't think that it changes anything right now. What we know about the vaccine is that it does prompt the various vaccines do lead to a really strong immune response for the vast majority of patients. When we start talking about a third shot, we're talking about one that's, say, 6 months, a year out from the first couple of shots, because of the fact that, quite honestly, as with the seasonal flu vaccine, it's perfectly reasonable and logical that with the variants, we'll need a booster shot as time goes along. But I don't think that changes the timeline of getting vaccines in most Americans by May.
Yeah, Dr. Raja, that was kind of why I was a little confused as to why there were so many headlines around what we heard from the CEO of Pfizer talking about the need for that booster shot 12 months down the line. Because even back in January, when we were talking to the CEO of Moderna about that, he told us that it was going to be likely that we would need to see that. Here's what he told us all the way back in January. I just want to play it and get your reaction on the other side. Take a listen.
I believe SARS-CoV-2 is going to stay with humans forever. We're going to have boosts adapted to the virus like we are for flu. It's the same thing. They are both mRNA viruses, and we're going to have to live with it forever.
So, I mean, obviously staying with us forever was pretty drastic when we heard it back then. It sounds like Pfizer would agree with that in terms of the booster shot. But if you kind of put together the fact that right now it seems like Americans are kind of getting, I don't want to say not going to get vaccinated here, but clearly kind of a de-evolution in terms of excitement around vaccines, I think, if you look at the stats. Does that become worrying if even those people who were excited to get it as soon as it was available to them now has to get a booster, and you worry about maybe even them also kind of skipping a booster shot? What does that mean for our recovery and reopening?
It is disappointing, Zach. For years, doctors have been talking to their patients about the importance of getting a flu shot. And this is going to turn into the same sort of discussion. I tell my patients every year as we start approaching flu season that they should get a flu shot. And I've got to tell you that there is varying acceptance of that. And given the pandemic, it makes sense that everybody was excited to do what they could to get to a point where we can loosen restrictions and have herd immunity. But eventually, that crisis is going to pass, and this is going to need to become part of our annual treatment of and preventative medicine treatment of patients. And that's where I worry, because once it becomes something that has to be done every 6 months or every year, we're going to lose patients' willingness to do it.
Well, Dr. Raja, I want to ask you a little bit about that, because I know that when we were kind of discussing this before getting on the show about the idea that it's a forever virus, there was a chuckle there. So I want to know, do you think that the part about it being forever is drastic? Is it just that we'll have to do sort of concurrent vaccinations until the rate globally gets low enough? Or are we truly looking at sort of like a seasonal flu type situation?
Anjali, I think it's a little bit hard to tell right now. I think that calling it a forever virus is a little extreme right now, just because we don't know. And once you say forever to a population that is so bent on trying to get this thing under control, it can become demoralizing. And I think what we need to focus on right now is the fact that, yes, we'll need boosters for 6 months, a year, a couple of years down the line. But we will understand more about this completely novel virus in that year or two. And I'm personally still hoping that we can get it to a point where it goes away.
Well, let's talk about, in the meantime, all the other vaccines that we're looking at coming out there. We know there's been sort of that stumbling from AstraZeneca as well as Johnson & Johnson. Other vaccine players have just completely fallen out. So a lot of pressure and a lot of focus on these mRNA vaccines. Do you anticipate anything out of that CDC panel meeting next week in terms of maybe an age restriction? And if so, how might that impact our vaccination progress?
Anjali, I do. I hope for two main things coming out of the panel that's meeting now, as you mentioned, in a week. The first is that I hope that they restart, that they allow for and recommend restarting giving the Johnson & Johnson vaccine. As we've been talking about all week, the risk of these blood clots is exceptionally low. The J&J vaccine is very effective, and we should be using it. The second thing is I hope they give information about who the risk of blood clots is greatest for. Right now, it looks as though my 60-year-old male patients really shouldn't be hesitant about getting the Johnson & Johnson vaccine if what they're thinking about is blood clots. But there's probably a population of patients who should be a little hesitant, and there needs to be recommendations made around that. So those are the two things, but I really hope that we restart the J&J vaccine as soon as we can.
Yeah, certainly a lot of people waiting for it and potentially having to reschedule those appointments. Dr. Ali Raja, great to talk to you today, co-founder of Get SPP and Harvard Medical School professor. And our thanks to Anjali Kamlani as well. Let's turn our attention back to the markets and one stock that is moving, although not as significantly considering the earnings results that we got. Morgan Stanley down about 0.8%. First quarter profit and revenue for the bank beat Wall Street estimates. The bank posted a profit of $4.1 billion, earning $2.19 a share. That number more than double the $1.7 billion it earned and it posted a year ago. Revenue surged 61% to a record $15.7 billion. That was helped by stronger than expected trading and investment banking activity. Investment banking activity alone jumped 128% to $2.6 billion.
Yeah, not bad at all. Coming up, we're going to be chatting more on what those bank earnings mean for the rest of earnings season. And another day, another call for Coinbase to nearly double. We'll chat with an analyst who has a $500 price target on that stock right after this. Welcome back to Yahoo Finance Live. It's been a very interesting week for crypto fans out there. Of course, today we're watching Dogecoin be one of the trending tickers on our site, but also let's not forget that just a few days ago we had Coinbase's direct listing setting a record for the largest direct listing ever. The shares open at $381 a share. Since then, we've seen a few analyst reports come out and point to price targets well above that, including $600, $650, and today, an analyst joins us with a price target of $500, talking about the big upside that still might be there for Coinbase. I want to bring him on now. Mark Palmer is BTIG Managing Director, Research, FinTech, and Digital Assets. He joins us now on the phone. And Mark, I mean, when we look at this, your $500 price target comes 16 times multiple on 2024 expected revenues. But when you dig into it, a big piece of your thesis as to the upside is the institutional impact that Coinbase has and how that business is just kind of getting started now?
Yes, thanks very much for having me. Good to talk to you. That's absolutely right. The institutional part of the story, we think, has really not been highlighted to the extent that we believe it will be going forward as the company begins to demonstrate the strength of that platform. To put this in perspective, Coinbase just launched its prime brokerage service in the middle of January, and it wasn't even complete at that point. A big piece of that is a company called Bison Trails that Coinbase acquired in the third week of January. So the company has a robust prime brokerage platform, custody, over-the-counter trading, crypto lending, and now staking with the Bison Trails acquisition. To really emphasize one part of this, securities lending is a huge part of equities prime brokerage on Wall Street. Very profitable business. Coinbase is extremely well positioned to do effectively the same thing, but with crypto lending to hedge funds and other investors. They are the safe haven in the space. They have cooperated with regulators. They've never been hacked. There's very little career risk for an institutional investor in deciding to partner with Coinbase. That, we believe, is going to translate into some big numbers for that business over time.
What kind of numbers are we talking about, Mark? I mean, when you look at Coinbase in relation to some other IPOs we've seen this year, you've highlighted the fact that this is a company that was profitable, but critics would argue, well, sure, it was profitable in a year where we saw a huge surge in Bitcoin. When you talk about the sustainability aspect, with the money coming in from the institutional side, can you put a number on how significant you think that upside looks like?
Yeah, sure, happy to. It's really not about institutional trading. And I think that's where some of the confusion comes in, because people focus on institutional trading and the fact that the margins are extremely thin, and they say, okay, what really matters here? We're focused on the institutional subscription and services revenue. It's the ancillary services that are really going to make the difference. We project that those are going to grow at the top line more than 30% from 21 through 25. And we may be very conservative in that regard. So I think that's really important. With regard to margins, the company posted a 63% adjusted EBITDA margin in the first quarter. We do not believe that's sustainable. The company has said so simply because they're in growth mode. They're out there. They're going to be spending on sales, marketing, technology. It's a land grab, and they are going to be spending to execute on that land grab. What's important, though, is that the company in the first quarter demonstrated what the margins could be in the future when this is a mature business. A 63% adjusted EBITDA margin is basically in the same context as CME Group. So they don't need to print those margins. We wouldn't, as analysts, want them to print those kind of margins in the near term. We want them to go after the top line growth, and that's what they're going to do.
Yeah, outside of the institutional focus here, I mean, I wonder what the other biggest catalysts might be, given, we talk about active traders and the gains there and people coming to cryptocurrencies. Obviously, Dogecoin right now, I think, driving a lot of adoption from people who may have been outside some of those more, I don't know, shall we say, looked at projects. But when you look at maybe what those drivers might be, you got to pair it with the downside risks. And we keep going back to how levered this company is to crypto, obviously, and why this might be a better play than just owning Bitcoin or Ether or some of the other ones outright, given that we've seen how revenues can take a hit in prior downturns in the crypto space. So how do you pair those things?
Well, we fully acknowledge that this is a play on the ongoing growth and adoption of Bitcoin and other digital assets. That is what it is. And so there is going to be volatility that goes along with that. But frankly, this is a company that had 11.3% share of all the world's crypto assets at the end of the first quarter. And the total market cap of all crypto is 2.1 trillion. If that grows to 10 trillion, 20 trillion, 30 trillion as adoption increases, and coin is able to maintain anything close to its current market share, the upside is going to be enormous. So this is one where, yes, there could be some swings in the near term, but over time, the company is extremely well positioned to benefit from the growth and adoption of digital assets in a way that not a lot of other vehicles will.
Well, I mean, there's a lot of excitement around this space right now. We'll see how it goes. Still in the early days, but appreciate you coming on here to talk about where we could see Coinbase trade here in the interim. Appreciate you taking the time. Once again, Mark Palmer from BTIG, Managing Director, Research, FinTech, and Digital Assets. Of course, as all of this is playing out and all the excitement is there, clearly on the crypto side, there is, of course, earnings right now to pay attention to from some of those more boring traditional companies, just the big banks that we'd be covering here. And we've gotten beat after beat after beat to kick off earnings season here. The latest, Morgan Stanley out today, again, beating expectations. It's something we've been talking about, setting us up for a very exciting quarter of earnings still to come in here. And for more on that, I want to bring on our two market guests to discuss all of that with us. David Bahnsen, the Bahnsen Group Chief Investment Officer, joins us right now alongside Chad Oviatt, Huntington Private Bank Director of Investment Management. And David, why don't we start with you, because we have been talking a lot about kind of the expectations right now on Wall Street. And if anything has been proven out so far, it seems like they might be low still. But it might be a little bit of hesitance, I think, on the part of analysts to raise expectations beyond where they're at. So how do you see earnings season going, given the strength we've seen from the bank so far?
I think it's going to have a lot more to do with forward guidance for the remainder of earnings season, because you really are looking at comparables year over year that are just so skewed by where things were a year ago. Some companies, I think we're going to want to look at how they're doing now versus 2019, but the 2020 year over year comparisons are going to be very skewed. But as far as how markets respond to different things, you look at this week, a huge blowout response from Goldman Sachs, and Goldman stock went higher. A great response, great numbers out of JP Morgan. Their stock went down 1 or 1.5%. So there's different ways that things are already baked in as well. And we've seen that this week with the great results from the financial sector. As you get into the more penetrated parts of the S&P sectors, I expect we're going to look to their forward guidance as a key market mover.
Well, Chad, on that front, we've seen the Dow cross that 34,000 level for the first time on those strong numbers we've gotten out from these banks so far. I mean, it feels like beyond that, the expectations for future growth is spilling outside of value names as well. Where are you positioning yourself right now on the expectation that this momentum does continue?
Yeah, great question. Thanks for having us on. Really, for us, we continue to emphasize being balanced, being very deliberate in our portfolio construction. So we're not tilting necessarily to growth or value. We are at kind of our core individual stock pickers, and our equity team is looking at very much that forward guidance story, but also margins. So we're going to be looking at different things that are impacting various sectors and individual companies to make a decision. And that goes beyond just that growth over value discussion. Certainly, having a 10-year Treasury back in the 150 to 160 range helps some of those growth momentum names. We know that story, but also there's some really good value stories going on. So it's about trying to harmonize that portfolio within the construction. Right now, if we were to tell you what our favorite 3 sectors are, it's industrials, materials, and finance. So I guess that does lean to a value tilt, but we are staying pretty balanced in our construction.
David, would you agree with that one as well?
Yeah, we're real bottom-up oriented as well. And so in that sense, we have quite a bit in common. But I do think you end up with a value tilt right now when you're being bottom-up oriented. And for us as particularly dividend growth investors, we really have a value orientation just because some of the great dividend growers are in consumer staples. Last quarter, they were in energy, and energy was at a really attractive value. That's, there's been a great recovery there. I think you have to be bottom-up oriented. I think the indexes are trading at multiples that are too expensive to just want to own everything. Discernment right now is very key. And I know people have been saying it for years, but it's really become true. It's now the time for active managers.
And Chad, when you look at the economic data, everything points to this momentum picking up in the economic recovery. We saw jobless claims falling to their lowest since March of last year, retail sales jumping 9.8%. Have your inflation expectations shifted at all as a result of the string of data we've gotten this week, or do you sort of just listen to what the Fed chair has said, essentially that this is transitory and there shouldn't be any worry about that?
So we did get some really good economic numbers coming out of March, right? We consider March kind of a lift-off point for the U.S. economy. It's really picking up speed, kind of moving into that next gear, if you will. We saw with the consumer price index this week moving 2.6% higher year over year, but the markets kind of took that in stride. They looked at that and cited, I think a lot of market participants were citing the so-called base effect with those year over year comparisons. And so we would suggest that some of the inflationary pressures right now may be transitory. You have supply chain disruptions, production bottlenecks, there's some commodity input prices. Some of those may be temporary and resolve themselves. That said, we're still looking at 2.9% as an inflation target for this year. But we think, as the Fed has mentioned, some of this is transitory this year. Inflation is going to be a bigger story in 2022.
We'll be watching that one closely. Chad Oviatt, Director of Investment Management at Huntington Private Bank, as well as David Bahnsen, Bahnsen Group Chief Investment Officer. It's good to have both of you on today. Well, coming up, Google's new $200 million project, a mega campus planned for the city of San Jose as the tech giant expands its physical footprint. The mayor of San Jose, Sam Liccardo, will join us to discuss after this break. In our worldview today, Japanese Prime Minister Yoshihide Suga visiting the White House today, and you're looking at a live view between him as well as Vice President Kamala Harris over in D.C. He is the first foreign leader to visit the White House, and China expected to be at the center of the discussions today. Suga reportedly set to announce a $2 billion commitment to work with the U.S. on alternatives to Huawei's 5G network. Biden and Suga are also expected to discuss human rights concerns in Xinjiang and Hong Kong. The two are scheduled to hold a press conference this afternoon where they are expected to issue a joint statement on Taiwan. That would be the first time they've done that since 1969. Hong Kong media tycoon Jimmy Lai has been sentenced to 1 year in jail for his involvement in the city's pro-democracy protests. Lai was convicted of unlawful assembly earlier this month following charges he helped organize the 2019 demonstrations protesting China's growing grip on the city. The sentences of 2 other activists were suspended on Friday. Lai's imprisonment is a symbolic victory for China as Beijing continues to crack down on Hong Kong. Just last month, Chinese officials overhauled the electoral system there to give Beijing more control. And the UK is preparing to say its final goodbye to Prince Philip. The funeral for the Duke of Edinburgh is set to begin at St. George's Chapel at 10 Eastern on Saturday. Concerns of coronavirus infections have limited the gathering to just 30 people at Windsor Castle. Prince Harry, who flew in from the U.S., will also be among those attending. The Duke's coffin is set to be placed on a modified Land Rover that you just saw there that he helped design. Prince Philip's funeral marks the official end of a period of national mourning in the UK, although the royal family will continue to observe 2 weeks of mourning. And we'll be right back. Well, Google is looking to dramatically expand its presence in the city of San Jose, unveiling a new $200 million mega campus that includes 4,000 housing units across 80 acres. It's part of Google's larger plan they've announced earlier this year of $7 billion investment to expand office space and data centers across the country. Let's bring in the mayor of San Jose, Sam Liccardo, joining us today. Mayor, it's good to talk to you. Certainly a big announcement for your city. Talk to me about the economic benefits that you see, especially at a time when the city, like so many cities, have really been trying to bounce back economically from this pandemic.
Well, thanks, Akiko. It is a really critical time for cities across the country, and it's not just a matter of bouncing back, but bouncing back more equitably. We saw how the recovery went from the last recession, and we know that here in California, many families struggled mightily with rising rents and rising housing costs at a time that they weren't sharing in the Great Boon. And so what's really essential about this project is Google gets it about the importance of supporting equity in the community, and they're making major investments in education, affordable housing, and a host of other ways to really try to boost the opportunities for all of our residents.
On that front, you've got 4,000 housing units that are included as part of the project, 25% of that affordable housing. To your point, a lot of these tech companies have been under pressure for contributing to the rising costs of housing in the Bay Area. To what extent do you see this as a template for other cities, even just in the state of California, to follow as these companies expand their footprint?
Well, this is obviously a great example of what a major company like Google can do. What you see on the screen is a roughly $200 million community fund that they're creating for community benefits. In addition to what you see on the screen, they've committed, as you mentioned, 4,000 housing units, about 1,000 of which will be rent restricted and affordable. They're also making really significant investments in parks and trails and a host of other amenities that are going to be important for our community. So this is really very epic, certainly for the city of San Jose, the largest private sector investment we've ever seen, some 7 million square feet. We understand this isn't going to be replicable in every city just because we're very fortunate to have this unique situation with Google. But I think this pattern in which tech is increasingly understanding and getting the fact, and I shouldn't say it's all tech, but certainly Google gets it, about the fact that tech can be a divisive force economically, and it's going to take some real intentionality and investment to make it a force for bringing people together, for closing that gap. And here in San Jose, certainly in the heart of Silicon Valley, we feel that gap as acutely as anyone.
And Mayor, I mean, you pointed out that it was the highest percentage, Kiko's talking about there, a quarter going to be rent restricted and affordable housing there. The highest percentage of private developers agreed to, and whether or not the guilt there or the blame assigned to Google for pushing up rents, pushing people out is deserved or not. I mean, I suppose there are people there who don't care about whether it's deserved or not because that's the fact that they're living with. So talk to me about maybe what Google gets on their side of the deal here in committing to that and helping to, I guess, solve some of those rent issues in the city.
Yeah, the community benefits were tied to expansion in buildable space that essentially the city council would be granting to Google. That is higher heights, build out into public-owned land, and to be able to retrofit streets and so forth, to be able to make this urban village really work. It's not going to look like a typical tech campus. It's going to be very open, certainly integrated with restaurants and housing and a lot of public spaces and paseos and parks. But because this is an integrated effort that's going to require a lot of public cooperation and, in fact, entitlements to build in space that previously wasn't entitled, there was some justification that the dollars would be aligned with that square footage.
Mayor, we've had a chance to talk to you throughout the course of this pandemic, from the time when California very quickly enacted this lockdown. Since then, you've kind of gone through the waves of the virus, and it feels like there is some momentum picking up in the vaccine rollout, as well as businesses opening up. Where do things stand in the city right now in terms of the economic recovery? How bad is the damage when you compare it to where the expectations were?
Well, like so many communities, we are a tale of two cities. For the many residents here who work in tech, and indeed for our tech community, things have gone very well. And you might not even know there was a pandemic if you looked at their bottom line. The reality is we've got thousands of families, particularly in East San Jose and other parts of our city, that we know are excluded from that particular economy. Maybe they don't have the tech skills, they're not in the jobs. Of course, many of them are essential workers who were required to show up every day working in the restaurant kitchens or at the supermarket. And those are the families that are most seriously impacted. Our unemployment rate probably exceeds 15 or 20% in many of those communities, not far from where I live, for example, in Central and East San Jose. And yet, for many, many residents, I mean, our unemployment rate in the county is less than 6%. So one would think that number would suggest things are going relatively well. We know that there's a significant division in big cities throughout the country, and we're feeling that as well. And so really our focus is going to be how do we help lift opportunities for a lot of folks who may work in industries that are not going to come back right away. I mean, hotels, aviation, it may take many years to see some of those businesses be able to rebound and have those jobs again. And so we're really focusing on how we can get people moved into those industries that are still growing.
And when we talk about the tech community specifically, early on, there was this expectation that people just wouldn't return to the offices. And yet over the last month, we've heard sort of this trickle of companies saying, we're actually going to start moving bodies into the office. What are you hearing about what that hybrid environment is actually going to look like? Do you expect more people to return to the office than initially anticipated?
I do. And certainly remote work will be with us well beyond this pandemic. And I think we've all learned how it can work. But for a lot of innovative companies that really depend on the creativity of their employees, I think what I'm hearing overwhelmingly from CEOs is they value having smart people working in the same space, particularly across the disciplines, having the marketing folks and the design folks and the manufacturing folks be able to have those creative collisions when they're in the elevators or in the break room, be able to have those sporadic conversations that are often really essential to being able to create and iterate and solve challenges. And so I'm hearing more and more that folks want to get folks back into the office setting. Obviously, major investments like you see with Google's wanting to build out 7 million square feet in our downtown says something about the fact that tech is very interested in continuing a model in which we have people working together because they understand that's the value in a creative industry.
Yeah, we'll continue to watch that space. Always good to get a pulse check from the ground there. The mayor of San Jose, Sam Liccardo, good to talk to you today. We'll be right back after this short break.
Welcome back to Yahoo Finance Live. This week, Epic Games, the maker of the wildly popular video game Fortnite, announced a new $1 billion funding round to hit a valuation just shy of $29 billion. Of course, Fortnite has spawned a handful of gaming superstars, including a 25-year-old Australian named Lachlan Power. And Jen Rogers sat down with Lachlan to talk about how he's turned a childhood passion into a very lucrative career. Here's one of Yahoo Finance's The Next 21 to watch in 2021. Take a listen.
My name is Lachlan Power, and I'm a YouTube gaming content creator. And in 2021, I'll be focusing on building my gaming organization, Power.
So, like Beyonce, you go by a single name. You have over 14 million subscribers on YouTube. You started out playing Minecraft, but it is your Fortnite videos that can often be found on YouTube's trending videos. So, when and how did you actually figure out that this could be a career?
So I think we just hit 8 years. And it was actually pretty quick for me. The first month in, I think I was getting a couple thousand views on my Minecraft videos, which was insane. But at the time I had a side hustle project, which was developing a Minecraft server. And I always have this memory of like, there was one day where the revenue on that server made, I think it was like $1,000 in a day. And that was just like unbelievable money at that time. I was 17 at university, and I was just like, I think I'm gonna drop out and pursue this, I think. And haven't regretted that ever since.
What did your parents think of that? Like, did they try to convince you to stay, or did they get it?
They were sad at me leaving at first, and then tried to convince me to go back for the next year. Even though I was making really good money, but you know, the argument would always be there, this can't last forever. So I made it last forever.
So how do you define yourself now? Are you a gamer? Are you a content creator? Are you an entrepreneur?
It's a good question. I would say content creator would be the overarching kind of description of what I do. But these days it's a lot more delving into game development, you know, the whole ecosystem of content creators, and it mainly revolves around Power, which is the esports organization. We focus on a lot of game development stuff, you know, working with our new content creators out in OCE. That's where we're starting out, and just developing those as, you know, personalities within the space, helping them get the kind of tools and advice from myself on how to build their profile online.
So how do you spend your day? Like, how much of it is playing video games versus the business side of your job?
So the business side, it's interesting. It's like it's full-time squared. You wake up, you think about work, you go to bed, and in between that is just you think about work. There is nothing, especially in the influencer kind of side of things, you're always thinking about the next business opportunity. You're always thinking about your next video. You're always thinking about how you can better optimize a certain process within your organization. But to answer your question in regards to like how many hours I'd play a day, that's like a number that's steadily gone down over time. You know, that I enjoy playing games a lot because I don't get to play it as much as I used to. Like when Fortnite first came out, I think I was putting on like 8 hours a day. These days, maybe like 2 or 3, because there's just so many other things taking my time. But it's still definitely something I enjoy every second of.
I was actually really interested to read that Fortnite and the Australian Open teamed up for a Fortnite Champion Series. Do you think we're going to see more of this old guard and new guard, real world, virtual world coming together?
Yeah, I think Epic and the Fortnite team have done an amazing job with breaking down those barriers between, you know, traditional and the gaming realm, because it is so new. And the Australian Open is one great example. Fortnite's also done a lot of things in game as well through the Icon series. You know, we have awesome, amazing collaborations with Travis Scott, more of these mainstream things that kind of, you know, make gaming cool.
So you bought your first NFT, non-fungible token. So what do you think of NFTs?
Yeah, no, I think the NFT space is amazing. I've been doing a lot of research myself personally into the whole scene. I think for creators and creatives, it's a great way to monetize your audience in a new way. And I think we're going to see a lot more of it. I feel like for creators, it's a lot like buying a piece of apparel, or, you know, having ownership of a collectible within an organization or something, or a creator. is a very powerful thing to do online. And I think it's going to be very interesting if that world collaborates with a game. That could be a very interesting space.
And do you feel the same about Bitcoin and crypto? There's a little bit of overlap people see between your world and the crypto world.
Yeah, definitely. And I feel like it's getting closer to that bridge day by day. I personally am very into crypto. A little bit of investing myself into a few coins. And it's just very interesting, the blockchain technology. And I would really love to see a video game get involved, because I think that is going to be when it gets real.
So what advice do you have for kids everywhere who want to be like you? They want to make a career out of playing video games.
I would always start on YouTube. It's just a great discoverable platform for people to find content. Provide value in a way through niches. Growing out of a niche is probably one of the best strategies you can do. That's what I did. I grew out of a mod within Minecraft. I didn't just tackle straight from Minecraft. And I feel like Fortnite as an example, there's a lot of niches within creative, especially right now as it's a new space. But just finding a way to do things different that you would still watch. And you need to focus on your titles, your thumbnails. They're your first things that a new audience member would see. So you need to have your best foot in the door and then just deliver on the content. Make them not want to click off the video. Make sure you're getting good retention on your videos and using your data to make better videos. And finding ways to create content that people aren't doing is the best way to grow, in my opinion.
It is time for this week's lesson at Yahoo U. Today we are talking about market cap. Let's bring in Brian Chung. Brian, we talk a lot about Amazon being a $1 trillion company, Apple being a $2 trillion company, but how do you break it all down?
Like everything, Kiko, size is relative. And because of that, class is in session today, we are talking about market cap. And I'm actually going to guess that most of our viewers already know what a market cap is. It's how big a company is. But what's fascinating about market caps is that it also tells us a little bit something about the market itself. Wait, what? Well, let me walk you through it with an example right here. So this is the calculation of market capitalization itself. So numerically, it's calculated as the stock price multiplied by the number of outstanding shares. So you can easily find these figures on our Yahoo Finance site. But if you just kind of take a theoretical stock, let's say it's $20 a share, and you multiply that by the 1 million, say that's how many outstanding shares there are, your market cap is going to be $20 million. Pretty easy mathematics right there. Now, of course, all companies come in different types of shapes and sizes. And I want to know that there's no SEC or formal definition for this. So it's going to depend on who you're asking. But broadly, a large company is defined as a company that's about $10 billion in market cap or more. Mid-size could be somewhere in the neighborhood of $2 billion to $10 billion. And then small is going to be $300 million to $2 billion. Now, within these subgroups, there are other types of categories as well. So if there's a company that's larger than $200 billion, we might call that a mega cap company. Any sort of company that's smaller than $300 million, we might refer to as a micro cap company. Okay, so the question now, and this is all pretty big stuff, the question is when we talk about the market, right? When you see us on Yahoo Finance, for example, quote S&P 500, what's covered in that? Is it only large companies? Is it a little bit of mid-sized companies? Is it a little bit of small companies? What's in the largest 5 companies?
Okay,
well,
Brian,
the range is pretty large, as you can imagine. And
Brian, we're going to have to stop you. It looks like your connection's taking some hits there. We're going to see if we can correct that, because I know a lot of people are looking forward to this session, especially because there's so much weight put on market caps of these companies. We're going to take a quick break here, but in our next hour, we're talking about a potentially big investment being announced over at the White House, with President Biden meeting with Japanese Prime Minister Yoshihide Suga, plus pizzas delivered by robots. The co-founder and CEO of Neuro is going to be joining us in our next hour. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. Happy Friday to all of you. We are seeing strong earnings lifting the Dow and the S&P 500 to new highs in the session. The Dow up 97 points there after crossing that 35,000 threshold for the first time yesterday. The S&P 500 now on pace for a fourth straight positive week. Vaccine stocks gaining in this session. A handful of states crossing the 50% mark for residents with at least one shot, even as Pfizer says you may need a third in 12 months. And robots on demand. We are talking to the co-founder and president of Neuro about its new rollout with Domino's. We begin this hour, though, in Washington, with President Biden hosting his first foreign leader. Japanese Prime Minister Yoshihide Suga expected to make a big investment in 5G technology today. Let's bring in Yahoo Finance's Jessica Smith, who's following that story for us. Jessica, there's a full plate here of topics on the table. China is certainly a big one, but this 5G one getting a lot of attention, especially given the focus on trying to push Huawei out of the network.
Absolutely. And the two leaders are set to announce a $2 billion 5G initiative, according to a senior administration official. We are still waiting on the exact details, but of course, 5G is a huge area of competition with China. Now, the prime minister did meet with Vice President Harris this morning, and then later this afternoon, he is set to have a one-on-one with President Biden. The two leaders will have a press conference later after that meeting. Of course, China is really going to be top of mind throughout this meeting. The president plans to bring up human rights abuses, tensions in the region, and economic competition. This is all part of a broader message that the White House is trying to send. In the coming weeks, the president of South Korea is also coming to the White House. So the White House is signaling just how important these allies are by having the leaders of South Korea and Japan come to Washington first. Now, President Biden has made it very clear that he wants to strengthen those relationships as the U.S. tries to compete with China and as the Biden administration tries to shape its overall China policy. The White House is also going to bring up several other issues, including climate change, the Summer Olympics, and several other topics. It's going to be a full plate, like you said, but I think China is really going to be the focus here. North Korea, a big issue for these two leaders to discuss as well. We'll hear from them both during the 4 o'clock hour again, so we'll keep you updated on what they have to say after that meeting.
All right, Jessica Smith bringing us the latest there in Washington, D.C. Appreciate that. I want to shift gears over to what we've been talking about in the crypto space. Of course, we've been focused a lot on Coinbase this week. The theme, though, has not all been about centralized exchanges over the last few months. DeFi, or decentralized finance, has caught quite a bit of attention from investors, whether it be decentralized exchanges or decentralized lending, as investors have turned to that. Close to $60 billion have flowed into DeFi projects over the last few months, proving we're well past the days of just Bitcoin and digital money at this point. But one project, Chainlink, is looking ahead to help blockchains communicate with off-chain data, perhaps to enable hybrid smart contracts that can be triggered by real-life events like the outcome of a football game, election, or other real events in the real world. The token behind the project, Link, is actually up more than 10,000% in 2 years' time. And for more on all things DeFi, let's bring in the co-founder of Chainlink in this week's Crypto Corner. Sergey Nazarov joins us right now. And Sergey, appreciate you taking the time to chat with us today. I mean, DeFi as a term has kind of become a catch-all, but how quickly have you seen that technology evolve in just the last few months? Because some of these projects already are making traditional banking look obsolete.
Thank you. Great to be here. I think the pace is just accelerating. As you saw from that chart, in less than a year, it's gone from around $1 billion to $60 billion. And I personally think there's going to be another zero there pretty soon based on all the value that there is to put into DeFi. So if you think about DeFi, you should look at it as a superior alternative to centralized finance, with its only limitation being that the value that it secures needs to be in this blockchain cryptocurrency format. So with $2.2 trillion in the cryptocurrency format and only 60 billion of that value in DeFi, that's about 2.5% of the value that can be placed into these financial products. So there's much, much further to go. Even going to 600 billion is something that I think is a pretty clear next step. Beyond that, I actually think that people will end up putting value into the crypto format, not so that they have the crypto format, but so that they can use DeFi. Because if you go to a bank today, you'll get 1% or below interest, whereas at DeFi, you can get 8% interest or 7% interest on that same dollar with less risk and more transparency about what's happening with your holdings, for which the only limiting factor is that people know about that. And by virtue of us discussing it here and elsewhere, they're learning about it. So the numbers, I think, will continue to rise rapidly.
We'll go into 600. That's going to be 10x from where we're at now. But I mean, you talk about the opportunity to earn interest on your crypto holdings, and that is interesting because we've seen centralized players like a BlockFi offer that for a bit. And I think it's easier for investors, maybe traditional viewers of this show, to understand how that might work, because it's essentially kind of at that point similar to a bank, though there are legal rules around calling yourself a bank. But when it comes to decentralized finance, that gets a little bit harder to explain where this yield and where interest is coming from. So, I mean, when you think about the on-ramp out there right now for people who have maybe never even dipped a toe in crypto, what do you think about those kinds of players, those centralized players, as kind of a stepping stone in that race to get to more decentralized solutions? How do you see that playing out when we talk about a Coinbase or a BlockFi?
I think those centralized financial companies that offer crypto products to both the crypto industry and the larger public have a user base that's very sensitive to cryptographic guarantees. And so they are, many of them working with us in order to further decentralize their infrastructure so that they can provide a cryptographic guarantee to the users that put money into their system. And I think there is a path for them to do this where they can gradually decentralize parts of their infrastructure and show the proof from those decentralized parts, while portions of their financial product is still operating in a more centralized form. And what I'm seeing them doing is gradually decentralizing their infrastructure, and there being a greater and greater demand from their user base, which once again is very sensitive to the transparency and reliability and risk dynamics of a blockchain, right? So their user base is wanting them to create that transparency that they get from DeFi. So I personally think that the majority of them will move into a decentralized financial product format in a relatively short time frame because their users will want that from them.
Sergey, when you talk about the total amount of assets, the value of assets hitting $500 billion within the next year, what does that mean specifically for Chainlink and your growth outlook?
At the end of the day, Chainlink is an infrastructure that enables DeFi because DeFi is a combination of blockchains and oracles. Oracles is what Chainlink does. Blockchains are what some of the other cryptocurrencies and projects out there you might have heard of do. If we had another zero, Chainlink will need to increase its security and has a system for progressively increasing its security already in place as the value it's secured grows. So I think what'll happen is that the amount of security Chainlink and Chainlink Oracle networks provide will grow. That'll lead to a growth in fees from users, which will be invested back into the security of a specific decentralized Oracle network. Once that decentralized Oracle network becomes even more secure, it's able to handle securing greater and greater value. So I think there's actually a virtuous cycle between more security being provided, more smart contract types being made possible by oracles, and the kind of value flowing into the industry, leading to fees being paid to the Oracle networks, and those Oracle networks then providing even more security and services. So I think what we're seeing now is a virtuous cycle where more smart contracts being built leads to more demand for decentralized Oracle networks and decentralized services, which leads to those Oracle networks and services being provided, which leads to more smart contracts being built. So I think it's the type of virtuous cycle that you see in other networks, network effects-based technology products, where demand leads to more services, and more services leads to people building more things and therefore more demand.
Yeah, when we talk about oracles, just for those who are watching who might not know, just kind of, an independent blockchain oracle providing data to these blockchains on top of everything else. And when we talk about maybe the way that that's been a problem in the past, we could have a project on one blockchain that doesn't necessarily talk to another. And we've seen that increasingly get addressed. I think the simplest example would just be decentralized exchanges again, or Uniswap, SushiSwap, kind of changing one token for another. And that seems simple enough. But for Chainlink, I mean, when you look at maybe what you guys are working on and talking about consensus around real world events, I mean, that kind of seems more difficult because sometimes even people in the real world can't agree on events. So how does maybe Chainlink play a role in bringing the non-blockchain space or events that don't necessarily communicate with blockchains at all? And how does Chainlink look to solve that in the timeline you've laid out?
Sure, absolutely. So we've actually released a new Chainlink 2.0 white paper yesterday, which details this in over 130 pages in great detail. I think the way to think about this is in terms of a decentralized stack, so a collection of technologies. Blockchains are like databases. Smart contracts are like the application code that defines the conditions under which things happen. And oracles and decentralized oracle networks like Chainlink are the services. They are all of the systems that the application code uses to achieve its stated goals. An example from the web world would be something like Uber, right? When you initially build Uber, you write some core code, and then you go get information about a user's location from the Google API. You get an ability to send them messages through the Twilio API, and you pay the driver through the Stripe API. And if you didn't have all of those other services and other systems talking to your core code, you wouldn't have been able to build Uber because you'd be forced to build all these other services around GPS and messaging and sending money. What Chainlink does is it takes all of those services that are in the web world and creates also new ones that can then be composed with the smart contract or core application code. And it's doing that at greater speed with greater and greater security as defined in the Chainlink 2.0 white paper. I think what we're already seeing is that an individual smart contract, even in DeFi, can use multiple decentralized oracle networks, multiple services to achieve more and more advanced functionality. So I think the right way to think about it is you have application code where you define the contract and its conditions, that holds value, that controls value, it creates transparency about what's going on with the financial product. And then you have all the surrounding services that give it market data, allow it to send payments, allow it to do any number of other things that it needs to do to achieve more advanced functionality.
Well, it's all fascinating to watch when you think about how fast the adoption cycle is moving this time around, and more people using crypto obviously enables a lot of these things you're talking about, but just fascinating to hear it all. The Chainlink co-founder, Sergey Nazarov, appreciate you coming on here to chat. We'll chat again about all that soon. Be well. We're going to take a quick break here on Yahoo Finance Live, but when we return, talking about tech hitting people right now today in Houston with Neuro and their self-driving robots delivering pizzas from Domino's. We'll break down the growth that company is seeing, including its more than $1 billion it's raised from SoftBank and others on the other side of the break, with the co-founder and president joining us right after this. Welcome back to Yahoo Finance Live. In this week's Startup Spotlight, starting this week, Domino's customers in Houston might open their door to a pizza delivery, not from a human, but from a self-driving robot. That's because the Domino's out there in Houston, teaming up with autonomous delivery company Nuro, the first to get an exemption from the U.S. Department of Transportation to test out its delivery bot on public roads. The company has also raised over $1 billion from the likes of SoftBank and even Chipotle in its latest $500 million round back in November. And join us now to chat more on that is Nuro's co-founder and president, Dave Ferguson, joins us once again here. And Dave, good to be chatting again. Congrats on finally getting this up and running. We talked a couple years ago about the progress you guys were making here, but how exciting is it to finally see pizzas getting delivered on real streets?
Thanks, Zach. Good to be back. And yeah, it's very exciting. I mean, we've been working on this obviously for almost 5 years now. And this week, getting to deliver real pizzas with a partner as amazing as Domino's to real consumers is a real thrill for us.
Dave, so many restaurants have talked about the need to create this touchless delivery point, especially during the pandemic, where there are so many concerns about any kind of transmission. Wonder to what extent that has accelerated the growth for you, and to what extent you've generated more interest as a result.
Yeah, it's a great point. You know, obviously with self-driving vehicles doing deliveries, one of the elements of that experience is that it is totally contactless from the point where someone loads the vehicle all the way through to when the consumer gets their goods out of it. And when we started out on this journey, that was seen as sort of a nice to have by our consumers and partners. And I think the pandemic has completely changed that. And exactly to your point, Akiko, now having a contactless experience has enormous value. And so we're seeing that becoming an additional benefit that our partners and consumers are asking for and really appreciating with the service.
Dave, you're talking to a guy who used to be a pizza delivery man, dare I say, a pizza delivery boy back in high school. And I don't know. I mean, I know that this job's difficult. So in the first week, how have deliveries gone and what have you seen so far?
Yes, you know, so far so good. We're ramping up. We mentioned we're doing it from one store in Houston to part of the local community, and we're really excited over the coming weeks and months to see how consumers take to it and what they love and what they don't love as much, so that we can improve upon it. You know, we've only been doing it for a few days so far, and so there's still a lot to learn, but so far so good for sure.
From a regulatory standpoint, does this provide an easier entry point to any kind of autonomous delivery? And it feels like we've been talking about drone delivery for so many years, and yet the regulation just hasn't caught up to that. Does that open up a bigger window for you?
One of the reasons why we were so excited to work on-road delivery specifically is that we have an incredible infrastructure already built around roads in this country, right? So roads are for transporting things. Now, usually that's people, but it's also goods. And so we felt that that was a clear, strong path towards building a full delivery infrastructure and service, right? If we can go on roads, we can go quickly, we can leverage existing infrastructure. We don't need to clear entire new regulatory fields, such as drones in the air. And we also don't need to use spaces that are primarily for humans, such as sidewalks, right? And so we felt that was the clearest path. And I think we felt somewhat validated in that decision over the last year or so, because we've gotten this exemption from the federal government for the first ever exemption to have a fully autonomous vehicle on roads. And we also got approval from the California DMV for the first ever fully driverless commercial operation. So we feel pretty good about that. We think it makes a lot of sense to use roads for what they were intended. And so far, we're seeing a lot of traction there with partners and our regulatory friends as well.
Yeah, the progress has kind of been like a frog in a boiling pot of water. It's kind of slow. Next thing you know, you got a pizza delivery. But when we were talking 2 years ago, we were talking about grocery delivery in Scottsdale. But what does the timeline look to maybe when this isn't just in Houston, but everywhere? And now with Chipotle on board in the last round of investing, when it might be more restaurants turning to you guys to maybe replace what DoorDash or Uber offers?
So we see a tremendous opportunity across a number of verticals. As you mentioned, Zach, we started out with grocery, and we're still operating with grocery partners, both Kroger and Walmart. But there's so much more to this than just grocery or even just hot prepared food, right? Today, 43% of all personal vehicle trips in the US are for shopping or running errands. That's almost 100 billion trips every year that we feel that we could replace if there was a service that could go do those things for you. If there was a service that could run those errands or pick up those goods for you, then you wouldn't need to do it. And to us, that's the opportunity. And that obviously spans across not just pizza with incredible partners like Domino's or groceries with Kroger, but all verticals and all local businesses. We really want to empower local commerce and strengthen the ability for communities to service the folks that live in those communities itself.
Well, we're certainly looking forward to continue to follow the progress of Nuro. Nuro co-founder and president Dave Ferguson, it's good to talk to you today. Coming up, the tech march to Miami, one major investor who is leading the push out of Silicon Valley. We're going to be talking to the founder funds, Keith Rabois, about his move into Miami. And also, you see there, he's got a new side hustle over at Barry's. That and much more on the other side of the break. Welcome back to Yahoo Finance Live. San Francisco lost more residents than any other city last year. That's at least according to new numbers out from CBRE. The rate of exits doubled during the pandemic, with the big beneficiary being the state of Florida. The share of residents there moving to the Sunshine State rose by more than 45%, with some big name tech investors making the move to Miami, including our next guest. Keith Rabois is general partner of the Founders Fund. And Keith, it's good to talk to you. I know the Miami mayor likes to talk about you a lot as sort of leading the charge as this ambassador of Miami. To what extent have those moves actually led to additional investments being made? To what extent have the VC funds taken hold in the city?
Well, lots of VCs, angel investors, seed fund investors, professional venture capitalists have moved here. That isn't surprising. The key is when entrepreneurs and new companies are formed here at scale, and that started in the last quarter. Obviously, you can't build an ecosystem overnight. Nobody has. Silicon Valley took somewhere between 30 to 50 years, depending on how you count, to build. So I'm not trying to recreate Silicon Valley in one day, 1 week, 1 month, but in 3 to 5 years, we're going to have very successful companies here at massive scale.
Yeah, it feels like there's been so many comparisons made between these two cities, when in reality, there's so many different elements that led to the success of the Valley. What do you see in the city of Miami itself that you think could differ from what has taken hold over in California?
Well, California is just a mismanaged state. The Bay Area is a mismanaged local environment. And so Florida isn't. It's a well-run state with well-run policies, a regulatory framework that allows for innovation, a tax policy that allows for success. And those things are exciting. But more importantly, there's a culture of, there's a lack of an entitlement culture, which is important. There's a cosmopolitan mix of people from a diverse set of backgrounds, from Europe, from Latin America, from New York, if you include that. There's now refugees from California, left and right. So I think the cosmopolitan mix allows, across multiple industries as well, entertainment, real estate, financial services, and now technology, allows for these new custom cocktails to be brewed that turn into interesting and arresting companies that create value propositions for consumers and enterprises all across the world.
Yeah, and Keith, I mean, when we talk about, Francis Suarez has been on the show multiple times. He's done a lot of things here. I'm not sure which one in your mind has been most impactful in trying to steal more Californians away, or even those from New York. But clearly, crypto has been a big push for him, and obviously it's caught on here in 2021. But in your mind, I mean, how much more can be done on his part, or what would you say is the most successful piece that he's implemented so far in trying to boost Miami's standing?
Well, I think just highlighting the degree of receptivity. Florida and Miami want high-paying jobs. They want to be part of the future. The 21st century is not going to be about legacy jobs. It's about entrepreneurs creating value through the use of technology, through the use of design, and through the use of data. And we want to embrace that here. We want the people who have the most talent on the planet to move here and create the future here. And his ability to communicate that this is the future and that this city, this state, welcomes the future, as opposed to is trying to retard the future like Europe and San Francisco, has been very exciting and refreshing, actually, to entrepreneurs, to investors. And that's why you see this magnet of talent just shifting across the globe to actually Miami.
Speaking of Keith, speaking of crypto, I'd love to just have you weigh in on the listing that we saw from Coinbase, because there seems to be a lot of enthusiasm around the growth that we're seeing. If I remember correctly, you were a little more skeptical on Bitcoin early on. What do you make of the huge valuation it's come to market at? And what does that say about where things stand right now for the appetite for these startups to come to the market?
Well, I've been a fan, long-time advocate of companies going public as early as possible in their trajectory. I've written chapters and books on the topic. So it's exciting to see the public markets appreciating the value created by Silicon Valley entrepreneurs over the last decade. And I think more entrepreneurs will avail themselves of public capital sooner rather than later over the next 3 to 4 or 5 years, which I'm extremely excited about. With respect to Coinbase, I'm also extremely excited about. Coinbase has had a different type of leadership that's really resonated with the public markets, which is we're not going to have all of these artificial sort of pseudo-woke policies where we basically refuse to focus on the company's mission. One of the other disadvantages of the Bay Area, other than government mismanagement, has been this monoculture where it's basically a path of least resistance, where any employees offended by X, company Y, X, Y, or Z won't engage in a particular topic. And that makes no sense whatsoever. So Coinbase was very clear that if you don't agree with the company's policies, you can leave. And turns out those employees are not that valuable, not that important, and the company is very successful. I think more CEOs will emulate the policies of Coinbase, which is we have a mission. The only things you're allowed to do at work have to contribute to that mission. If you detract us from our mission, you're going to be shown the exit door. And so I think that's a very healthy policy for more corporations to embrace. I think CEOs initially were ecstatic that Brian took such a great leadership position, and now they're going to emulate it at scale, which it'd be a wonderful course correction for Silicon Valley.
Keith, we have to ask you about your new side hustle, which is as an instructor at Barry's. How'd you get involved, and what other tech names are you bringing on board?
Yeah, so I'm an addicted user. For the last 5 years, I've probably taken almost 2,400 classes. So part of this is just a reflection of my own personal interest. I find berries to be the most efficient workout that one can do if one cares about their body, about their health, about the future of their life. And so it's the only hour of the day where I don't have my phone with me. It's enjoyable. Most of my friends participate. I've learned to appreciate music. The hour flies by. So the combination has been incredibly productive in my own life, and I wanted to share that back with other people. I like to challenge myself in different ways. I challenge myself playing basketball, for example, against very good basketball players. I wanted to challenge myself against the best trainers on the planet and learn to teach a berries class. I originally started this a few years ago for my friend's 30th birthday. I learned how to do one. This is the first time I've done one in 2 years, and fortunately it went well. The mayor at least enjoyed himself.
I think that's important to put on the resume. If Francis Suarez is enjoying your Barry's bootcamp course, then that is more, I think, than a lot of what people can say. But impressive when you put it all together and add that to the resume. That was already impressive enough. Founders Fund General Partner Keith Boy, appreciate you coming on here to chat with us today. Be well and hope to chat again soon. We're going to take another quick break here on the show. But again, a focus this week on taxes, not just being a big factor in relocations, people going from New York to Florida, but also for inheritances and estate planning. We'll chat that with an expert on the other side of the break. Stay with us. Welcome back. In this week's Tax Time, a reminder of a famous quote from Benjamin Franklin. Of course, he pointed out there are only two certainties in life. That would be death and taxes. And in this week's Tax Time, we are talking both, ladies and gents. We're talking inheritances and estate taxes. I want to bring on an expert to walk through the best way to plan around these things. Not always great to think about, but important to think about nonetheless. And for more on that, let's bring on Rutgers School of Business professor and Rutgers Masters in Taxation Program Director, Jay Soled, joins us right now. And Professor, it's interesting because this is something that I don't think people plan for enough, right? Nobody really wants to think about the end of times, but important to really be smart about that. And what has changed I guess, the most over the last couple of years as we talk about tax changes that people out there should know?
Well, one important difference from what it might have been years ago is that right now the federal estate tax exemption is historically at its highest zenith. It's at $11.7 million. So in yesteryear, a lot of people had major tax considerations, transfer tax considerations, but between the federal government, which has vastly increased the exemption amount, and most states have repealed their estate tax. Now there's only approximately 12 states that have an estate tax. Taxes have truly taken a secondary role in most people's estate planning.
And Jay, you talk about that 11.7 million, but there is a proposal on the table. President Biden has talked about reducing it in a significant way, down to, I believe, more than 3 million. So, I mean, when you look at that number, how significantly is that likely to shift? Granted, it's going to be more people into the fold.
Well, the actual proposal is by Bernie Sanders, and it's not to reduce it to 3 million, it's 3.5 million. And that may happen. If it does, it will increase the number of people potentially with estate tax exposure. But keep in mind that between spouses, the exemption amount is portable. So that does allow married couples up to $7 million that they can transfer tax-free. That's likely to mean that still 99% of all taxpayers in the United States will have no estate tax exposure, even if the Bernie Sanders proposal were passed.
What's interesting is, every time we talk about taxes, the topic is brought up that rich people always find a workaround when it comes to skirting taxes, and it's tough to find a workaround after you're dead. But before you're dead, I guess we keep hearing about gifts and the way that some people are working around those. So what is maybe the loophole to watch for there?
Well, what you can anticipate if the estate tax exemption were to be lowered, we are going to see a vast amount of wealth transferred by year's end before the new legislation may take effect January 1st, 2022. So you can anticipate a lot of people trying to make multi-million-dollar gifts to get past the finish line so they can give 23.4 million before the exemption is reduced. So that would be one easy go around that I would anticipate taxpayers seeking to avail themselves of.
It's also kind of surprising that we haven't seen this targeted earlier, right? I mean, you think about just the general conversations we're having right now about tax the rich. Why do you think that it's taken so long for maybe, I know it's still from Bernie Sanders here, a more progressive Democrat, but why do you think it's taken so long to maybe target this type of wealth, given that it, happens after someone's gone?
Well, there's two reasons. First of all, I think the Biden administration is focusing first and foremost on corporate tax reform. They don't want to bite off more than they can chew in this legislation or legislative proposal. So they're taking it one step at a time. And keep in mind that for the last 2 or 3 decades, the Republicans have called this the death tax. And that moniker has dissuaded many politicians from embracing it because it sounds kind of Machiavellian. So there's this spin to it that leaves a lot of politicians with a distaste. So its popularity in the last 20, 30 years has waned, even though it affects so few people in the country.
All right, well, I appreciate you bringing us the latest on that front, because a lot of people, as I said, don't talk about it. Always important to highlight on tax time. Professor Jay Soled, Rutgers School of Business professor, thanks again for taking the time today. Be well. I want to shift over, though, as we've been talking about death and taxes. Let's shift to a rosier topic here, at least one that a lot of our viewers will appreciate, and getting technical on the trading action we've seen play out. And for more on that, I want to bring on Yahoo Finance's chart master, Jared Blickery, who has a special guest in this week's segment. Jared?
Yeah, I'm really excited to bring in Jay Woods, who is Chief Investment Strategist at Drive Wealth. And Jay, I know you just began at this firm here, but I got to ask you, first of all, what's it like down at the New York Stock Exchange going back there? And we'll get into some tickers in a second.
Well, it's great being back home at the New York Stock Exchange. We're still going through our COVID protocol, so it's not as lively as we'd like. We miss you and your team and Inez down here at the NYSE. But all signs are pointed to reopen sometime soon. When we get the go-ahead, we can't wait. It's been great, and the markets have been fantastic. So what's not good to be back at the New York Stock Exchange?
Exactly. I can't wait to go back myself. I want to talk about the financials. We got big bank earnings this week. XLF pushing a record highs recently, as are most of the other sectors. What are you seeing in the sector action? And just throw out whatever you want to here, and I'll bring up some tickers.
Yeah, sure. I mean, it's good that we got that Easter slowdown and we had the lowest volume week of the year last week. And then we knew the financials were reporting this week, and they kicked us off to a great start. If you look at the XLF, you go back in time, right before COVID, it looked like we were going to break out of a 10-year base here. And we paused, we tried, we failed. This quarter, we broke through, and we broke through with a vengeance, and it continues today. So it's always nice to see the financials lead. And then you mentioned, the other sectors. 10 out of 11 sectors in the S&P Spider Select Sector Index are making new highs this week. So when you say all tides lift, the tide lifts all boats, we're seeing that right now. The only lagger is energy, which was leading us basically the first quarter of this year. So as a bull, I don't want to see energy lead. This is fantastic that the financials are leading. Tech is coming back. We're losing that rotation trade narrative as everything is kind of running ahead at the same time, but it's exciting.
Yeah, and let me just ask you, because this is options expiration Friday, we do see some activity in individual names. Doesn't necessarily affect the indices as a whole, but there might be some seasonality aspects with respect to this particular week, but also heading into May, because we're just coming off the best 6-month period of the year, and heading into the worst 6 months. There's that saying, sell in May and go away. So what are you making of the timing of everything right now?
Yeah, well, let's talk options expiration first. Yes, it's options expiration Friday, so you'll see some volume swell towards the end of the day, which is good, and it keeps us busy down here. But we've seen the last 2 months where we've peaked kind of mid-month around options expiration, and then digested the gains we had early on of that month. So hopefully this doesn't mean we pause with the expiration, but given what we've done so far in April, it wouldn't shock me. And then you talked about seasonality. Sell in May and go away was an expression I actually joked about last year, like, where are we going to go? Well, this year, people are ready to go away. I can't wait. I'm 1 day away from my first shot, and May seems to be the time where people will actually maybe take advantage of some of these gains, and we could see a pause in this market. It sounds too obvious, but right now, seeing where we've gone and how strong this rally has been, a pause would be fine. And you throw in the seasonality factor, where April is the second strongest month over the last 20 years. Now we're coming into that slowdown. We didn't see it last summer, which was great, but this summer, rationale would dictate that we're going to go away. What's that?
We got about 30 seconds left here. How does anybody hedge this experience if they're going to go away? Anything in the stock portfolio? What do you do?
Well, you always want a diversified portfolio. That's the smartest thing. Right now, with gains across the board, you may want to lighten up if that's your prerogative. But over the long term, these trends are phenomenal. I like to look at things from the long-term perspective, and put my day trading hat aside, even though I do that for a living. I think we're on a good trajectory, but we could see a small pullback over the near term, given the run-up that we've had.
All right, Jay Woods, we're going to leave it there. Thank you very much for joining us. And I'm going to send it back to you, Akiko.
Thanks so much for that, Jared, and our thanks to Jay as well. Coming up, we are talking about the numbers behind Kim Kardashian West's divorce from Kanye West. Yes, there is a business discussion to be had here. Ali Kanal is going to be walking us through the numbers, what all of this means for Kardashian's booming business. Well, Kim Kardashian West has had a record-breaking year. The reality star officially inducted into Forbes' coveted Billionaires Club last week, but her impending divorce from rapper Kanye West could have implications for her booming business. And Ali Canal is on top of it all to walk us through the numbers. Ali, this is not something that we have talked about or I've actually thought about, but she does have her name across a lot of these brands. So even from that standpoint, how significant are the implications?
You're right. Let's talk about KKW Beauty, which is her cosmetics company. She owns 72% of that company. She sold a 20% stake last year to Coty, and it's very heavily branded with KKW. In 2014, when she married Kanye, she legally changed her name to hyphenate it to Kardashian West. And then that moniker, KKW, really took on a life of its own. Not only do we have KKW Beauty, she also has a perfume line, KKW Fragrance. And a lot of her fans have really associated Kim Kardashian with KKW. So I was curious to think about, well, what happens if she ultimately decides to just go back to Kim Kardashian and drop the West name altogether? Will that impact her brand? So I did go ahead and speak to a brand expert, and he said it's very important for Kardashian to slow it down a little bit and make sure that this is a business decision and not an emotional one, especially since KKW Beauty is sold both online and in stores. That creates a lot of logistical challenges. If she were to go ahead and do a complete brand overhaul, that would impact printing, shipping, in addition to SEO, URLs, the website, and that could all take a lot of time and a lot of money. So we said what a good middle ground could be if she ultimately decides to change her name is just to repurpose the meaning of the W. So instead of it meaning Kim Kardashian West, perhaps the W could stand for worldwide, Kim Kardashian Worldwide. And that could be a way where you could still maintain the brand identity, but also change the ultimate meaning. And we've seen corporations do this before. For example, in 2013, AARP rebranded from American Association of Retired Persons to an Alley for Real Possibilities. So this is certainly something that has happened before. But in the case for Kardashian, it's not a question of whether she can go and create waves and make this change known. She has 214 million followers on Instagram, and I personally believe that her fans are going to follow whichever way she chooses. It's more so the logistical challenges moving forward. So we'll see what happens. There are e-news sources that say she's not sure yet. If she does keep it, it's going to be for her kids. The divorce seems to be going well so far. There is not a lot of mudslinging, which is always good since both of these names are huge, Kanye and Kim. But again, we'll just have to wait and see. I think she should just keep it, cut her losses, and keep it simple.
Yeah, nothing personal here. As we know, the Kardashians are adept at making business decisions. That's what this one might be. We'll chalk it up as a business decision. But Ali Canal, appreciate you bringing us the latest there on KKW. We're going to take one more quick break here on the show, but when we return, breaking down a couple specials we have coming your way next week. Not just a focus on planet Earth and climate, but also on cannabis. We'll break down those and what you need to know on the other side. Stay with us. Well, welcome back to Yahoo Finance Live. We've got a couple big specials coming your way next week that we want to spotlight and give you a heads up on. Akiko is going to be diving deeper into the issue of climate change ahead of an important focus at the White House on that. And I'm going to be focusing in on cannabis since we got 420 coming up. No need to explain that one further. But Akiko, why don't you dig into what we have coming here with your climate focus?
Yeah, it's certainly the 11 to 1 p.m. Eastern hour. We've got climate and cannabis converging, but it's certainly going to be a big week for the climate discussion here in the U.S., but really globally. You've got Earth Day coming up, but also that 2-day climate summit that the White House is hosting. They've invited 40 world leaders to really hone in on the issue of what can be done to get to that broader Paris Agreement goal of getting to net zero by 2050. And we've got a very long list of some experts lined up, really diving into the discussion all week. We're going to kick things off on Monday, a conversation with Robert Downey Jr., who many may not know, has really taken an active role on this issue, establishing what is the Footprint Coalition. He's been working closely with lawmakers as well as private sector to really push forward on trying to reduce the carbon emissions. We've also got 2 senators from that Climate Coalition or Climate Caucus over in the Senate with Susan Collins as well as Jeanne Shaheen, and many more guests to come throughout the week, Zach.
Well, how do I follow that? And the warning that the Earth is on fire with a joint being on fire, because we're going to be talking on 420. The Business of Cannabis Special makes its return here with the discussion about not just New Jersey, New York, New Mexico, and Virginia expediting legalization in those states, but also a national level discussion. And of course, the impact on all the businesses focused in on that. We're going to have a discussion with TrueLeaf CEO Kim Rivers, as well as Curaleaf Chairman Boris Jordan going to be joining us. And of course, the CEO of Canopy Growth, the largest one out there in Canada, talking about U.S. expansion plans. It's going to be a very interesting chat, as well as analysts joining in with some interesting price targets for more on how investors can play the increasingly looked at legalization here at a national level. Exciting next week. That'll do it for Akiko and myself here in our hours today. We got much more coverage coming your way in regards to today's trading session as we sit at all-time highs, so stay tuned. We're back in 2.
Hi, everybody, and welcome to Yahoo Finance Live. I'm Alexis Christophorus, along with my co-host Kristen Myers, and here's what's happening at this hour. Half of all U.S. states saw an increase in coronavirus cases this week, and experts are urging people to maintain safety precautions and get vaccinated to avoid another spiral. This, as Pfizer's CEO says, a third COVID-19 dose will likely be needed within 12 months. And it could be a big payday for Roaring Kitty, the Reddit trading crowd's favorite and the man who inspired the epic GameStop short squeeze. He stands to rake in millions from his GameStop options bet today. We have the latest for you. And it looks like that March hiring surge spanned the country. According to the Labor Department, hiring increased in every state except Alaska, with large states such as California, Texas, and New York adding the most jobs. Upbeat economic data like that, plus a strong start to earnings season, helping the Dow and S&P push up to fresh record highs. And if you're keeping count, Kristen, this would be the S&P's 23rd record close of the year. But we see that the tech stocks are falling behind a little bit.
Absolutely, Alexis. So let's keep on looking at the markets. As you mentioned, the Nasdaq right now is under pressure, down 0.04% right now. Of course, as you mentioned, those record highs in the S&P 500 up about 0.2 percentage point. The Dow not too shabby either, up about 80 points right now. Let's look on a sector basis. As you mentioned, with tech under pressure, not a big surprise here. It is one of the laggards, down about 0.1 percentage point, only being bested, if we can even call it that, when it comes to a laggard, by the energy sector, down about 0.75 percentage point. On the flip side right now, however, utilities and materials are leading, both up over 0.8 percentage point right now. So I want to take a look at some stocks that we see. We've got Pfizer up right now, up just about 2.5%. We are seeing that stock in the green after Pfizer CEO said that we'll all, as you mentioned, will likely need a booster shot, so a third shot of the vaccine. Want to take a look over at Morgan Stanley. It's the last of the big banks to have reported earnings. It did top expectations. That stock, however, in the red, down over 3% right now. But I want to look right now, Alexis, at cryptocurrency. We will be talking it in the show. And I want to draw everyone's attention here to what's up first on that list, and that is Dogecoin, up almost 158% right now. Absolutely crazy moves that we are seeing in Dogecoin. Bitcoin in the red right now, down 1.75 percentage point. That, of course, is after the news that Turkey is going to be banning that currency for payments, Alexis.
Yeah, we're going to be talking about whether or not that crypto bubble is about to burst. All right, we've got more strong economic data out this morning, just pointing to a recovery that continues to gain steam. We've got Yahoo Finance's Emily McCormick here now to break down some of the big headlines of the day. And housing starts caught my eye, Emily, rising to a 15-year high. There seems to be no stopping the housing market right now.
That's right, Alexis. Really strong data out this morning, especially on the housing market, really coming in tandem with yesterday's stronger than expected retail sales, as well as jobless claims report. So again, all signs pointing to this economic recovery. But to your point on housing starts, the Commerce Department saying this morning that starts were up 19.4% in March. That was the biggest month-over-month rise that we've seen since July, and it brought starts up to an annualized rate of more than 1.7 million. That was the highest level since 2006. Now, this also more than reversed the 11.3% drop that we saw in housing starts in February, which economists had mostly said was due to inclement weather. And I also want to highlight that for March, we saw single-family home building, and especially single-family home building in the South, be the main drivers of that boost in housing starts. I also saw building permits increase by greater than expected at 2.7% month over month in March. Permits point to future home building, so also a good sign to see those rising, considering the tight inventory levels we've been seeing across the housing market, across the country, rather, for the past several months. And then finally, also want to highlight a different report that we got out this morning, and that was from the University of Michigan. Their surveys of consumers and their headline consumer sentiment index actually climbing to a one-year high in April in that preliminary monthly report. And really what was the main drivers behind that were these faster than expected vaccinations, those stimulus checks, as well as easing social distancing restrictions, all helping to provide a boost. So again, Alexis, some really strong economic data out this morning, and many are saying even stronger data is to come in the coming months.
And speaking of stronger data, we're hearing about our earnings season now. These reports are coming in; they're looking really good. We heard from more banks today, including Morgan Stanley, and I know that they had a record-setting quarter, but again, they had those massive losses from that Archegos hedge fund, and I guess that's what got investors down about Morgan Stanley today.
That's right, Alexis, because again, as you mentioned, we did see record results on the top and bottom line for Morgan Stanley. Some similar trends that we saw from the other banks like JP Morgan Chase, as well as Goldman Sachs, where trading revenue on both the stock and bond side really helped boost results there. I want to highlight that fixed income trading revenue was up 44% to nearly $3 billion, and equities trading revenue up 17% to about $2.9 billion for Morgan Stanley. So again, some really strong results there. We also saw the firm's wealth management business bringing in record flows of $105 billion. But again, seeing that stock falling in intraday trading because of that hit from the Archegos Capital implosion. That included a $911 million loss for Morgan Stanley during the quarter, again, directly tied to that firm. We've heard other banks like Credit Suisse as well as Nomura cite Archegos as a source of negative impacts to these results. But again, overall, some really strong estimates topping results here for Morgan Stanley. So potentially just a momentary decline we're seeing as Wall Street digests that impact.
All right, thanks so much for the roundup there, Emily. Let's stay with the markets now and bring in Tom Essay, founder and president of Sevens Report Research. Hey, Tom, good to see you again. So talk to me about earnings season. What do you like so far? Any big surprises for you to the upside or the downside so far?
Hi, Alexis. Thank you very much for having me back on. I think that it's been a very strong start to earnings season, right? I mean, we really haven't had any blowups yet. The numbers have been very solid. I'm surprised that to a point that the banks aren't being met with a bit more enthusiasm. Some of the numbers are very high. There are some issues with reserve releases, but as I look at the banks, I think they're set up really for a couple great quarters if the economy recovers. So I'm a bit surprised they're not being bought more on these earnings, but overall, it's a great start.
So Tom, speaking about that, as you mentioned, financials not doing, as well. It had been in the red just yesterday. We'd seen a nice pop in tech. Tech right now, of course, is in the red, down about 1/10 of a percentage point. Given that you think that financials, there should be more enthusiasm, especially around some of those bank stocks. Where do you sit on this growth versus value debate? How should investors really be looking at these different sectors in their portfolios?
So I'm on team value here as far as a full year outperformance. I think that if what everybody is saying and what the market is saying, that we're going to have a big economic recovery, that we're going to have rising inflation, that we're going to have an improved labor market, then value, small caps, and cyclicals should continue to outperform. Now, I fully acknowledge over the past 3 weeks, we've actually seen growth and tech outperform, but I think that's more due to the past 6 months of value and cyclicals just massively outperforming. And now we're seeing a little bit of a reversion to the mean. But for a full year basis, I still think value is the place to be.
Tom, I'd love your take on what we're seeing happening in the bond market right now with the 10-year Treasury yield, because remember, it was rising at such a speed. It got a lot of stock investors nervous. A lot of folks were unloading those large tech stocks as we saw the yields starting to rise. But now they're falling back a little bit. I know the 10-year Treasury yield is down from 1.64% that we saw last week. Why do you think that is? I mean, are investors now finally buying into what the Fed has been saying all along, that they're not going to be bumping up interest rates anytime soon to rein in inflation?
I think that's part of it. I think a lot of us have been surprised by sort of how dismissive to a point the Fed has been about incredible data. I mean, in normal times, the numbers we saw yesterday on Thursday from Philly Fed, Empire, and retail sales, they'd have sent the 10-year yield up 10 basis points. Instead, it went down 10 basis points. Now, part of that had to do with short covering from people who were short treasuries. But the bottom line is the Fed is giving a drumbeat that regardless of how strong the economy is, it seems they are not going to talk about tapering QE anytime soon. Now, that works great right now, but down the line, if the data continues to get better, then the Fed is going to, frankly, face a credibility issue. I mean, if we're talking about 9-10% GDP, and the Fed is saying we're still going to buy 120 billion of bonds every month, people are going to start looking around and saying, what's going on here? So I think for now, the Fed's message is being delivered. But as I look out a month, 2 months, 3 months down the line, it could cause some volatility.
Do you think that these falling yields call into question aspects of the reflation trade? Should people start rethinking that reflation trade?
No, I don't think so. I think that this is part of a market that, frankly, is awash in liquidity. And this market tends to be, it's like we're on a boat, right? And we just have one crowd running from one side and running to the other. In March, everybody was running out of bonds, out of treasuries, and yields. Yields went from 120 to 170 in a couple of weeks. I mean, that's not a sustainable move higher. Just like yields falling 10 basis points on the day when we had blowout economic data. I mean, that's not going to be sustainable either. So I think part of this volatility is just a function of all the liquidity that the government and the Fed has put into the market. And we're just sort of like a herd running from one end to the other. And I think we just have to get used to that. Longer trend, though, the reflation trade is still good. COVID, thankfully, is going away and hopefully will be really gone to all intents and purposes in the next couple of months. And I think the reflation trade will re-engage in a big way.
All right, Tom Essay of the Sevens Report Research. Thanks so much. Have a good weekend. Coming up, the latest on the COVID-19 vaccine and why Pfizer and Moderna are not working with J&J to investigate those rare cases of blood clotting.
Welcome back. It's likely that people will need a coronavirus vaccine booster. At least that's according to Pfizer CEO. So let's chat more about that. We're joined now by Kristen Choi, assistant professor at UCLA's School of Nursing. So Kristen, we're hearing from Pfizer CEO that folks will need a third shot. As we know, Moderna and Pfizer need 2 shots in order to be fully vaccinated. We'll need to get a vaccine booster. I'm curious to know how long you think folks are going to need this booster regimen. Is this something that folks are going to have to do every single year like the flu shot, or might this be something that might be short term until we can get boosters every 5 or 10 years perhaps?
Sure. Well, first, thank you so much for having me on this afternoon. The booster shots and how frequently they will be needed is really still something that's a major question. We don't know for sure what's going to happen with coronavirus variants. We have seen a couple of big dominant variant strains emerge, but it's difficult to predict at this point whether those strains will take hold in the population or whether with our current vaccination process, we'll be able to sort of tamp them down. At this time, both Pfizer and Moderna are testing boosters of the vaccine. At this point, also, though, we know that the original 2-dose regimen has seemed to be fairly effective against some of the dominant strains we're seeing, which is really good news. At this point, we sort of need to wait for the research to bear out whether or not these vaccines will be effective and if they're needed. And at the moment, our priority still is just getting those first and second doses to people that haven't gotten them yet.
What do you make of these breakthrough numbers that we're getting now, Kristen, about people who've been fully vaccinated and still getting COVID? I know the numbers are small, but it is happening. Is that to be expected?
Yes, we know that the vaccines, even though they are very effective, in the case of Pfizer and Moderna, 90 to 95%, they're not perfectly effective. And we do still have some cases of people who contract the coronavirus even after being vaccinated. These cases are very rare. And the good news about our vaccines, all three of them, including Johnson & Johnson, which is now paused, is that they are very effective at preventing severe COVID. So even if you contract COVID after getting vaccinated, which no one wants, it's rare, but it can happen. You're very unlikely to be in a situation where you would need to be hospitalized or you are at risk of dying. But for most people, these breakthrough cases are something that most people can expect not to happen to them. The vaccines are very, very effective for the most part.
Kristen, I'm curious to know how concerned we should be going forward in terms of vaccine hesitancy about these blood clots. Johnson & Johnson, that vaccine was paused, and right now the demand is still exceeding the supply. Are you at least hearing from patients at all a lot more concerns about the vaccine? And do you think that might play out perhaps a little bit later on in the year as folks start refusing to take it?
Yes, I am concerned about vaccine hesitancy in the US. Right now, we are still in a place where sort of demand exceeds supply. And there are more people that want the vaccine still that need to get it, which is great news. But I think we're pretty close to seeing a place where that supply-demand relationship is going to shift. And we're going to be in the position of getting vaccines out to some key groups that haven't gotten it yet. And there are a couple of groups that I'm especially concerned about when it comes to getting the vaccine. One is kids and teens. We know that Pfizer and Moderna are both testing their vaccines for much younger kids. We've seen some really promising data from Pfizer about the vaccine in adolescents. But kids are going to be a very important group for us to vaccinate to get to herd immunity. And we know that with vaccines being new, it's going to be really important to reach parents and help them understand that the vaccines are safe and effective for their children. Another group, interestingly, is men. There have been some interesting data points coming out showing that men are less likely to get the vaccine than women. We also know, unfortunately, that men are more at risk for severe COVID than women. So it's going to be very important for us to think about outreach to some of these groups that might not want to get the vaccine. In terms of the Johnson & Johnson, that concerns me as well. I think that the pause to review these cases of these very rare blood clots was probably the right thing to do. But at the same time, we want to make sure that people know that the risk of the blood clots is so rare and our risk for COVID is so much higher that it's likely that Johnson & Johnson will still be a vaccine that's worth taking for a lot of people out there.
Kristen, we heard that you are in the trial for that booster vaccine. Of course, you wouldn't know if you received the third shot or if it might be nothing but more than saline. But curious to know how you're feeling, if you've received the third shot as yet, or if you have any insights from being a participant of that trial you could share.
Yeah, I do. So I talked with your audience before about being a part of the Pfizer study last summer. I was in the phase 3 clinical trial and was fortunate to receive the active vaccine. A couple of weeks ago, I had the opportunity through that same study to get a third dose booster as part of a small study of safety and tolerability of a booster shot. I got that booster dose a couple of weeks ago here, and so far I'm feeling fine. I had some mild symptoms after the vaccine, similar to what people see in the first or second dose. But I feel really fortunate to be a part of this study and hopefully help learn whether this vaccine will work for a lot of people and whether it works against some of the variants that we're seeing. But I feel good so far.
That is great news. And thank you for being part of that trial. It's so important that they have people to be able to be willing to be tested for things like this. So thank you. There's been some confusion, I guess I'll say, about people who've been fully vaccinated and whether or not they should be getting tests for COVID because, you can be asymptomatic and still get it. We're seeing that there are these breakthrough cases. So how important is it that folks who have been fully vaccinated do get COVID tests, especially if they're going to be around younger people who have not yet been vaccinated?
Sure. I think that COVID testing is still something that is a very important tool for public health that we all need to be participating in. Again, at this point, we are still not at that level of herd immunity, and we know that there is still a fair amount of coronavirus circulating in our community. Once we get to the point of herd immunity, I think that's where we'll be able to really see reduction of some of these measures like testing and masking that we currently still follow. But until we get there and we still have a little ways to go, it is important that people continue to wear masks, social distance, and get tested. And certainly for folks who are interacting with groups who are around people that may not have been vaccinated, getting those tests is really important. Testing has become more and more accessible. It's fairly easy to get a test in most states now. And so certainly would encourage folks to continue to be tested regularly, especially if they're going to be around people that are not vaccinated.
All right, Kristen Choi, assistant professor at UCLA's School of Nursing. Thanks so much for joining us today. And coming up, GameStop bull Roaring Kitty is set to rake in millions from his options bet. We've got those details next.
Welcome back. The infamous trader Keith Gill, also known as Roaring Kitty to the Reddit crowd, inspired the epic GameStop short squeeze. Well, today, his options bets on the stock expire, and he stands to rake in millions. Jared Blickery is here now with all those details. Looks like Roaring Kitty's bets may have paid off big time.
Yeah, in a big way. This was an options purchase. I believe it was 500 contracts for about $10,000, which could expire today worth millions, specifically $7 million. Now, let's go to the Wi-Fi Interactive and explain exactly how this works. So this is a year-to-date chart, by the way, of GameStop. And yes, we all remember what happened in that big spike that we see right here. But in January, when the price of GameStop was in the single digits or thereabouts, he bought some options betting that the price would close in a few months above $12 per share. And now, a few months later, it's at $154 a share. And when the market closes today and trades a little bit afterwards, whatever the final price is today, he will get the difference between that. And the people who wrote those options will have to pony up. So they'll be in the red for quite a bit of money. But most of those guys have hedged by actually buying the shares. And that's what was happening when we saw this spike that I was just highlighting there. The option sellers, in order to hedge their risk, will buy the underlying stock. And that's part of the reason why it fueled these incredible gains. Now, we know that options buying was it came to be a very intense strategy and popular strategy for a lot of new retail traders because of what happened in the early part of the year. But in the subsequent months, when we had these weekly bouts where the stock prices were closing lower instead of higher, a lot of those traders got burned. In fact, they would have lost the entire premium on their money if their bets were not in the green at that time. So long story short, we're talking about Roaring Kitty, he still has a huge position, which should be up more than $10-12 million, something in that ballpark by our calculations, just based on what he's shown on his screens recently. So sitting on a position, maybe profits of around $20 million or so, that's not bad for this entire phenomenon.
A phenomenon indeed. It's just been incredible to watch. You know, another phenomenon that's been incredible to watch is what's happening with cryptocurrency, right? I mean, you remember Doge started out as a meme, as a joke. It's up 400% this week. It's got a $40 billion market cap. And I know that there was a survey done by Bank of America of fund managers asking if they think crypto is in a bubble. I don't think you need to be a fund manager to answer that, but 74% of them think we are. Tell us the latest.
Yeah, well, I'm looking at Dogecoin right now in the Wi-Fi Interactive. We can see it's up 500% plus over the trailing month. Most of that has been in the last week and up 500% in that time frame. Now, Elon Musk has pumped this at various times, but as you said, it was intended to be a joke. It was never intended to be a serious investment vehicle. Nevertheless, here it is. As Brian Shannon, a friend of the program, is fond of saying, only price pays. And if you bought it low and you sell it high, well, the money is yours. But the kahuna here in cryptocurrency is, of course, Bitcoin. We were able to break above 60,000 over the last week. We hit about 65,000. We're coming down a little bit. But I want to show this longer term chart, because with all the interest in crypto this week, especially with the Coinbase listing, we do have this consolidation pattern that we were tracking. And this was a breakout. So we got the breakout this week. And it's normal to come back down a little bit and kind of test the waters in this area, see if there's interest. But we want this now to lift off if it's going to continue. We start trading down here, the chances increase that we will have a more protracted sell-off. So I think it's going to be a critical weekend for Bitcoin. A lot of times when we see these big breakouts occur just before the weekend, we either get continuation or a big rejection over the weekend, because as we know, Bitcoin never sleeps.
No, it does not. All right. Thanks a lot, Jared. We'll see you a little later on. Stay with us. Much more Yahoo Finance Live to come right after this. Welcome back. Throughout the pandemic, a number of large companies have risen to the occasion, holding true to the mantra, never let a good crisis go to waste. The RepTrak company is out with its 2021 reputation ranking of the top 100 global companies. And joining us now is Kylie Wright-Ford, CEO of the RepTrak company. So Kylie, before we get to the top 10, and there may be some surprises in there for some folks, tell us what were the primary drivers of the company's reputation in the eyes of the public.
Thank you for having me today. So I'm Kylie. Thank you for acknowledging the study that we have just released for the 11th year in a row around reputation. And what we do is we look at the universe of companies that are doing very well across many countries. And what we found is actually that citizenship and governance are the key drivers of improvements in reputation this year. It was harder than ever to get in the top 100 as reputation soared, as trust and positive feeling about companies improved.
So Kylie, I'm looking at the list right now. I'm seeing that the Lego Group is in that top spot, number 1. What did the Lego Group do to clinch that position?
They certainly are, and they're no stranger to being in the top 100, let alone the top 10. Lego does a really nice job on all 7 drivers of reputation. Let me back up for a moment and define reputation in our parlance. And it's been our life's work to define and quantify reputation. So we have a score from 0 to 100, and we rate companies. There are 7 drivers. They include factors like citizenship and governance that I just mentioned. Those 2 are really important this year, and Lego does a nice job on those. Products and services is, of course, a driver of reputation, but it's often less than 20% in most industries. So the other 80% of your reputation, which is how much people trust, admire, and respect you as a company, is driven by these other factors. They include leadership and innovation also. So Lego does a nice job on all of them. It also does a really nice job of being able to perform well across more than 15 geographies that we measure. That is unusual. Many companies have a weak spot in terms of a geography or a driver which drags them down, whereas Lego does a nice job across all. It's an all-star when it comes to reputation.
So we saw that graphic just a moment ago showing some of the top companies when it comes to reputation. Rolex was number 2, Ferrari 3, Bosch, Harley Davidson. You've also got Disney and Microsoft on that list. But I want to talk about companies that perhaps fell a few notches during the pandemic in the eyes of the public. Can you tell us, were there any companies that were in the top 10 in prior years and were kicked out this past year?
Sure. And before I do, I will say that it was harder than ever to actually get into the top 10. So there's that. We have seen a major rise since 2015 in the difficulty of getting into the top scores. But the companies that did fall back in ratings still rated very highly. One I will point out is Barilla, Italian company, and they do a really nice job. And they just fell outside and came in at number 11, I believe. But that means they still rose in reputation. And one of the things they did really well is they're really good at telling their story in a relevant way, and especially with their media. So they talk a lot about diversity and inclusion. They talk a lot about what they do well for their communities, as well as their products and services. The mistake many companies make is to focus on financial performance or products and services in too much volume, instead of focusing on the things that matter to the public. And the public here was a big stakeholder. They also do really nicely on ESG. And the public in this study gave a resounding message of, while we're making progress on ESG, we still have a lot of work to do.
Kylie, are there generational differences in terms of perhaps how important corporate reputation might be, or perhaps even the criteria that make up that reputable company?
There is certainly a difference. There's difference across industry, geography, time, and generation. And one of the things that we tell the companies that we speak to about reputation is it's a means to an end. So let's back up and talk about the difference between brand and reputation, which is the most common question I get asked. So your brand is the promise you make to the world, and your reputation is the ultimate consequence of whether you kept that promise on the 7 drivers that I referenced before. And citizenship and governance are proven to be increasingly important to your reputation. And so when it comes to generational differences, take millennials, for example. One of the things you want millennials to do is say good things about you so that you're more able to get people to buy from you, work for you, and invest in you. They are more likely, 1.8 times more likely to say something good about a company if you have a good ESG track record. So the way you conduct yourself on positive impact on society and environment is very important. One more finding just on ESG is that companies are doing quite a nice job on the S, on the social piece. They really need to pick up the pace on being open and transparent, ethical in business, fair, and also in the idea that they protect the climate. That is not slowing down anytime soon.
And Kylie, I saw that once again, banks and financial institutions had the dubious distinction of being dead last when it came to an industry that people felt really good about. Can you talk to us more about that? And what might they be able to do to change that in the eyes of the public?
Yes, you point out the industry differences. And while that is true about banks, we have studied their reputation for more than 16 years now. And I can say that overall, the category is doing much better than they have historically. They really had a tough time post-financial meltdown in getting trust and benefit of the doubt. The reason that trust and benefit of the doubt as the outcomes of your good or bad reputation matter is because it gives you a buffer in a crisis. So while banks are still struggling, their governance is the place they need to win. They need to prove, they need to do, they need to say when it comes to open and transparent behavior, when it comes to ethics and being fair in business. There were some great stories in there. ING does really nicely on this dimension across the 15 countries. And there are some rising stars in banking. So I'm very hopeful that we'll continue to see that rise. On other sectors, obviously, pharma benefited greatly from being in the spotlight on the S in the ESG, and just generally their reputation rose to 8th overall. And it was really nice to see pharma companies getting some of the benefit of the doubt. The places they did really well were on citizenship and governance, and so that was great to see. There are also regional differences for pharma. North America gets less high ratings than EMEA does, and so that's another place where they can work. But there's some wonderful stories in there, Sanofi and Novo Nordisk, and many to draw great case studies from.
All right, definitely something to bounce off of and hopefully continue to grow. Kylie Wright-Ford, CEO of the RepTrak Company, thanks for being with us, and we'll be back right after this.
welcome back. Tragically, overdose deaths have soared during the pandemic. As much as 87,000 people have lost their lives to drug overdoses. Let's chat more about that. We've got Jim Carroll, Senior Advisor to Students Against Destructive Decisions, joining us today, along with Yahoo Finance's reporter Adriana Belmonte. Adriana, of course, has been doing a lot of reporting on the opioid crisis. So we're very lucky to have you here with us as well. Jim, I'm going to start with you. These overdose deaths, how much did this put us back in terms of our fight against addiction?
Yeah, it's really sad. And we really think the majority of these deaths are due to the pandemic. And obviously, we needed to help people during COVID and make sure that people were isolating and being careful. But what it also did was it meant that people who were especially new in recovery and need that peer-to-peer relationship, were cut off. And it also meant that in schools, a lot of the prevention efforts were cut off. So we really now need to double down. Thankfully, the pandemic hopefully is coming to an end and we can focus on the mission of SAD, of teaching prevention, but also allowing people who are in recovery, who are susceptible to this disease, and it's a lifetime battle, are able to connect to the people that they need to the most.
Yeah, I want to talk more about how the pandemic has really exacerbated this story, Jim, because we had a lot of treatment centers closed, a lot of resources that would normally be there for folks have not been. Did you see the numbers spike early on in the pandemic last year, and are they at least starting to lessen, or have those numbers sort of been consistent throughout the past year?
When I was the director of the White House Office of National Drug Control Policy, 2 years ago, we announced for the first time a reduction in the number of overdose deaths in 30 years. And what we saw starting almost immediately with the pandemic, as those isolations started taking place, you mentioned the treatment centers were closing, schools were closing, was they started to spike. And the data released recently showing 88,000 overdoses are sort of the current estimates and current, where we think we're going. I really think it's going to be even worse. And I think we're going to see close to 100,000 deaths for, the last 12-month period as we sort of get final data. And that's how we need to think about it, in terms of 100,000 people a year have died from overdoses. That's why we need to, teach prevention. We need to get help for those who need it. And we need to stop the drugs coming into our country.
So you emphasize a lot about prevention. While you were drug czar, obviously you had a big hand in the drug policies. Under this current administration, we have an acting director right now, but once a permanent one is put in place, what kind of policies do you hope are set in place as part of these prevention tactics?
Yeah, and I think the office is continuing to do great work, and the acting director there is really doing a great job in leading the fight. And so my hat's off to Acting Director LaBelle for continuing these policies. We were spending the most amount of money, about $100 million a year, just on prevention. The American Rescue Plan that President Biden signed recently has more money there going towards that. And so we need to keep going in that direction, keep spending money on prevention. The money shows, right? This is Yahoo Finance. We talk about the return on investment. And we really can't even do that with human life. But what we do know is that for every dollar spent on prevention, it's about a $15 to $17 savings on the treatment cost if someone becomes addicted. And obviously, God forbid, if someone loses their life, there's no dollar amount. But even from a financial perspective, this is money well spent. And it's also, of course, saving lives. And that's why SAD exists. And that's why I'm proud to partner with them.
So I have to ask while you're here, there's more and more states that have been legalizing marijuana. I'm curious for your take on this because I've been seeing mixed reactions all over. Some people think this is a step in the right direction. Others think that this won't bode well for the future. I'd love to hear your take on it.
Yeah, boy, I hate not to answer, but you're exactly right. They're sort of mixed results, and I agree with what you're saying. What we have seen is states where it's been legalized have very mixed results. Some states have not been effective in controlling the black market, which means that, kids are hearing different messages. They're hearing it's legalized, And so they think, well, what's the difference? If I can do it when I'm over the age of 21, why can't I do it at a younger age? And so, we really have to teach prevention. We really have to make sure that we're keeping it out of the hands of kids. And all we have to do is sort of think back about the Surgeon General's advisories saying from a medical perspective, marijuana negatively impacts and permanently alters a developing brain. And so we have to make sure we're teaching prevention of marijuana, and the money that is made, the revenues, needs to go back into prevention. And we also need to, of course, talk about the dangers of fentanyl.
So, Jim, in terms of that prevention, but also even dealing with that addiction, we've seen folks get very innovative, get very creative during this pandemic. I'm curious to know if there was lessons learned over the last year that perhaps could be utilized moving forward, if perhaps virtual meetings, for example, might be able to reach a broader base of people that might be struggling.
Yeah, just like what we're doing today and communicating, through the phones and through our laptops, virtual meetings are important. We relax the restrictions on that to allow the telehealth meetings to take place and for everyone to still, get reimbursed as they would for any other medical service. We did that early on. We increased the amount of take-home medication and greatly expanded the availability of it. The take-home medication that is so critical for people to maintain their sobriety and not, relapse and go back. And so that's why it's so critical that we do this. We have to think about all these game changers. We really made naloxone, Narcan, more widely available. We started thinking about fentanyl as a weapon of mass destruction with 100,000 people or 80,000 people dying a year. This is what we need to continue to do. This is how we need to think about this issue. And I'm really, look forward to continuing to work on here and stay the fight.
And Jim, are you seeing that this current crisis with overdosing is affecting Black Americans disproportionately from whites? It was the other way around just about a year or so ago.
Yeah, what we're really seeing is an increase in urban areas of deaths because of fentanyl. Fentanyl is so lethal. It is so much more deadly, 10 times more deadly, than other drugs in terms of the ability to kill someone. Just, a few grains of salt and it can kill someone. And we're seeing the use go up in urban areas, and we're seeing a real spike there. That's why, we started targeting that. I know we're going to continue the fight in these cities to teach prevention, to get treatment, but also we've got to stop the flow of fentanyl into our country. None of it is made really here in the United States. It's all coming from outside the United States. And so, like I said, if we thought about this as a weapon of mass destruction, if we thought about 9/11 happening every 10 days or so, with the number of deaths, that's where we need to sort of start thinking of, what would you do? And what would you do if this is your child? So many kids are dying. So many of our loved ones, our neighbors. We have to start thinking, we're not immune from this. This is affecting all of us.
Absolutely. It's a crisis that is hitting this entire country. Jim Carroll, Senior Advisor to Students Against Destructive Decisions, Yahoo Finance's Adriana Belmonte. Thank you both for joining us today. And coming up, a Republican antitrust bill is targeting big tech. We have those details next. Welcome back. A new Republican antitrust bill is being proposed, and it would block big tech acquisitions. We've got Yahoo Finance's Alexis Keenan here with the details on that. Hi, Alexis.
Hi, guys. So actually, I'm going to talk about this Republican memo that came out from members of the Energy and Commerce Commission committee, and it was directed to interested stakeholders. And what they are is really legislative concepts is what they call it. And they want it to open up some discussion and ideas that they say they hope can help craft new legislation to address what both Republicans and Democrats say, for different reasons, are problems with Section 230 of the Communications Decency Act. That's that law that we talk so much about that gives websites and online platforms the freedom to really moderate the user-generated content without any legal liability. So this memo follows three different sessions of congressional testimony this past year from big tech CEOs. That's Mark Zuckerberg, Alphabet's Sundar Pichai, as well as Twitter's Jack Dorsey. But I want to highlight from this memo some of the concepts that are being set forth by these Republican lawmakers. Now, keep in mind, though, that when you're looking at these, that they apply only to big tech companies with $1 billion or more in annual revenue. Now, specifically, they talk about scenarios under which they envision this Section 230 Communications Decency Act law and those liability protections would be completely gone. So perhaps the most controversial of all of them is a suggestion to strip protection for all of these big tech companies. That includes social media, it includes app stores, and removing that protection also for companies that use targeted behavioral advertising. So when we think about the YouTubes, the Facebooks, the Instagrams, the Twitters, and others, another approach that they're looking at is to remove that same protection for moderation of content that's based on political affiliations or viewpoints. Also, moderation of speech that is protected by the First Amendment. Now, that would leave the shield in place only for moderation of unprotected speech. And those are things like fighting words, libel and defamation, obscene type of content, and also things like child pornography. Now, also another proposal I want to highlight is the idea that they would designate platforms as places of public accommodation, and that would be to remove liability for discrimination based on those political affiliations or viewpoints, and also moderation that doesn't offer due process to users, and that's really just access to the court system. So these are some of the ideas being put forth by Republican lawmakers, and as we have talked about for a long time here on Yahoo Finance, there is a long way to go with Section 230, but this might be moving the cart forward a bit, guys.
Absolutely. Thanks so much, Yahoo Finance's Alexis Keenan, for bringing us those details. And our coverage will continue right after the break. We'll be chatting with Teresa Romero, president of the United Farm Workers.
Hello, everybody. Welcome back to Yahoo Finance Live and our continuing coverage here. I'm Alexis Christophers with my co-host Kristen Myers. And here's what's happening. Is the crypto bubble about to burst? Dogecoin started out as a joke. Now it's a top 10 digital currency worth $40 billion. And of course, Coinbase briefly hit a $100 billion market cap when it went public this week. We're going to speak with CoinShares Chief Strategy Officer about the big run-up in crypto and how long it can last. And Wendy's isn't letting the pandemic stop it from ramping up new restaurant openings around the world. The CEO of Wendy's joins us later to talk about the fast food chain's expansion plans and its plans for its breakfast menu. And the push for vaccinating our frontline food workers. We'll speak with the president of the United Farm Workers about how the pandemic is disproportionately impacting our nation's farmers. Taking a look at the markets right now, we've got the Dow and S&P in record territory. In fact, the S&P is looking at its 23rd record close of 2021 if it can hang on to these modest gains, but the Nasdaq falling back a bit as tech stocks come under pressure. Want to check in with Jared Blickery now for a look at earnings season week one, Jared, and of course dominated as usual by the big banks. Great news coming out of Morgan Stanley, but investors don't seem to be buying into it, right?
Well, I'll tell you what, the headline number is from their trading division, just out of sight. But unfortunately, they let themselves get caught up in the Archegos family office debacle, and they ended up owing $951 million, not quite a billion, but that's still substantial, and that eats into their profit. So Morgan Stanley right now down about 3%, 3.5%. You can see year to date still looking at gains of 13.5% or so. And this was a record high for the bank, as many other banks have been doing in the previous weeks. But I think just taking stock of earnings season overall, results are good for the big banks. But some of the more traditional ones like JP Morgan, Wells Fargo, not Wells Fargo in particular, but looking at loan growth. And so the more traditional banks like JP Morgan and Bank of America, that's the other one I was looking for, not seeing as much loan growth in the future just yet. And that's despite the fact that we're in a huge housing boom. I mean, housing starts came in this morning at the second highest reading in about 4 or 5 years. That's substantial. We're seeing home builders at record highs. So the trading, which was really good in the first quarter, that may have been a one-off. GameStop helped that. A lot of volatility in the Treasury market helped that. We also are in the midst of a SPAC boom. That's helping investment banking fees, but that's probably peaked as well heading forward. We know the SEC is really digging into it, probing some of these companies. So even though the results are good and they're suggesting that we are in a good economic stance right now for the recovery, especially in the back half of the year, for the current quarter, the second quarter, things might be a little bit dull, but we'll have to wait 3 months to see how that works out.
All right, Jared, let's look at a stock right now that is not doing so well today, and that is Pinterest. What's happening there? They're not set to report earnings for over a week.
Yeah, Pinterest is pretty curious here. Let's key off that. I don't seem to see the particular stock here. It looks like that's not in my on this interactive radar. But Pinterest is reporting in a couple of weeks, and there seems to be concern that because of the reopening, there will be fewer eyeballs on its platform, and it really is kind of a much smaller stock compared to some of its larger competitors. Facebook and Facebook's Instagram come to mind, of course. And so we do have some notes from Bloomberg Intelligence, which is highlighting the action here. They're saying that Pinterest top-line growth, this remains aided by favorable digital ad trends and the addition of customers on the platform in home decoration, furniture, beauty, fashion, etc. But kind of concluding with a mixed picture here. While Pinterest monthly active user count, that growth could decelerate to the low to mid-teens amid reopenings. They're also saying that sales could double over the next 2 years amid a potential 25 to 30% increase in average revenue per user. So basically their monetization, still kind of in the early stages, could accelerate going forward.
All right, we've also got Clover Health Investments, not a stock we talk about very often, but the stock is soaring here this afternoon, the past couple of days. I guess investors are saying this company is a prime target for another one of those short squeeze trades.
Exactly. Yeah, their short interest as calculated by S3 Partners is 150%. That's right about where GameStop was before that stock exploded. And so we're seeing that stock, and let's go back to the Wi-Fi Interactive. We have that up 13% today. It's been up as much as 35%, excuse me, up actually about 20% right now. So off of the highs, but it's been pretty volatile. And I'll just give you a sense of the year-to-date price action. You can make the comparison. You can see it is quite depressed, and it's been basing off of these levels here, looking for some support. This is a SPAC that came to market with by Chamath Palihapitiya. He backed it, so it gets a lot of attention. But we know what happens with these meme stocks when we see that short interest creep up. So I hope we don't have another hedge fund blow up next week, but maybe they've learned their lessons.
All right. So speaking of those meme stocks, let's talk cryptocurrency, especially the meme itself, Dogecoin, up right now, like 155%.
King meme. I got to tell you, who would have thought this? Even with Bitcoin at record highs and getting so much market attention, Ether and even XRP breaking to record highs despite that ongoing SEC valuation probe on it. Look, it's up 6,000% year to date. What more do you want? This was trading at a fraction of a penny just a few short months ago. Elon Musk played a big part in its run up, at least tweeting twice before big run ups. One was in early February. The other was just a few days ago, actually. And look what has happened over the last 7 days. Most of the price action, most of the increase really occurring over that time period. So you get Elon Musk involved in something, you know that there's going to be a lot of attention on it.
You better believe it. Anything that man tweets about, talks about, it becomes the next hot thing. All right, thanks a lot, Jared. Let's stick with the markets now and say hello to Ava Ottos. She is COO of ER Shares. Ava, so you've been listening to what Jared's been talking about with the cryptocurrency sort of going crazy. We had Coinbase, the direct listing this week, sort of all over the place, lots of volatility. Do you think that this has signaled to traders that the speculative trade is back on, that it's okay to take on a little more risk?
Yes, we definitely see a correlation there when it comes to the risk appetite. We saw Coinbase being the biggest DPO, direct public offering in the history, much bigger than Roblox or Slack or Palantir. And what's interesting to see is that the first 10 minutes of its trading, it reached $105 billion of market capitalization. To put that into perspective, that's 4 times the Nasdaq and 1.5 times the NYSE. And at the end of the day, it was worth the same as NYSE and Nasdaq combined. And let's not forget, Coinbase is also an exchange, and you can only trade 50 cryptocurrencies through that, mostly Bitcoin and Ether. And it was able to have such an extraordinary growth trajectory, and the stock did great. So we are very excited to see that's a great entrepreneurial growth story.
So Ava, some of these growth names are pretty expensive. You just highlighted Coinbase, up over $300 for one share. If you are looking to some of those high-flying names, perhaps even outside of crypto, where are you seeing some growth, or some opportunities rather, among some of those growth names?
So we think there's going to be a transition, and we're going to see if everything remains equal, as economists say, ceteris paribus. If the conditions that we're seeing now remain equal, which means that we have the Fed support, we have good earnings announcements, lower numbers of unemployment, pent-up demand, vaccination that works with mutations, and the interest rates remain calm. If things remain like this, we think we're going to see tech coming back strong. We have, and that of course always starts with the least risky category when it comes to tech. And in that case was the FANGs, and the FANGs are up about 10% month to date across the board. Then that's going to move to hyper growth companies with earnings such as Square or Roku. And then of course the most risky category with hyper growth growth tech companies with no earnings, such as Cloudflare, for example. And then that can move, of course, to emerging markets. We saw China today reporting 18% growth on that quarter. And of course, China has 10 days now continuously with no COVID cases. So there might be potential there down the road as we get into the summer. And of course, small caps will follow the lead too.
What do you make of the activity we're seeing in the bond market and how yields are now starting to come down? And, you know, we had the yield on the 10-year Treasury above 1.64% last week. It's come down quite a bit. What do you think's causing that? And do you think rates have stabilized for the time being?
We think that rates shot up a lot and maybe overshot actually. So now they're coming down. We think this will continue, and we had the Fed support. People relate the interest rates to inflation. We're not very concerned about inflation at this moment. Of course, as we get closer to the year end, that's of a bigger concern. But at this moment, we don't think it's a big concern, as long as we have the Fed support. And let's not forget that we just got the stimulus. So having the stimulus and on the other side increasing rates would be contradictory. We had the stimulus to stimulate the economy. Rising interest rates it works reverse in the reverse way. So we think as of now, there are blue skies ahead. It's a great time to be an investor, but we should have our eyes open when it comes to new mutations, and of course, when it comes to have our eyes on the interest rates. And having said that, we think it's not a good time to be in the fixed income space. So we are seeing flows out of fixed income into the equity market. We are also seeing a record number of retail accounts opening up when it comes to Robinhood and Schwab, for example. And there are more retail investors now, especially millennial, coming after tech stocks. So that's also a driver when it comes to tech stocks. And of course, the growth names that millennials love, the ones that have great stories behind, great entrepreneurs. And then that's also going to fuel money into the marketplace.
All right, Eva Ados of ER Shares, thanks so much. And don't go anywhere. When we come back, we're going to speak with the Chief Strategy Officer of CoinShares about the outlook for crypto.
welcome back. Let's talk cryptocurrency now. Bitcoin is under pressure after Turkey banned using that as payments. Meanwhile, Dogecoin right now is soaring. So we're joined now by Meltem Demirors, CoinShares Chief Strategy Officer. Meltem, thank you so much for joining us today. I want to start with that Turkey news. Now, it was thought that Bitcoin was getting to a place where we would have more institutions adopting it. Curious to know if you think that Turkey and that decision there might be more of an outlier, or if we might see more countries joining in as well and banning that cryptocurrency. And what could that do to Bitcoin going forward?
Those are all great questions. I've been in this industry for 7 years. CoinShares manages $5 billion in assets. So we spend a lot of time looking at what's happening around the world. I'm actually from Turkey myself, and my WhatsApp has been blowing up this week with friends and family in Turkey looking at getting into crypto. Let's be very clear though, Friday's sell-off, today's market sell-off, had very little to do with the news of Turkey banning the use of cryptocurrencies for payment, but really more to do with the derivatives market. Ahead of the Coinbase listing on Tuesday, we saw a lot of activity in the levered trading market, with a lot of traders taking on leverage to go long Bitcoin into that news. Now that the Coinbase cat is out of the bag, and given how expensive the cost of debt is in the crypto space, we've seen a lot of that unwound, which has been the primary downward catalyst. But a fun fact about Turkey, I was just speaking to my friend who runs part of the TradingView business, which is one of the largest networks for investors. And this week, that site saw a massive spike of traffic from Turkey, which is now its #1 source of traffic as a country. And all of that traffic is going to cryptocurrency charting and cryptocurrency discussions. So it's definitely not a dampener. I think if anything, it is a catalyst, and more people in Turkey are now looking at crypto, already the #1 country in the EMEA zone in terms of crypto adoption. So I expect this story will continue to unfold.
We know that you can't get into crypto unless you have an iron stomach, right? Because there's going to be lots of volatility here. But when do you think that might start to even out? What has to happen to sort of bring that, to rein that volatility in? And I'm thinking maybe it happens when there's finally a Bitcoin ETF, or we see more products out there that allow people to buy sort of baskets of crypto as opposed to sort of playing in one kind of cryptocurrency versus another. What do you think?
Yeah, absolutely. And great question. You know, CoinShares, we've been in the ETP business for the last 6 years. As I mentioned before, $5 billion in AUM in our products. Around the world, there's over $60 billion in AUM in publicly listed crypto ETPs. And we see that number growing. One interesting fact, the last 2 quarters, gold products have seen $20 billion in outflows. Crypto products, record high of $7 billion in inflows. I don't know that an ETF really changes much in terms of the ability to access crypto. Today, if you're in the US, you can access crypto directly through Square's Cash App, Robinhood, Coinbase, name your favorite fintech platform here. You can access it through a number of other platforms. You can buy products that provide exposure to Bitcoin. So it'll be interesting to see what a Bitcoin ETF really does in terms of unlocking additional demand. What I think is more interesting, per your question on volatility, is at our firm, we firmly believe that Bitcoin's volatility and the overall volatility of the crypto market is part of the price of opportunity. Historically, you know, we've seen these 2 to 3 year cycles play out in the crypto space. And right now, obviously, we're in an up cycle. But by the way, cryptocurrency volatility is nothing compared to traditional equity markets. Over the last 12 months, certainly, you know, it used to be that Bitcoin was crazy volatile. In the last year, Tesla stock has been twice as volatile as Bitcoin, and equities across the board have been extremely volatile. So as the rest of the market becomes more volatile, I think Bitcoin's relative volatility becomes less of a concern. The real question here is, can you achieve real diversification through buying a basket of crypto assets or crypto products, or even companies like Coinbase? Because so much of the revenue in in this space is still tied to the market cap of these coins. And a lot of crypto assets still do have a beta of 1 or a high correlation to Bitcoin's price movement. Bitcoin still comprises over 55% of the crypto market cap. Ethereum, the second largest digital asset, is over 13%. So the real question is at what point will we see correlation come down and see increased diversification within the sector itself?
Meltem, we had so many more questions that we were hoping to get to with you. So we're just going to have you back on in the future. I know we're going to be chatting a lot more about crypto going forward. Meltem Demirors, CoinShares Chief Strategy Officer, thanks so much for joining us. And coming up next, we're going to be hearing from Wendy CEO Todd Penegor about expansion plans and breakfast. That's next.
Welcome back. Wendy's isn't letting the pandemic stop it from ramping up new restaurant openings around the world. Yahoo Finance's Brian Sozzi spoke with Wendy's CEO Todd Penegor about the fast food giant's expansion plans and also their plans for their breakfast menu during the pandemic.
Throughout the pandemic, we've been getting into people's morning routines. Our business ended last year at mixing at about 7% mix, so exactly where we thought it would be in the first year. We supplemented that with some strong support from company-funded advertising, as well as the franchise support that we've had throughout the year. And we're really excited about where this business can go in the future. And as part of our earnings, you know, we just talked about, we do believe it can be a 10% mix of our business by the end of 2022 with the momentum we've seen, because it's doing well, but mobility's down. People don't have their morning routines. And we know we have a lot of opportunities on awareness and trial, which can drive the business like crazy in the future.
How close do you, so 10% of sales by 2022, how big a business in terms of sales would that make breakfast for Wendy's?
Yeah, so what we've been talking about is, you know, how is it $1 billion plus incremental sales layer to our business? So we're a $12 billion system today. So at 10% mix, you know, $1.2 billion, $1.3 billion as we continue to grow the rest of the day part too. So that's a sizable business to pick up in the course of a couple of years.
That's almost, if I'm just crunching some numbers here, that's almost 200 million more than when we initially talked. You were targeting, I believe, $1 billion goal within short order. To me, that sounds like market share gains. Where are you taking market share?
We do say, you know, in the data that we see, we are picking up our fair share within the business. You know, you got some sourcing from all the traditional big players. You know, the smaller mom and pop and other folks have had a little more challenge through the pandemic, and you've had a lot of restaurants closed unfortunately, during the course of the last 12 months. But you know, we think there's just a huge opportunity. You look at where other traditional QSR players, they're all mixing much higher than 10%. So it's a journey for us. We think there's a lot of growth for us into the future, but to be able to establish a business that's already at 7% with a line of sight to be 10% by the end of next year, we're well on our way to really have a day part that's driving a lot of growth and really helping fuel the restaurant economic model for our franchisees.
And the franchisees, they're still committed?
Fully committed. We had an opportunity, as we had talked about in the past, after the first year, we were going to allow folks to take a look to see if they wanted to opt out, if they were in a trade area that just wasn't working. We've had literally less than 5 franchisees asked to opt out. And the only folks that have asked for a little bit of hiatus are those that are in a trade area that has been completely shut down, if a mall or a athletic venue was right near them and not driving a lot of business during that into that trade area. So no, they're all in, and what they really loved, it's driving additional frequency to our restaurants. It's incremental to our rest of day business, and it's profit and margin accretive to the business. So they're feeling good about it. And the pleasant surprise, Brian, it was a lot easier to staff than they thought that was going to be. So we were able to hire up staff and have a very effective and efficient model for the morning day part.
You mentioned mobility. Mobility data, that has started to come back a little bit. I watch a lot of the Google Trends data. People are going back out, likely after they're getting vaccinated. What have you seen in your business?
Yeah, we're in that quiet period right now. We got earnings coming up in a couple of weeks, but you know, just in general mobility trends, we're seeing the same thing. Folks are getting a little more comfortable getting out. Everything we look at is seeing mobility pick up. You still got about half of the folks still working from home, so the routines are a little different on the mobility. You don't really have that dedicated morning routine with the big rush to get to school, big rush to get to the office. But people are out and about during the course of the morning. And what we've really seen in our breakfast day part is it continues to build all morning long. So our biggest peak half hour in breakfast is between 10 and 10:30. And I think a lot of that is folks are doing a little more grazing, getting the late morning snack, getting to be out behind the Zoom camera and grabbing a biscuit and a frosticino to keep them going throughout the day. And how that changes over time, we will see as the routines come back. But you know, it's not that dedicated mobility. It's not a routine yet, right? We're all willing to get out a little bit, but it's not like we're on that every morning we're heading to work or every morning we're heading to the gym. But it's starting to pick up nicely.
So Todd, I know you as a pretty competitive guy. We're both Pelotoners, but what are some of your thoughts on McDonald's entry into the chicken sandwich wars, so to speak? We all love to say chicken sandwich wars. They launched 3 new sandwiches in mid-February. What have you seen?
Yeah, no, everybody's been launching into that space. You know, a lot of discussion with everybody that plays in traditional QSR. And, you know, the good news is it's created a lot of discussion and a lot of noise around chicken. And we've been very pleased with our chicken business. It goes back to the fourth quarter of last year when we renovated our homestyle chicken and renamed it the classic chicken sandwich. You know, we've done work to have a more tender, juicy grilled chicken sandwich. I know we had sent you some over today to have for lunch. And we continue to do work on our spicy lineup to make sure that it's got the spice that holds. But we're not just doing things on our base sandwich. Our Made to Crave lineup allows us to truly innovate on chicken sandwich business. The jalapeno popper chicken sandwich is the one that, as we talked about on earnings, was off to a nice start in its early days. We can continue to win in the chicken space, not just with high quality base protein, but with the toppings and the fixings that we can put on them with the Made to Crave lineup. So we feel really good that we're in a position to compete. No matter what McDonald's does, no matter what Popeyes continues to do, no matter what KFC decides to do, we're in a great position to continue to win and get our fair share of that business.
Why is the industry? Why do they love chicken sandwiches? What is it about chicken sandwiches?
Well, chicken sandwich, you think about it's, from an entry perspective, you got a fryer. If you're going with the fried chicken, it's easy, quick to make. You can serve it fresh and hot, and you can do some unique builds along the way. And if you look at where the protein markets have been over the last couple of years, the chicken protein has been very predictable on a cost pattern. I know it's been creeping up a little bit more recently, but I think that's why folks love it. It's a great eat. It's got a healthier perception to it from a consumer perspective. So I do think that there are a lot of folks gravitate to it. And with all the news that's been created, it does drive a lot of trial, and it gets folks to really think about, maybe I need to have a few more chicken sandwiches in my routine. So it's been good for the industry.
Is Wendy's seeing inflation? You mentioned chicken, but are you seeing inflation in meat and other commodities? And how have you overcome that?
Yeah, we are seeing a little bit of inflation, especially as the economy comes back and demand starts to pick up. Some commodities we have covered, others are uncovered, but not insurmountable. We're seeing a little more labor inflation along the way as access and cost of labor is a little bit more. But with all of the productivity that we've been able to drive through the pandemic, with getting more cars through the drive-through, the work we've done around labor positioning, the work that we're doing on technology to drive higher average checks, both with mobile grab and go, curbside, as well as delivery. All of those things have helped us, along with a little bit of pricing, to really overcome those headwinds and still drive a strong restaurant economic model for the system.
All right. And that was Wendy's CEO, Todd Penegor. You can watch the entire interview on yahoofinance.com. Coming up next, the push to vaccinate our frontline food workers during the pandemic.
Welcome back. We have Yahoo Finance's Jared Blickery here now for our energy market check. And Jared, I'm seeing today energy down 0.7 percentage point. What's going on today?
Well, I think this is just a little back and fill because we had the big breakout, which we'll look at in a second, earlier in the week. We do have some headers today that I'm looking at. JP Morgan cut its Brent and WTI 2022 forecast by $4 a barrel. They're saying next year Brent will have a price of $70, WTI going to have a price of about $66. We also got some news from Baker Hughes today. The rig count in U.S. for oil wells is up 7 to 344. But I think the focus is on the demand picture and also the reopenings. This is a 1-month chart, and this is a big breakout that we had just a few days ago. We had been consolidating here, so we got a nice pop. And I think this is just kind of a little back and fill price action that we're seeing here. Now, it hasn't been the greatest week for the energy sector. Energy kind of lagging now. We're going to take a look at that heat map, and here we go. We're going to start getting some of these guys trickling in earnings in the next 5 to 10 sessions. So let's take a look at what's happened this week. All right, so we got some green there over the last 2 days, fallen off a little bit, but still holding on. A lot of these names holding on to green for the week. Of course, earnings season going to be a big driving factor. Expecting huge growth. The comps are going to be out of sight here because there were such low expectations and low actual results last year. But nice to see crude holding over $60 per barrel. It had dipped down to about 57.58, and regaining that sets it up for a potential run in the coming sessions.
All right. Thanks so much, Jared, for those updates as usual. Let's turn now to discuss the impact the pandemic has had on farm workers and what we need to do to protect them going forward. We're joined now by Teresa Romero, president of United Farm Workers. Teresa, thank you so much for joining us. What kind of protections do we still need? We're more than a year into the pandemic for those farm workers going forward, especially as they're such essential frontline workers.
Yes, you're right. Farm workers have been working every day. You know, most of us can work remotely, but they cannot harvest the foods and vegetables that we enjoy every day remotely. We have been working in the farm worker movement with the UFW Foundation, the Cesar Chavez Foundation, and some contract companies to make sure that farm workers are getting the vaccine. For the most part, in rural areas, it's very difficult for them to go to a pharmacy because those pharmacies are not in those areas, or it's very difficult and time-consuming to make an appointment. And you need to remember that not many of them have the technology or are technology savvy to really navigate the system. So we have been working throughout the state of California to make it sure that vaccines are getting to rural areas.
Tell us more about that, Teresa, and the work you're doing in conjunction with different municipalities in California. How many of those frontline farm workers have been vaccinated, and what has are you seeing that there is vaccine hesitancy on the part of these farmers, or do they want to get the vaccine?
No, farm workers want to get vaccinated. We went through a process of getting phone calls with doctors and experts that spoke Spanish. So we had Zoom meetings and phone calls where workers were able to ask the questions that they had to understand what the vaccine was and what it did and the risks. Once, like all of us, once they were informed, they were told the risks. Farm workers are not hesitant to take a vaccine. I know there has been a lot of comments out there that they don't want to do it, but we have done research and we have contacted tens of thousands of farm workers, and 95% of them are saying, yes, we're going to get vaccinated.
Teresa, I want to talk to you now about immigration issues, which of course is huge among a lot of farm workers. There are pathway to citizenship bills right now that are being considered. Do they go far enough? Are there too many cracks? What do we really need for many of these farm workers? I know some of whom are undocumented going forward.
Yes, and that is one of the main problems in the industry. A large percentage of the farm workers that work here in this country are undocumented. In 2019, we passed through the House the Farm Workforce Modernization Act, and it passed with this bipartisan support. 34 Republicans voted for it. We again, 3 weeks ago, this Speaker Pelosi put it through a vote in the House and again passed, and this time with 30 Republicans supporting it. We worked with both Republicans and Democrats in the House. We worked and negotiated with the major growers associations in the country, and we compromised to get a bill that would satisfy the needs of the industry and that would give farm workers and their families a path to citizenship. This bill, like I said, passed the House. It is in the Senate. We're working with the Senate to try to move it forward because President Biden has said he would sign it.
Teresa, I know that there has been a labor crunch, a labor shortage in the farming industry for quite some time. And now we see some U.S. produce growers turning to robots to do some of that work. Is that something that your organization can get behind? Is this something that will actually help the farm workers or actually greatly reduce the amount of jobs available for most of them are immigrants, for these immigrants?
Like on any industry, technology is going to change the way we do things. If we see that these robots are going to make the work easier for farm workers, we applaud it. But we understand, and not if all the work can be done by machines. When you're harvesting vegetables and strawberries and wine grapes, you have to be very careful. There's fruits and vegetables that you need to handle with a lot of care and knowledge. And I don't think the industry can be replaced by these robots.
All right, Teresa Romero, United Farm Workers President, thanks so much for joining us today. And coming up, we'll be hearing from Lachlan Power, gamer and content creator for the next.
In the latest installment of Yahoo Finance's special series, The Next 21 to Watch in 2021, Jen Rogers speaks with Lachlan Power, who is rapidly becoming a force to be reckoned with in the world of gaming and content creation.
My name is Lachlan Power, and I'm a YouTube gaming content creator. And in 2021, I'll be focusing on building my gaming organization, Power.
So, like Beyonce, you go by a single name. You have over 14 million subscribers on YouTube. You started out playing Minecraft, but it is your Fortnite videos that can often be found on YouTube's trending videos. So, when and how did you actually figure out that this could be a career?
So I think we just hit 8 years. And it was actually pretty quick for me. The first month in, I think I was getting a couple thousand views on my Minecraft videos, which was insane. But at the time I had a side hustle project, which was developing a Minecraft server. And I always had this memory of like, there was one day where the revenue on that server made, I think it was like $1,000 in a day. And that was just like unbelievable money at that time. I was 17 at university, and I was just like, I think I'm gonna drop out and pursue this, I think. And haven't regretted that ever since.
What did your parents think of that? Like, did they try to convince you to stay, or did they get it?
They were sad at me leaving at first, and then tried to convince me to go back for the next year, even though I was making really good money. But you know, the argument would always be there, this can't last forever. So I made it last forever.
So how do you define yourself now? Are you a gamer? Are you a content creator? Are you an entrepreneur?
It's a good question. I would say content creator would be the overarching kind of description of what I do. But these days it's a lot more delving into game development, you know, the whole ecosystem of content creators, and it mainly revolves around Power, which is the esports organization. We focus on a lot of game development stuff, you know, working with our new content creators out in OCE. That's where we're starting out, and just developing those as, you know, personalities within the space, helping them get the kind of tools and advice from myself on how to build their profile online.
So how do you spend your day? Like, how much of it is playing video games versus the business side of your job?
So the business side, it's interesting. It's like it's full-time squared. You wake up, you think about work, you go to bed, and in between that is just you think about work. There is nothing, especially in the influencer kind of side of things, you're always thinking about the next business opportunity. You're always thinking about your next video. You're always thinking about how you can better optimize a certain process within your organization. But to answer your question in regards to like how many hours I'd play a day, that's like a number that's steadily gone down over time. You know, that I enjoy playing games a lot because I don't get to play it as much as I used to. Like when Fortnite first came out, I think I was putting on like 8 hours a day. These days, maybe like 2 or 3, because there's just so many other things taking my time. But it's still definitely something I enjoy every second of.
I was actually really interested to read that Fortnite and the Australian Open teamed up for a Fortnite Champion Series. Do you think we're going to see more of this old guard and new guard, real world, virtual world coming together?
Yeah, I think Epic and the Fortnite team have done an amazing job with breaking down those barriers between, you know, traditional and the gaming realm, because it is so new. And the Australian Open is one great example. Fortnite's also done a lot of things in game as well through the Icon series. You know, we have awesome, amazing collaborations with Travis Scott, more of these mainstream things that kind of, you know, make gaming cool.
So you bought your first NFT, non-fungible token. So what do you think of NFTs?
Yeah, no, I think the NFT space is amazing. I've been doing a lot of research myself personally into the whole scene. I think for creators and creatives, it's a great way to monetize your audience in a new way. And I think we're going to see a lot more of it. I feel like for creators, it's a lot like buying a piece of apparel, or, you know, having ownership of a collectible within an organization or something, or a creator. is a very powerful thing to do online. And I think it's going to be very interesting if that world collaborates with a game, that could be a very interesting space.
And do you feel the same about Bitcoin and crypto? There's a little bit of overlap people see between your world and the crypto world.
Yeah, definitely. And I feel like it's getting closer to that bridge day by day. I personally am very into crypto, a little bit of investing myself into a few coins. And it's just very interesting, the blockchain technology. And I would really love to see a video game get involved, because I think that is going to be when it gets real.
So what advice do you have for kids everywhere who want to be like you? They want to make a career out of playing video games.
I would always start on YouTube. It's just a great discoverable platform for people to find content. Provide value in a way through niches. Growing out of a niche is probably one of the best strategies you can do. That's what I did. I grew out of a mod within Minecraft. I didn't just tackle straight from Minecraft. And I feel like Fortnite, as an example, there's a lot of niches within creative, especially right now as it's a new space. But just finding a way to do things different that you would still watch. And you need to focus on your titles, your thumbnails. They're your first things that a new audience member would see. So you need to have your best foot in the door and then just deliver on the content. Make them not want to click off the video. Make sure you're getting good retention on your videos and using your data to make better videos. And finding ways to create content that people aren't doing is the best way to grow, in my opinion.
All right, Lachlan Power, one to watch here in 2021. Coming up next, our tech editor, Dan Howley, will join us with a preview of Apple's big event next week.
Welcome back. There's a new Apple event happening on Tuesday, and we have Yahoo Finance's tech editor, Dan Howley, here to give us a preview. Hi, Dan. What's going to happen on 420 with Apple?
Elon Musk will probably be sparking some attention on 420, but Apple will be hosting its event. This is going to be primarily what we imagine to be an iPad-focused event. That's because we've been hearing tons of rumors about iPads getting an update, mostly from the iPads Pro. Those could get chips that are as powerful as the M1 chips that Apple has made and put into its MacBooks and its Mac Mini line. We could also see some of the iPad Pros get Thunderbolt ports. Those are basically upgraded USB-C ports. No, it doesn't mean if you had another iPad Pro that you need another cable. It only means you would need another cable if you wanted to take advantage of the Thunderbolt capabilities, which include turning another screen into a secondary monitor connected to your iPad. Beyond the iPad, though, we're expecting to see perhaps some updates to the AirPods. They could be the AirPods 3, not a new line of AirPods Pro, but these could have shorter stems where the microphones are, and they could have silicone tips now that go into your ear, make them a little more comfy. Don't expect active noise cancellation, though. That's something that's reserved for the higher priced AirPods Pro. And then we could also see things along the lines of some new features in iOS 14.5. That is probably going to launch then. That's big news because that comes with the controversial app transparency tracking. That's a feature that when you install a new app or you open an app, it will ask you if you want to be tracked across different apps and websites. Facebook is pushing against that, but it should launch that day, we're hoping.
All right. Thanks so much, Dan. I know that you're going to give us all of the updates after the event. I don't know if you're going down to the store. I don't know if those days are long behind us thanks to the pandemic. All right. So then you're going to stay at home. All right. Thanks so much, Dan. All right. Coming up in the next hour, Blade founder and CEO Rob Wiesenthal will be stopping by to chat a new deal that they've struck with the electric vertical aircraft maker Beta. That is coming up next.
No.
True. Wild moves in crypto today. Dogecoin surging more than 100% following tweets from Elon Musk, bringing its gains for the week to nearly 400%. Bitcoin, on the other hand, in the red after Turkey bans cryptocurrency payments. We will discuss the latest. Blade reaching a deal with Beta Technologies with plans to bring electric vehicle aircraft to the market by 2024, so in just a couple of years. We're going to talk to Blade CEO Rob Wiesenthal about why this is a critical moment for EVAs. And Kimco Realty reaching an agreement to buy rival Weingarten in a $3.9 billion deal. It will expand their presence in the Sun Belt region. CEO Connor Flynn joins us to discuss. It's the final trading hour of the week. Welcome back to Yahoo Finance Live. I'm Shauna Smith.
And I'm Adam Shapiro. We're set to break some records here as we head toward the closing bell. Jared Blickery is watching everything for us from his vantage point. What are you seeing?
We are set for some more record closes in the Dow, the S&P 500, not the Nasdaq Composite, but the Nasdaq 100. And today's price action largely constructive. We have a broad-based leadership here. The Nasdaq is lagging, so we're seeing some of those tech stocks, and we'll take a look at them in a second, not participating. But for the week, we are sitting on some nice gains. And I do want to look at the bond market right now, because we are seeing the 10-year T-note yield up 4 basis points. That's after that huge drop yesterday. And I'll just take a quick look at that chart. 30-year T-bond also slightly down, or slightly up about 4 or 5 basis points. But here's breaking that support. The bond action kind of giving some consternation and some weird price action to traders yesterday, kind of normalizing today. And it is options expiration. So the index options, those expired on the open. We'll get options expiration on the individual names later in the day after settlement. But you can see a mixed picture here. Apple's underwater by a third of a percent. So is Facebook. But Microsoft, Amazon, Tesla, each up in the green. Not a lot of big movers here. I am noting that Moderna, up 6.8%, continues to benefit from the vaccine squeeze on some of the other manufacturers. And also, I believe, coming out with news today that it's going to limit some shipments. But let's take a look at the travel sector. This is how things are shaping out for the day. Royal Caribbean up 1%, Trip.com over 2%. But let's take a quick look at the week here. And by the way, we're going to do a big review at 4:30 and take a look ahead at the week ahead. But we can see some of these names under some pressure this week. Carnival's down 7%. Delta Airlines down 5%. It's really been about those big FANG names most of the week, guys.
Jared, we also have some breaking news on this afternoon. Squarespace filing to go public. They're going to be doing this through a direct listing. What have we learned about the company's financials?
Well, I'll hit some of those numbers here. They're seeing a nice pop in revenue, although their profits did decrease. And I think it's notable that they are profitable. And it's probably why they're doing a direct listing. That's where they don't raise any new money from investors. They simply allow their existing shareholders to kind of cash out. But they will be listing under the ticker SQSP on the New York Stock Exchange. And the New York Stock Exchange is where most of the direct listings have taken place so far, except for Coinbase, which of course listed on the Nasdaq 2 days ago. But I'm looking at the Wi-Fi Interactive here. We have all of the major issuers of direct listings. And you can see some interesting price action for today. Coinbase up 5%, Roblox and Snap down 5%. So we're seeing a bit of volatility in these names. And I guess within the coming weeks, they will be joined by one more, Squarespace. This is a company that that helps people rapidly prototype and develop websites along with analytics and search engine optimization, all that good stuff. But they're also pivoting into e-commerce. So all in all, I think there's going to be a lot of attention on this issue as well, probably not as much as Coinbase, though.
Certainly will be. And we, of course, will be tracking it here at Yahoo Finance. All right, Jared, we will talk to you in a little bit. So we have just under an hour to go until the closing bell. You're looking at gains across the board. The Dow above 34,000 today. S&P hitting a new record intraday high. We want to bring in Erica Clower. She is technology portfolio manager at Jennison Associates. And Erica, we're looking at gains across the board today. It was a pretty bullish week here for the markets. All three of the major averages up over 1%. From your vantage point, what's boosting investor sentiment?
Well, first of all, thanks so much for having me. What's really boosting investors' confidence is earnings. Earnings have been, in general, coming in much better than expected. And the outlooks also have been much better than expected. And that's not only for the steady Eddie technology plays, but also the reopening of the economy, restaurants, hotel chains. We're seeing very strong indications on bookings for travel. So all of those reopening plays have also seen quite a big boost. So you've seen a pretty broad broadening out within the market strength, which I think is a good sign.
What advice would you give to all of us as investors if we wanted to be specific, say, in technology, how to look at who's going to be the long-term winners post-pandemic versus who's been a short-term winner during the pandemic and maybe a couple of months afterward, but not long-term? What should we look at?
That's such a great question, and it's one that we get a lot at our team. And really what we look at are the longer term disruptors, those companies that are accelerating innovation, increasing efficiency within their various industries. And really, it's not necessarily a tightly defined technology company, but even companies that are using technologies to advance their competitive edge, to increase innovation. Those companies are the ones that we look at over the long term as the best bets.
So, Erica, when you're trying to figure out which names are overvalued and which aren't and where you're finding opportunity, yes, it makes sense, but drilling down into the fundamentals, what specifically are you looking at?
Well, specifically, we'll take it industry by industry. So just two examples that would come to mind would be the transportation industry. And I know you'll be having the Blade CEO on a little bit later, but I'd be very curious to know, for example, from his perspective and from any vehicle maker's perspective, where are you with regards to the electrification of the vehicle and also with the autonomous aspect of the vehicle? These are huge untapped opportunities when we look over decades. And the technology that's required to implement those changes is enormous, and those are really where you might find some interesting opportunities. Another simple area to think about would be healthcare. That's a very broad-based category, but within that, you can think about things like telehealth. You can think about electronic medical tools that are, for example, robots that are assisting in surgeries, or even looking at artificial intelligence and how they're accelerating drug delivery. These are incredibly exciting, big opportunities that are still in very early days.
I'm glad you brought up the Blade CEO because we like to have really cool companies join us. But the other issue with Blade is they're going to go public via SPAC. Lots of companies are doing that right now. So whether you're picking a tech company that's disruptive or a healthcare company that is on the verge of breakthroughs, what's the danger do you advise for clients who think, I got to get on the SPAC, I got to get on the SPAC? Because we're seeing huge amounts of money via SPAC going and that companies coming public.
Well, I think that clearly what we're seeing right now in the electric vehicle SPAC space is some distribution. A lot of those recent SPACs have gone down pretty considerably. So I would move away from the untested, unproven companies. I would look for incredible stewardship amongst management teams. But most importantly, I would look for defensible technologies. What is the exact technology that the company is bringing to bear that makes it different from other companies and gives it a sustainable advantage, not just for this quarter, next quarter, but really over a 3, 5, 7-year time frame. And that's really where we find the best opportunities and we find our best results in terms of investment returns.
Shauna, I think you're muted.
Sorry about that. It was bound to happen. It always happens once a week, so I got it out of the way early. But Erica, what I was asking you was, when we take a look at the market right now, what's priced in from your perspective? We got that $1.9 trillion COVID relief package. Now President Biden's talking about the potential of a $2 trillion infrastructure bill. How is the market viewing this?
Certainly, the market is viewing this as very positively in the sense that we have a very accommodative Fed at this moment, and some of the setbacks with COVID vaccine distribution obviously gives the Fed a lot of movement to keep rates low for longer, which is positive. You're seeing companies borrow at very attractive rates. You're seeing M&A deals being done. So I think that's all very supportive for the market. But if I were to distill it down to one thing that I think hasn't yet been fully discounted by the market, and still is many more years of opportunity to come, that would be to really look at how COVID has, in a very profound way, accelerated the digitization of the economy. And we can look at it from examples of whether or not we ever will go back to a bank to deposit a check. Instead, we're taking pictures of our checks with our smartphones, to just the fact that we're having this interview on Skype. And companies are doing a lot more remote collaboration. Students are learning online. I think that the transformation of us all and our proficiency in technology, whether it be work, entertainment, finding where we're going to travel, all of that has changed forever. And that, I think, is the place that we ought to look for opportunity going forward.
Erica Clower, Technology Portfolio Manager at Jennison Associates. Great to have you, and we look forward to having you back again soon. Coming up next, we'll talk about the latest on COVID, and we'll hear from Moderna's CEO about why a booster shot may be needed. We're back with that in just a couple of minutes.
Just about 45 minutes to the closing bell. We want to get our COVID-19 update, news about the vaccines, depending on which one you got, and you might need a booster shot. Angelique Kamlani, let us know what's going on with this.
Hey, Adam. So we know that we've heard from health experts that we're likely going to need booster shots. Now the vaccine company CEOs are saying so as well. We heard from Pfizer CEO Albert Bourla saying that we might need one 6 to 12 months after the original shot. Earlier this week, we heard from Moderna CEO Stefan Bancel saying just the same and explaining why that is going to be necessary. Listen to what he had to say.
You have a mixed bag, I would say, between people that are young and healthy and maybe 100% efficacy, and people that are older with one or several comorbidity factors. And then to your point is the variant. We do worry about the variants.
And so variants, of course, being a key role, we know that that's really a major issue right now with the federal government investing in being able to track more of that around the United States as we see the spread of variants here, as well as hear more about them globally. Right now in the US, more than half of states seeing an increase because of these variants. And globally, we've seen a doubling of cases in about 2 months. So all put together, really troubling scenario, and likely going to see the need for COVID vaccines for some time to come, even as we're seeing those stumbling blocks. Of course, AstraZeneca first, and then now Johnson & Johnson, seeing their vaccines hit some snags and some concerns over blood clots. And so right now, as it stands, the US government still has recommended that pause on Johnson & Johnson. We're going to hear next week from that vaccine advisory committee for the CDC on when to unpause and what the sort of restrictions may or may not be for the Johnson & Johnson vaccine. Back to you guys.
Angeli, we're going to keep talking about this with Dr. Sarah Andrabi, Assistant Professor of Emergency Medicine at Baylor College of Medicine. It's always good to see you. There was a column by a doctor in the New York Times, which basically said, I'm summarizing what they said, if you've got a vaccine, do not be afraid of the variants in the United States. What do you think?
So I think we do definitely have to be cautious of these variants. Pfizer CEO, as you guys said, recently announced that a third dose of the vaccine is likely necessary in 6 to 12 months after you receive your first pair. And we have good data to show robust immunity 6 months post-vaccine. Soon, we should have 12-month data to see what that immune response looks like in vaccinated individuals. We are continuing, though, to see this virus mutate and evolve. Specifically, the variants out of South Africa and Brazil are resistant to the immunity you would get from a natural infection. And additionally, the vaccines are less powerful against these variants. So they are as they are against the original strain. So if the virus continues to spread, which means it continues to mutate, it could evolve to a point where what you get from those first 2 doses in terms of immunity may not be enough, and that you really need that additional dose. You could think of it like an annual flu shot, but for an illness that's much more serious, deadly, and contagious.
And Doctor, we also had that study from the CDC earlier this week talking about how people who are fully vaccinated, they were again infected, or they were infected by COVID. Does this raise any alarm bells, or is this in line with what we were expecting?
Yes, the CDC identified a small group of COVID-19 infections among fully vaccinated patients. 76 million people have been fully vaccinated, and there are 5,800 breakthrough cases is what they're calling them. Most of them were women. 40% were over the age of 60, and 7% had to be hospitalized. But this incidence is rare. It's about 0.008% and is in line with expectations. The infections are similar to it coming down with the flu, despite getting the flu vaccine. So let's keep this with a global perspective in mind. The COVID vaccines were found to be 95% efficacious for Pfizer, 94 for Moderna, and 86 for J&J. This is higher protection than the annual flu vaccine received. The vast majority of people who are vaccinated and get COVID are going to have mild to moderate illness and be able to recover at home. The current vaccines protect against the UK variant, which is now the most common variant in the US, and they're almost 100% effective against preventing death, which is actually what the trials were set up to study. We also saw breakthrough infections in the trial data, so I'm not surprised we're seeing a small number of them right now.
I'm going to ask you a question that comes out of frustration that I think millions of us share, having to work at home, but nothing like what those of you in the medical field deal with. At what point because there are people who will not get the vaccine, at what point do we just say, okay, we've got to get back to what we used to do? And if that means going to the office, going to school, I mean, people are at the breaking point at this stage.
Yeah, and I think this is the tough thing. We're seeing lots of folks with vaccine hesitancy, and then there's fatigue with mask wearing and social distancing all across the countries. I think what those individuals need to understand is that how many of these very rare breakthrough infections we get depends on how much of the virus is circulating within the community. So once we get to a point where we have enough people in the community that are vaccinated, then if somebody develops COVID in that community, the people around them are protected, and it's much harder for that person to spread the virus somewhere else, and therefore the transmission stops. And less transmission means fewer breakthrough infection cases. Right now, we have a lot of transmission going on in many parts of this country, and the vaccine will really help decrease that. So getting vaccinated when you can is of utmost importance to returning to some semblance of normal.
And Doctor, how do you view the likelihood of another wave? If you take a look at what's going on in Michigan, clearly that's very concerning. We're also seeing numbers creep up in other parts of the country. What's your view on that?
Yeah, I mean, COVID infection rates are approaching the highest level, which is what the World Health Organization chief recently warned about. There's more than 139 million COVID cases that have been reported worldwide, 2.9 million deaths. The new cases per week have nearly doubled in the past 2 months. This is approaching the highest rate of infection we have seen so far during the pandemic. India, I recently read, had 200,000 new cases. And even in America, cases are up 11% in just the past 2 weeks. As was mentioned earlier, 20 states reported an increase in deaths. And we are seeing in hospitalization in a younger cohort now. And this may be related to mask fatigue. It might be related to more activities in that cohort without social distancing and masks, and the ease of spread of the new variants. Plus, there's lower vaccination rates in this age group. Michigan's largest hospital system, like you were mentioning, is at 95% capacity from an increase in hospitalizations. All things considered, though, when I feel like you compare America to the rest of the world, we're really fortunate that we have vaccines available to be given to help curb the spread. And we should really be targeting those at-risk populations and getting them vaccinated.
Dr. Sarah Andrabi, Assistant Professor of Emergency Medicine at Baylor College of Medicine. Thank you for joining us once again. Stay healthy. We look forward to your next appearance here on Yahoo Finance Live. When we come back, American Express has a company called Cabbage that works with financing and funding issues that involve small businesses. They've got a survey out. 57% of U.S. small businesses now fully open as the pandemic shutdowns ease. We're going to talk about that right after this.
New study out by Cabbage is following small business reopening trends. And one of those trends, 57% of small businesses now say that they are fully reopened. So let's talk a little bit more about this with Catherine Petralia. She is Cabbage's co-founder and COO, and Cabbage is now an American Express company. Catherine, it's great to have you on the show. So more than half of small businesses are fully reopened. Yes, that is an encouraging headline, but we have to remember what more than 40% still aren't fully reopened. How are small businesses faring at this point in the recovery?
Hi, I feel like one of the things we're seeing is that the K-shaped recovery that we've talked about, where a bunch of small businesses are doing really well, especially those who are focused on things around folks' homes, because that's where they're spending so much time right now. And other businesses aren't doing so well. I think another thing we're seeing is that larger business have more access to tools and services they need to recover, whereas the smallest businesses don't. 90% of all small businesses have fewer than 20 employees, 80% have fewer than 10. So it's important to remember the composition of small businesses.
When we talk about small businesses, that 20 employees or fewer, they were the largest number of respondents to your survey. My question for them is, on May 1st, in places like New York, and I suspect in other parts of the country, the moratoriums on evictions by landlords will expire. Is that reflected in any way, the concerns of the ability to survive that expiration, been reflected in the survey results?
I think that probably represents, and I'm no expert on landlords, I don't think that represents a huge percentage of those business owners. Most of these business owners are more traditional things like, nail salons and dry cleaners and yard service companies and all the things that you might expect to see, all the places you might expect to see small businesses.
Catherine, small businesses that are reopening, have they had to reset their revenue expectations just with the shift of online spending? How is that going to affect their business here going forward?
Well, again, it depends on the type of business. A lot of retail businesses have had tremendous luck moving to an e-commerce environment. They had not previously had an online presence, and they realized that not only through a combination of e-commerce platforms, but also through social media, they could not only reach their existing customers, but they could find new ones as well. So I think we're seeing a lot of that shift happening. And even restaurants have done a great job of allowing every single possible food delivery service to allow them to get food into the hands of the customers who were eating there previously. I think, these small businesses have been remarkably resilient and thoughtful and careful. And I think we're seeing that play out.
What surprised you about the survey results?
I think what surprised me was how many small businesses still aren't feeling like they're fully reopened or have an opportunity to generate real revenue. 43% is a big number. And so, trying to understand who those companies are and what puts them in that position, I think is a really important thing to do. Did they have access to some of the financial tools that were provided to them through the CARES Act, like PPP? Those are all questions that we need to answer to understand what it is that's holding these businesses back versus others.
Catherine, what's the milestone or the data point that these small businesses are looking at just to determine if they've fully recovered from the pandemic?
Most small businesses have said they feel like they will be recovered and comfortable if they can re-employ all of the employees they had previously. That, to them, is the measure of success.
Catherine Petralia, great to have you on the show, Kabbage co-founder and CEO. We are going to take a quick break, but when we come back, we'll talk about Blade's newest deal. They reached a deal with Beta Technologies. They're bringing EVAs to the market. Blade's CEO joins us right after the break.
right, 2 and 2, the two stocks that both Shauna and I are watching. Let's start with me. Daimler AG, this is the parent company of Mercedes-Benz. That stock up about 3%. Shares got a boost after Mercedes-Benz unveiled its 2022 fully electric luxury EQS. Now, it'll hit U.S. showrooms this fall and is one of 9 EVs Mercedes plans to offer by 2022. Our executive producer, Pross, is more a BMW guy, but it's a lovely vehicle. Mercedes did not release the pricing on it, but said the EQS, it's kind of, if you have to ask, you can't afford it. It'll come in 2 trim levels. It's expected to stick, are you ready for this, at a base price more than $100,000. It's not even leather. Okay, let's take a look at Novavax. Shares are up over 10%. They were up all day. CDC saying 30% of U.S. adults now fully vaccinated against COVID-19. Michael Haydock, senior director at market research firm Informa Pharma Intelligence, said that this pause with the Johnson & Johnson vaccine could open the door for other vaccines like Novavax. And Novavax vaccine is expected to at least apply, they're expected to apply for FDA emergency use authorization by June. Shauna?
Adam, I'm taking a look at PPG. It's the biggest gainer actually in the S&P right now, up just around 9.5%, hitting a 52-week high, hitting a high of $172 a share earlier today. They had pretty strong earnings out. They beat the street's expectations. Net income rose more than 50% to $1.58 a share. Revenue climbing 15% to $3.88 billion. Again, it's the biggest gainer in the S&P today, with the stock up just around 9.5%. Home builders also in the green today. We got some strong housing data out on housing starts and also on building permits. They jumped more than expected. Housing starts hitting the highest level that we've seen in nearly 15 years. Taking a look at these numbers, we talked about the resiliency of the real estate market so far, and these numbers continuing to be better than expected. The housing starts surged 19.4% to a seasonally adjusted annual rate of 1.739 million. You can see the bullishness reflected in those home builder stocks today. You have D.R. Horton up just around almost 4%, a jump in KB Home, and Toll Brothers there up just around 3.5%.
If you live in a major city with a lot of traffic, then you love the commercials that come on every now and then for Blade. That's the helicopter service that flies you above the traffic. Joining us now to talk about that and the plans for expansion, Rob Wiesenthal. He's the founder and CEO of Blade. Good to have you here. There's a lot to talk to you about. You've got the SPAC and going public very soon, and the announcement that you're going to do this with Experience, I believe it is, Investment Corporation. Why don't we start there? Can you give us a date and when this might actually come about?
Well, we have a voting date set for May 5th.
And Rob, talking about this deal that you reached recently, clearly there's lots of excitement about this. We've heard for quite some time about bringing EVAs to this space, bringing them to the skies. When you talk about what this will do for your business, the opportunity, how do you view that?
Well, it really is tremendous. If you think about it, our transition from helicopters to what we call EVA, electric vertical aircraft, are going to allow us to fly people with equipment that's quiet, zero emissions, and safe, obviously. And that's the key here is really quiet. The airports and heliports that we fly in right now, some of the heliports are 38 years old. Some of the airports are over 100 years old. In fact, there have been more nuclear reactors built in the U.S. than new heliports or airports. And that increases our addressable market geometrically. Because if I can pick you up across the street from your house at a vertiport, that's much more valuable than you driving to a Blade terminal that's 20 minutes away. And quiet is what is going to really drive the day. So our strategy has been to build an ecosystem that starts with a consumer-to-cockpit technology terminals. We have 12 in the U.S., including 3 in India, and a great brand and a lot of customers. We have 200,000 users. We flew 40,000 people in 2019. We had a run rate pre-pandemic of 20,000 people to New York City
Let me interrupt you.
airports alone. And when you take that and you think about that transition, we're asset light, we don't own any equipment. It's not unlike you were showing the streaming stocks before. Think about Netflix. When they started, they didn't call the company DVDs in a bag. They called it Netflix because they were waiting for streaming. And they had a great brand, a lot of consumers, a great service. And what streaming was to Netflix, frankly, EVA is to Blade.
Rob, are you making money because I know you've just announced Chicago, and I want you to succeed. I think this is a cool business, but there are other hurdles when some of us think of the Jetsons and air taxi kind of stuff. There are regulations that still have to be passed. But very simply, are you making money on this yet? Are you profitable?
We've been gross margin positive since day one. We basically have been spending money to build new routes. I think this Jetsons analogy, air taxis, flying cars, these are not flying cars. Think of them as quiet electric helicopters or rotorcraft for a certain instance. When you say flying car, you basically mean you're going to get in and drive it and land at someone's home. That's not the case. We'll be flying from conventional airports and heliports in the beginning, and then we'll convince legislators, because they are quiet and safe and green, to enable us to build more vertiports that are more convenient to you, allow us to have cheaper emissions, and help cities become City 2.0, where you have an added layer of urban air mobility in terms of the transportation infrastructure.
Rob, let's talk about your business today. Just in terms of the reopening is underway. We've talked to more and more people. They're out traveling again. What have you seen in your business?
Well, it's been really interesting because this is the first April that we've flown 7 days a week. There clearly is something going on in terms of this kind of remote work office hybrid is what I would call it. So people are now working at home, maybe up to 90 miles away, buying commuter passes with Blade, and only flying to the city for one day, maybe every 10 days, to enjoy a day at the office. And I think you're going to see a lot more of that especially as we pull through this pandemic. But so what once was a very peaky business on Fridays and Sundays and Mondays, we're now flying 7 days a week. Beyond that, we see, in terms of early indications, commuter passes, packs to go to various leisure destinations. There's a lot of pent-up demand there. We're seeing it now with a lot of pre-purchases. And in fact, the last quarter that we announced, we were up 50% in revenues for the post-pandemic, during pandemic quarter versus the pre-pandemic quarter.
Rob, did Morgan Stanley get it wrong then with their projection that in 10 years this is a $650 billion market? Could it be much greater, just given what you've described to us?
Look, those are really, really big numbers. When you take a look at the aggregate value of Blade at the SPAC, purchase price at $10 a share after cash, it's a $456 million aggregate value, as opposed to multi-billion-dollar kind of Silicon Valley valuations for people who are building equipment. So I don't think we need even a fraction of that for this to be an incredible business. In fact, if you look at our 2024 numbers that we forecast, an airport is a very big business. We only need 28 people per hour per airport, even in New York alone, to make our numbers for airport in 2024. So we've been trying to be as prudent as possible. Unlike other deals you've seen in the SPAC universe, we are making revenue today. We have a business today. It's 6 years old, a strong brand. Blade is a verb in most of the markets that we serve, including India.
Rob Wiesenthal is Blade founder and CEO. We wish you all the best and congratulations on moving forward with the SPAC. When we come back, big news from a guest who's been on this program repeatedly. We're going to talk about Kimco and its big purchase right after this.
Kimco Realty is buying its rival Weingarten in a $3.9 billion deal. So we want to talk to the CEO, Connor Flynn, CEO of Kimco Realty, joining us now. And Connor, congratulations on this deal. I understand that it gives you much more exposure in the Sun Belt region, but explain to us just why this makes sense and why you see this boosting Kimco's business.
No, thanks very much for having me. It's nice to see you. Kimco is very excited about this opportunity. When you look at the deal that we have with Weingarten, it's immediately accretive. It's deleveraging, so our balance sheet is actually enhanced, and then it enhances our long-term growth prospects. The Sun Belt, we have assets across the Sun Belt as well, and this just really enhances the quality as well as the growth profile in those Sun Belt markets. There's a lot to like about the Sun Belt right now. There's migration, there's demographic shifts going on that really enhances the best markets in the Sun Belt. And we see it on the ground on the leasing side. That's why we're excited about this deal and the timing of it. We're at the early innings of the reopening, and we're experiencing record leasing volumes on our portfolio. And we think that's going to play very well with the combination to be a powerful landlord and growth profile going forward.
Connor, it's good to see you again. At the end of all this, you're going to have something like 560 open-air grocery-anchored shopping centers. When I saw the deal and then heard you were coming on, my first thought was, we knew him before he was a billionaire. Not sure if you already are, but what I'm not understanding is why you're being punished today, and not terribly. The stock is still near its 52-week high, but it's off a little bit today. But that expansion into the Sun Belt, where I grew up, Florida, I mean, you get a Publix anchor to a strip mall, which is what all of Florida is. You're off to the races. What do you think investors today are not seeing about this deal?
I'm also was born in Fort Lauderdale, so I'm a big Publix fan as well. We own a lot of Publix grocery anchored centers in Florida. They're about as good as it gets. Yesterday, when we announced the deal, actually, when typically, a deal like this that's structured with equity, typically the acquirer does trade off. Actually, we traded up yesterday. So, every day is a bit different. You never know. But I think investors are getting their arms around the deal. Clearly, it was well received yesterday when we announced it. And I think there's a lot of opportunities, both near term and long term. We feel like the engine of Kimco is just getting started. We have a lot of leasing to do, but we're experiencing a lot of record demand on the ground. When you look at the demand drivers, that's what's really exciting, is how diversified it is. It's not just one category that's coming back. And really, when you look at the restaurants that are out there expanding, there's a lot of market share up for grabs, and they're really being aggressive, trying to get to the right locations. And luckily, the combination of these two great companies provides a lot of upside for both shareholder bases.
Connor, you mentioned leasing is certainly trending in the right direction. I know we started to see that at the end of 2020. What about the occupancy levels? When do you expect to reach the levels that you saw pre-pandemic?
You're spot on. The rebound in leasing will drive those occupancy levels higher. We anticipate that the demand drivers are going to outweigh the supply that we got back through the pandemic from the vacancies that occurred during that time. It's really just now starting to get going. So if you look out the next few quarters, you're really going to see that inflection point on the occupancy side. And you have to remember, we came into the pandemic at all-time high occupancies. And so the way I like to think about it is, some of the weakest credit or the worst operators were the ones that were removed from the rent rolls during the pandemic. And now we have the opportunity to backfill those spaces with the best-in-class omni-channel retailers. Because really what the biggest lesson learned through the pandemic is that the last mile store that we have in our locations is being used as a hybrid. It's being used as these fulfillment epicenters. And you look at what Target has laid out in terms of the blueprint for the future, and that's why we get so excited and have such conviction on our product, is because that last mile store, it doesn't matter if you ordered online, doesn't matter if you want to buy online, pick up in store, or curbside pickup. That store is near where you live or work, that's fulfilling your order. And we believe that is really what is the magic that's going to make the shopping center more valuable long term.
Connor, is there a shortage of space in these types of shopping facilities, and will that drive up rents, or is that flat right now?
So as you know, real estate, especially retail, is a very local market. It all depends on the supply and demand dynamics in a local corner that you're operating on. Where we tend to focus our portfolio is in the best markets across the country, the top 20 MSAs, where there's barriers to entry, and there hasn't been new supply for decades. And so the nice part about where we sit is that there's more demand right now than there is supply. And so that's pushing rents. And so you will see our rental spreads, which is the new lease spread, the new lease rent versus the old rent that was being paid previously, will be very solid positive. And so you'll see high single digits from us going forward. And we continue to think that we have pricing power because of those locations that I mentioned.
And Connor, the areas that are reopened, just give us a glimpse as to what you're seeing. What has the traffic been like?
So traffic has really snapped back. It's pretty remarkable. I mean, when we launched curbside pickup nationwide across the country, that in a way gave all of our retailers almost like a pseudo drive-through to allow them to do more online deliveries as well as pickup through the time where they weren't really allowed to operate in full capacity. The nice part now when we look at our traffic patterns is it's almost back to pre-pandemic levels. And the grocery store seems to continue to be the anchor of choice as multiple trips per week happen there. But then the cross shopping occurs now that more people are allowed to open at full capacity. We have really a nice merchandising mix when you look at driving traffic at all times during the day. And really, you're starting to see that traffic rebound to pre-pandemic levels.
Connor Flynn, it's always great to have you. Thanks so much for taking the time to join us, CEO of Kimco Realty. Let's take a look here at the markets with just around 12 minutes to go until the closing bell. You're looking at gains across the board. Dow well above 34,000, up 174 points today. S&P hitting a new intraday record, now up 16. The Nasdaq up just above the flat line here. Not too much movement, up just around 10 points. We'll be back in just 2 minutes.
About 9 minutes to the closing bell. Cryptocurrency surging, but we got to talk about Dogecoin, or as some of us like to say, doggy coin. Zach Guzman covers crypto for us. And Zach, it surged, what, more than 400% today. So tell us more about Dogecoin, or if you prefer, dog e-coin.
Yeah, more than 400% this week there, Adam. And today, I mean, it's been hovering between, at one point more than 100% just today alone. But when you back up and look at the gains for that crypto over just here in 2021, it's pretty astounding when you compare it to what you could have made. Let's just say hypothetically you were to put $1,000 into this project, you'd be sitting on more than $55,000 right now at this point in the year. Which is, that same 1,000 would be $9,000 if you invested in GameStop, pretty much flat if you put it in Tesla. It just kind of goes to show the insane upside on these. Of course, holding it through all of this, there's not a lot of people, I'm sure, out there that would be able to say it. But of course, when we talk about Dogecoin relative to other projects, people are scratching their heads on this one a bit because it is inflationary. We talk so much about why people point to Bitcoin maybe over the dollar and the fact that there's a limited supply. Not the case with Dogecoin. It is an inflationary asset since there is no limit in terms of how many coins can be minted. It's also one of those ones that was created as a joke by its founders. But Elon Musk has been talking about it for months, all the way back to last year. So the hype is real. And maybe that could be possibly the reason as to why we've seen it take off right now. We've heard a couple platforms, Robinhood included, dealing with unprecedented volumes in terms of demand now to trade some of these assets. And, you know, from a reasonable perspective, it's tough to really point to a catalyst. We've been talking about Coinbase. Coinbase doesn't even list Dogecoin right now, although with all this craze right now, they might be rethinking that because they're leaving some fees on the table, guys.
Well, Zach, one thing that's kind of dampening some of this excitement out there today, we have Turkey banning crypto payments. We're seeing that reflected in Bitcoin's price, at least under just a little bit of pressure. How big of a headwind do you see this being for Bitcoin and other crypto payments?
I mean, when we talk about that, it's something we've gone back and forth on in terms of how many crypto users out there actually use Bitcoin and other assets for payments, right? And that's something that obviously would have some appeal in a country where your currency has come down by about 10% in the last month. Obviously, that might be a piece of why Turkey's pushing this now. This would go into effect at the end of the month. But considering it's only a ban on payments, people would still be able to transact normally within the ecosystem here. That could be a piece of why we're seeing a pullback. It's obviously been a volatile week, but it is something out there when we talk about regulation that does have people maybe a little bit more worried. Then later we talked about India's potential ban as well. All of these things are pretty difficult to enforce when you think about how the government would actually police something like that, seeing as you'd still be able to send things back and forth. Going after companies who accept it as a form of payment sounds like an easier path to go if that's how they actually want to do what they're talking about here in Turkey. But obviously a different situation than what we're dealing with here back in the US. But one of those concerns we still always need to address and talk about whenever we're discussing cryptocurrency, since that's hanging over the heads of a lot of people. Luckily, back here in the SEC now, we have Gary Gensler at the head of that, now that he's been confirmed this week. Much friendlier guy when it comes to crypto since he talked about it, taught classes on it at MIT. So it's at least one thing maybe we're lucky to not have to worry about here in the US.
Zach, we will see you later. And Dogecoin, I still prefer Doggy Coin. When we come back, the closing bell. A little more than 2 minutes to the closing bell. Helping us get there will be Seth Carpenter, Chief U.S. Economist at UBS, along with Gene Tenuzzo, Columbia Threadneedle Investments Global Head of Fixed Income. But as we get ready to have some more records, Jared Blickery is going to teach me how to talk good. Jared?
Well, I get that at the tip of my tongue too, and we are looking for record closing highs in the S&P 500, the Dow, and the Nasdaq 100, not the Nasdaq Composite, also the S&P 500 equal weight. We'll just throw that in there. We're sitting on smallish gains, but we'll take them. The Dow's up nearly 0.5%. That's good for 150 points. Just looking at some of the weekly totals here, it looks like the Dow is going to be up 3.6% for the week. The S&P 500 over 5%, and the Nasdaq up over 6%. And it has been a great week for the FANG stocks. Kind of a mixed picture today. We got Apple and Facebook down. The Amazon and Microsoft are in the green. I want to take a look at one sector that hasn't done so well today, and that is the energy sector. Now, we're seeing Exxon and Chevron off about 0.5%. This is the biggest lagging sector of the day. Crude oil finished off marginally, but going into next week, I think focus is going to be on the reopening trade. And let's take a look at how that's doing today in terms of the travel sector. We got Royal Caribbean up 1%, Live Nation up 1%, Caribbean cruise lines down 1%. So kind of a mixed picture here, not seeing any particular patterns on that front. What a week for semiconductors there. NVIDIA, it's off today, but I just want to show you the 5-day price action. There we go. After breaking to record highs earlier in the week, it is tacking on 10% gains, and we got some nice gains for some of these other guys. We're going to be doing a deep dive into the week that was and the week ahead at 4:30, so we'll go over that then. I do want to check out the sector action here. We see materials is the only one up over 1%, followed by utilities, consumer discretionary, healthcare, financials, staples. Again, no kind of rhyme or reason to that mix in leadership there, just reflecting these broad-based gains that we've been seeing. Energy, notably, we were just talking about that. Energy, the biggest laggard, down 0.9%. With a few seconds to go, just going to take a quick check on crypto because we can. Here is the closing bell on Wall Street. Bitcoin's down 1%, and so is Ether.
And we're closing out another week here on Wall Street. All three of the major averages in the green. The Dow up 166 today. S&P up 15. Nasdaq up just around 0.1%. You're looking at record closing highs for the Dow, the S&P, and the Nasdaq 100. The S&P up for the fourth week in a row. The sector action today, at least real estate and utilities leading the way. We want to bring in our panel. We have Seth Carpenter of UBS, and we also have Gene Tenuzzo of Columbia Threadneedle Investments, a global head of fixed income there. Gene, first to you, just because of the action that we saw in the bond market this week. We saw a pullback in the 10-year yield. It caught some people by surprise because we got that parade of very, very strong economic data throughout the week. What's your reading on the drop that we saw in the 10-year yield? Does it make sense?
Well, look, I mean, the economic data have been strong, as you just pointed out. Certainly retail sales yesterday and some of the housing data today were very firm, but you're not going to find very many investors at this stage who can't justify a positive economic outlook. And so I think we've seen a pretty dramatic rise in the 10-year note as it relates to the last 6 months, really. And what we're finding is probably a new trading range. So, you know, the good news is there. It's reflected in the price as we're seeing vaccinations and reopening. And I think we're likely to see that 10-year note settle into a range here for a little while. Maybe it's 1.5 to 1 3/4, something in that range, before probably pressing higher later in the year.
Seth, one of your recent notes talks about what we saw earlier with retail sales really surging, and it came a little bit faster than a lot of us expected. Going forward, should be worried about the fact that stimulus runs out and that this surge may be petering out?
I don't really think so. I mean, I think month to month there's going to be some noise, and this week's retail sales report was huge. And some of it was clearly driven by the one-time stimulus checks, as well as a delay in terms of tax refunds that usually come in February. So, you know, April might look a little bit soft, but I don't think the underlying trend of reopening is going to fade. In particular, you know, consumer spending on services is still something like 9% below where it was a year ago. And as the risk from COVID falls, as vaccination rollout continues, I think that part of consumer spending is just going to normalize, and that should give us a pretty strong tailwind for at least the rest of this year.
Seth, we also saw new lows there in initial jobless claims since the start of the pandemic. How are you viewing it? Is it a one-off number, or do you think it's a start of a pretty encouraging trend?
I think it's a continuation of an incredibly noisy trend. The decline probably slightly overstates things. In level terms, there's probably a little bit of noise. There are states that have reported issues with possible fraud. So we take it as a weekly signal that's got a lot of noise into it. But once you start looking at where the trend is going over 3 and 4 and 5 weeks, then I think that trend starts to tell you a fair amount. So I think things are inflected higher. We've been calling for March to be an inflection for quite some time. I was happy to hear Chair Powell use the same term when he was on 60 Minutes. And I think that measure in particular claims is just going to keep its downward trend.
Gene, one of the things that you've also been keeping your eye on has to do with the yields. And now is not the time perhaps to be chasing yields when it comes to bonds. And you're advising people look at the short term, not the long term. Can you elaborate what that means to me as an investor who might be afraid of the noise that Gene was just talking about?
Sure. Well, look, Treasury yields have been rising. We've talked about that, but yields on credit sensitive products, in particular high yield bonds and leveraged loans, have been coming down very significantly. And they're still in positive territory in terms of total return year to date. But now when we look at where high yield spreads are, so the risk premium you get for going into riskier companies over treasuries, that's at the skinniest that we've seen, or the most expensive we've seen since before the financial crisis in 2007. So history tells us it's not a time you want to take an exceptional amount of credit risk, even though I completely agree with Seth. The economic outlook is one that's frankly pretty exciting. So I think the way to earn a little extra yield, but not take too many undue risks, is to stay in shorter maturities. So looking at sort of 1 to 5 year credit sensitive assets, those tend to have a little more price, a little less price volatility, and to do a little bit better as well if inflation is rearing its ugly head.
Seth, we heard from President Biden on his infrastructure plan a couple of weeks ago. What's your view just on how big of a boost that would be to the economy? Is that going to keep the economy humming along after the impact of the stimulus agreement fades?
Yeah, very much so is our view. Now, huge uncertainties. There's a lot of politics to settle on in terms of the final number. But absolutely, we're looking at, something like between infrastructure and any other spending priorities, probably $375 billion per year on a flow basis. And so any slowing in growth rates that you might get next year because the stimulus this year is starting to wane, almost surely to be offset. Now, the economy is also going to have to contend with some increase in taxes, probably, if the current reports out of Washington are to be believed. But I think on net, yeah, it's going to keep us going reasonably well. We're looking for high 3s in terms of growth rate for next year, and then settling into high 2s in 2023. So pretty sustained expansion.
Seth is the chief U.S. economist at UBS. Gene is Columbia Threadneedle Investments global head of fixed income. Thank you both for joining us. Jared Blikre, you get the final thought.
Well, I'm looking at seasonality here. That's the tendency of a market to do certain things, act bullishly or bearishly on certain days or time periods of the year, and sell in May and go away is coming up. That doesn't mean you sell everything. That's what they used to do to enjoy the summer. They didn't have electronic trading, but it does maybe give some people the opportunity to spend a little less time in front of their screen, raise their stops, and also maybe go into a few of the defensive sectors like staples and utilities just to have a balanced portfolio. I want to look at the Wi-Fi Interactive. We have come a long, long way from these March lows. What an impressive rally from here all the way up to the current highs. Doesn't mean it's going to continue, but with options expiration today, we have been tending to peak at this time in the month for the last several months. And then just given the fact that April is the second best trading month of the year historically, we might be seeing some of these gains ebb over the coming 6 months. Guys.
Jared, thank you. When we come back, we're going to be joined by Dan Howley. He's going to explain why 230 is more than just a weight all of us want to avoid. The GOP is setting its sights on it.
House Republicans releasing a legislative outline, I guess you can say, to overhaul big tech regulations. Dan Howley is looking into this for us. And Dan, just taking a glimpse of it, Section 230 is a focus of this plan.
Yeah, this is really what the Republicans wanted to do in the Energy and Commerce Committee. This is out of the House. And essentially, what they're calling for is repeal, more or less, of Section 230 for specific companies. We're talking about the likes of Facebook, Google, Twitter, YouTube. Any of those companies would not have the protections that 230 offers. Now, there's kind of this weird misunderstanding about what Section 230 is. Section 230 provides a liability shield against being forced to defend yourself in court for moderating content that a third party puts on your website. Essentially, you would still be able to moderate that content because of free speech. Facebook is exercising its free speech by not letting someone post something just as much as it is letting someone post something. Section 230 is just a shortcut so that Facebook doesn't have to stay in court for a huge amount of time and be bled dry. Now, you may want Facebook to be bled dry, but the issue here is smaller companies. They don't have the kind of money that Facebook has to spend tons of time in court, and they rely on this part of Section 230 or Section 230 to ensure that they can defend themselves in cases where they do moderate content. So essentially what these legislative goals are from the conservative members of the Energy and Commerce Committee is to take away those protections from companies that make a certain amount of money. They also want to take it away from companies that engage in targeted advertising, as well as companies that do anything as far as discriminate based on political affiliations or viewpoints. Now, that's something that conservatives have been pointing to for some time. There's supposedly some big boogeyman that exists within social media at large, specifically targeting conservatives. There's been no real evidence of that brought forward at all. In fact, if you look at Facebook, some of the most trafficked stories are from conservative sites and have conservative viewpoints. The issue, though, with saying that you would take away 230 based on political affiliations is that anything can be political, really. If you want to say that, I think that dogs are better than cats, you could say, well, that's my political opinion, or it's part of my political party stance now. And so it's really an untenable position. The experts that we spoke to don't seem to think that this is going to get anywhere, especially since it wouldn't have any support. Republicans are obviously in the minority in the House, as well as the Senate. There would be nothing for Democrats to really want to latch onto here as far as Section 230, except for portions about protecting children online. And that is something that seems to be where conservatives had started to gain steam and have pointed to as a means for kind of working on 230. They say that some of these companies go after children for targeting for them advertising. They especially went after Facebook during a recent hearing, and Mark Zuckerberg for the idea that they may be working on an Instagram for kids under 13. They also, by the way, already offer Facebook Messenger for children under 13, and YouTube has YouTube Kids. So there are apps out there already for some children, and they are kind of getting hit here, especially Facebook.
Dan, I want to switch gears here just a little bit because the tax deadline is less than a month away, just around a month away, May 17th, so a month tomorrow. And if you haven't done your taxes yet, I know you're looking into this, Dan Howley, but what's the best software to use?
So there's a few pieces of software that I really kind of liked when I was digging into them. H&R Block is great if you're a student or you have student loans still, because you get out of their free version student loan deductions. That's a really big win, especially if you're just trying to get away with using the free version. Unfortunately, it doesn't offer any mortgage interest deductions or property tax deductions, and you don't necessarily get deductions that you may need if you were doing anything along the lines of using, selling stocks. TurboTax is what I've been using for the past several years. I usually just upgrade to the full version. It's $60. Then it's an extra $50 for each state. So it does get kind of expensive. The reason why I do that is because I'm paranoid and think I'm going to prison. So I just want to have an advisor that I can reach out to and say, no, you're not going to jail. But really, the reason why you may not want to use that as the free version is if you're a student. They don't have that student loan deduction included in the free version. There's also taxslayer.com. That does include this student loan deduction. But one of the things that they limit is who can use the free version based on your income. So if you make more than $100,000 in a year, you're not allowed to use the free version. You're automatically pushed to the paid version, which is around $25, and then you have to pay extra for each state. I think one of the other things that is very much worth pointing out is the fact that the IRS offers free services for people who do want to file their taxes for free. Now, they work with a bunch of these companies, TurboTax, H&R Block, some others that you may not have heard of, but you can go on, I have this in my article, the IRS website, and it'll tell you exactly how to get some of this for free. There are some limitations based on your age. You may have to be below a certain age. You may also have to be below a certain income bracket, and you can, certain states are limited as to whether or not that's included. But look, there is a way of doing this for free. You don't have to pay for taxes when you file them. If you have a more complicated tax scenario, you may have purchased a home, maybe you sold property, maybe you're doing a lot of buying and selling of stocks. In that case, you may want to get a professional. But if you're a regular person like me and you just want to make sure you don't go to jail, just use the free services.
All right, Dan Howley, thanks so much for bringing us that. Up next, we are talking retirement. We're going to talk about the difference between Roth and traditional IRAs. That's coming up right after the break.
News on the move. Indianapolis Mayor Joe Hogsett called last night's deadly shooting horrific news. The shooter killed 8 people and injured 7 others at a FedEx facility near the Indianapolis airport. Police say the gunman, who has not been identified, started shooting outside the facility, moved inside, and then killed himself. Chicago police released body cam and surveillance video they say shows 13-year-old Adam Toledo holding a gun just a second before a Chicago police officer fatally shot the young boy last month. The Toledo family's attorney says, and this is a quote, "At the time Adam was shot, he did not have a gun." Former Vice President Mike Pence had surgery yesterday to implant a pacemaker. His office issued a statement saying the device was needed to treat a slow heart rate. Doctors say the surgery was routine and Pence should make a full recovery. Want to move to retirement issues in our retirement segment, which is brought to you by Fidelity Investments. A lot of confusion for a lot of us between IRAs, both the Roth IRA and a traditional IRA. And hopefully one day we will all appreciate not being able to fund an IRA because we will make too much money and hit the federal cap. But to understand more about this, let's invite into the stream Winnie Sun, Managing Director, Sun Group Wealth Partners. Good to have you here. Very simply, traditional IRA, when you withdraw, you get taxed. A Roth IRA, you don't get taxed when you withdraw. How do you decide which is the right version of the IRA for you?
That's a great question, Adam. I think, whichever direction you go, you should actually, if you can, contribute to an IRA each and every year. But simply put, there are some income caps. I actually think the Roth IRA is like the golden egg. If you qualify, I think you should strongly contribute each and every year. As long as you make less than $125,000 as an individual when you file your taxes, or as a married couple, if the two of you file less and you earn less than $198,000, then you can go directly to the Roth. So that would be my first route. If you can't do that, then the traditional IRA could actually go through a conversion into a Roth as well. So that's something that you should speak to your tax accountant about.
Winnie, are there some instances where it maybe makes sense to do both?
Well, Sean, that's a good question. We're allowed to contribute to both each and every year, but I will tell you in like 20 plus years as a financial advisor, I've yet to see a client contribute to both. I would say it's best to pick one or the other. There are benefits to both, but typically it's pretty clear in that particular year what would benefit you more. It's either if you want to pay taxes later or you want to pay taxes ahead of time.
In the last century, I had the opportunity to roll over a 401k into an IRA, which in 1999, the government allowed me to convert to a Roth. I paid the taxes then and there. Fast forward to 2021. After reading your notes on this, that Roth IRA, I still got it, but I don't have to take money from it when I retire. And if someone's lucky enough to be in my good graces, I can leave that to them and they don't have to pay taxes on it, right?
Absolutely, Adam. This is a big deal. So, for example, if you are, you have sufficient income and savings to provide for your later years, that absolutely you can continue to keep that Roth IRA invested. You don't need to take withdrawals. You can leave it to your kids or grandkids and whatnot. And now they will also inherit the tax benefits of it being tax-free distributions, but they will have to take it out within 5 years. But nonetheless, that's a great way to move assets from one generation to another.
And when you're talking about this, I'm looking at your notes right now, you're talking about the Roth IRA, the benefits here to note, and you mentioned first-time home buyer clause. Explain to us exactly what you mean.
This is great. So for a young person, or you don't even have to be, and can be any age, but for your first home purchase, the Roth IRA does give you some benefits. You're actually able to withdraw up to $10,000 for the purchase of a home. Now, there is a caveat. You do have to have this account open for at least 5 years. But once you do that, these funds can be used pretty flexibly. This is as long as it's for your first home purchase. It could be down payment, closing costs, and it's treated like a qualified distribution, which means then you don't have to pay income taxes or early withdrawal fees, not only on the principal that you're taking out, but as well as the profit that you take out of that $10,000.
On the traditional IRA side, at what age does the government essentially say, start taking money, we need to tax you?
Well, historically, taking out money from the traditional IRAs, people always think, well, why do we have to do it? Well, the IRS hasn't collected money on your traditional IRA contribution yet. So as it continues to grow, at some point, the IRS is going to want a piece of your retirement savings. So usually that number would be 70 and a half if you were born before the year of 1949 generally. But after that, then you have until age 72. And that's actually called the required minimum distribution, or RMD for short. So that requires you to take a certain amount, and it's calculated based on your life expectancy. So unlike the Roth, where you can just continue to let it grow, the traditional IRA, at some point, you're going to have to take out some money.
Can you make a contribution to a traditional IRA if you are fortunate enough to earn more than the salary cap?
Yes. So if you make more than the salary cap of the Roth IRA, you can always
Not the Roth, the
contribute to the
traditional.
right. You can always contribute to the traditional IRA. But here's something to keep in mind. The traditional IRA is always going to be available to you regardless of how much income you earn, as long as you have W-2 income. Now, or 1099 income, I should say. But the caveat here is this. Then it'll be, it could be potentially tax deductible upfront, but then you'll have to pay taxes on the back end. There is another thing that you could consider doing. If your income is too high and you can't go directly into a Roth, but you have your heart set on a Roth IRA contribution, you could actually make a non-deductible traditional IRA contribution. So you don't get it deducted, but the traditional IRA contribution. And then you can soon after decide on whether or not you want to do a Roth IRA conversion, right? Now, if you do this very quickly and there hasn't been much growth in this portfolio, then you're not really subject to taxes there. The money then gets put into a Roth IRA, kind of like what you talked about, Adam, earlier when you did this with your previous retirement plan, your company plan, going into conversion. So that's an option. If you're interested in doing that, definitely would consult a tax professional before doing that.
Winnie, I'm going to suggest we bring you back and do a whole hour webinar with you, Q&A on retirement. Really appreciate your insight. Well, I got to tell you, when I was thinking about that Roth IRA that I did a million years ago, I keep hearing Tina Turner in my head saying to my potential heirs, you better be good to me. Thank you so much. Winnie Sun, Managing Director, Sun Group Wealth Partners. When we're back, we're going to hear from the CEO from Bed Bath & Beyond.
Was a record-setting week on Wall Street. Dow and S&P closing the week at new record highs, the fourth weekly gain in a row. Jared Blickery has a closer look at the gains we saw. Jared?
Yeah, it's surprising to have a day that goes by where we don't say record highs multiple times, but let's take a look at the Wi-Fi Interactive. It's useful to take a step back and look at some of the existing trends that are in place. This is a 3-month chart of the Dow. You can see it's up 11%. Big takeaway is it's from the lower left to the upper right. That's what you want to see in these charts. Same thing for the S&P 500. And if you take a look at the Nasdaq, not quite the same, but it has finally just about reached those record highs that we saw in February. So kind of playing a game of catch up. But it's been nice to see the stocks that have really powered it in the past, the FANGs, and we'll take a look at that in a second, and the mega caps, they have really been allowed to come back as well. And before I move on, got to talk about the transports, because you think the Dow was impressive. They're up 15%. And lower left to upper right, that is the chart indeed. They have been up 11 straight weeks. Now, the VIX is important because it has been holding below 20. We've been talking about the low volatility, the low volume, and this is what has been in part reflecting it, if not facilitating it. It's because traders, guess what? They're starting to go away maybe. They say sell in May and go away. I think we're starting to see some of the traders start to disappear for the summer, but probably not until after earnings season. So got a couple more weeks before that really happens in full force. Now, 10-year T-note yield, this had a big week as well. Remember a few weeks ago when everybody thought that we could potentially surge all the way up to 2% very quickly? Didn't happen. And so the FANG stocks, the mega caps, were kind of suffering in here in this meteoric rise, but not so much anymore. And this has given them breathing room.
Jared, real quick, looking ahead to next week, I mean, at the top of my head, there's Southwest, United. We're going to get earnings from Union Pacific. You're going to be watching some pretty big earnings next week as well, aren't you?
Yeah, we're going to kick it off Monday morning with Coca-Cola, and then after the bell, we got IBM and United. So we're going to get a lot of the industrial and transportation names, and then we get Netflix on Tuesday after the bell. That's always a big one. Healthcare. So it's going to be a really busy next 2 weeks, not just next week, but the week after. On the economic calendar, really not going to be that busy. But if I can just go back to the Wi-Fi Interactive, highlight some of the week's price action. I was talking about the FANG stocks and the mega caps. Well, guess what? These aren't spectacular gains, but they're gains. Microsoft's up 2%, record highs, I think, every day this week. Tesla up 9%. We do have some losers, and we're keeping an eye on them. In the chip space, after NVIDIA announced that it was getting into the server business, we saw Intel and AMD fall off. So we're going to be watching those next week as well. But all in all, we got a broad-based rally going on here. This is a sector action for the week. You can see communication services in the lower right. That is a standout because it's the only one in the red that houses Facebook and Alphabet, but everything else in the green. Now you look at utilities up 3.7% in the upper left. The fact that a defensive stock might be or in fact is the greatest performer of the week has something to do with the interest rate situation, not paying too much attention to that. But the fact that we have all these sectors in the green with some of them posting meaningful gains for the first time in a few weeks just really points to the strength of this rally.
All right, Jared Blookery, thanks so much for breaking that down for us. Let's talk about Bed Bath & Beyond, because this has been a winner so far this year and also over the past year. Shares are up just around 40% year to date, up 380% over the past year. Well, earlier today, Yahoo Finance spoke with Bed Bath & Beyond CEO Mark Tritton about the company's latest quarter and also how its turnaround plan is progressing. Let's listen to what he had to say.
Look, I think it will be in a straight line, but impatience is required. I mean, we just come out of a COVID moment. We've gone from 4 years of sales declines and performance to growth, and we're seeing consistent performance in our business, and we're exactly where we believe we should be and poised for a strong 2021. I think there's just impatience around us getting there faster. And I think that we look forward to coming out in Q1 and sharing our results and again, providing another consistent quarter of growth and performance against our estimates.
You know, to that point, Mark, consumers have been out there spending very aggressively in the past few weeks. A lot of stimulus checks going through at retailers. Have you seen that in your business?
We've seen overall growth that's very, very strong. I mean, we saw the results yesterday for March come out at about 10% growth. We're dramatically exceeding that growth rate in the month of March. So we see good things lie ahead for the quarter. We're seeing general consumer confidence is strong, and that's strengthening both in digital formats as well as store formats in that true omni always shopping experience. So I think that, you know, the COVID moment is still omnipresent in customers' minds, but confidence factors have changed definitely.
And, you know, Mark, it's Miles here, and I know we've discussed this previously. Certainly the stores, you know, when I go into my local Bed and Baths, they're a lot cleaner. They're not as cluttered as they were, you know, maybe three or 5 years ago. Are you guys having any supply issues, though, with things that you'd like to have in stock that you can't get because of issues. We hear that from a lot of industries, and I'm curious if it's impacting, any of your mix.
We're actually doing really well on our recovery of out of stocks. They're down to their lowest point in over 18 months. So we feel really good. We did curate the assortment miles down and actually create that focus in stores with new signage and new presentation and new flow. That's really paying dividends as we take each room and category and reset them sequentially in stores. So we're seeing some level of change in the inventory and the placement as we get settled in to bring in our new own brands. We'll see that really stabilize through Q1, but no major supply issues at this point. And in terms of our own brand launches, we brought in that product ahead of time in the right quantities to make sure that our setup was on point. A few areas where port delays are affecting a few items, but in general, we're looking good.
Mark, how much inventory have you pulled out of the stores? I know you've been actively just reassessing what a Bed Bath & Beyond store should look like. And when I walk in there, perhaps there's categories that no longer make any sense to have in the store.
Yeah, we're actually reducing inventory in stores by about 20 to 30%. Now, the flip side of that is the customers are coming in the store, particularly where we've remodeled, and saying, wow, you have more assortment than ever. And so I think it creates focus. It creates the ability for the great merchandise to breathe. We're able to resonate clarity on value and our unique offers and the differentiated offers that we'll show with own brands. So, definitely curating, definitely reassorting, definitely upgrading our assortment. All those things are taking hold as we speak.
And then, along with that assortment, Mark, certainly stay-at-home trades have influenced what people have been purchasing. I mean, when we've talked about your company on the show, I've heard from a lot of folks who are spending a lot more money on coffee in their house. And when I go into a Bed Bath, that's a very robust section of the store these days. How has the mix changed in the store? And do you see things starting to shift as life maybe normalizes and people aren't home, 7 days a week anymore?
We're actually seeing a solidification of those trends. And I think these are, I've been using we've seen a moment that's now become a muscle. I think that customers do enjoy having that cup of coffee at home and the value that it brings. They got the great coffee maker. And we're seeing that continue through. We're seeing customers really stay in love with their home for comfort, for safety, for style. And so we see the discretionary side of the business really continuing with strength as part of people's lives and their modus operandi, whether it's inside the house or now moving to the backyard. So we see a strengthening of that trend. Everything we see in trend reports and NPD shows is that part of the market will remain buoyant. We think we've got new offers and new assortment and new storytelling throughout the year that will only fortify that.
Mark, a lot of focus after the earnings calls on how many stores you're looking to prune. So far over your store closing campaign, you've closed about 140. Look to have 200 total closed as part of this campaign by the end of the year. Is this just the first round?
No, it's the major round. I think, Brian, we've done an assessment using data and an outside group to really assess not just what we needed to do to take out underperforming stores or where we had duplication in an existing market, but really looking at a 3 to 5 year horizon of growth and demographic growth, population growth, and seeing how we would also digitally fulfill orders for our customers across the nation. So this is a bold move to really restructure those approximately 200 stores based on that long-term criteria. But we'll always remain open to tweaking that where we see performance improve or slow. That's actually part of our criteria. But I think this is the major thrust, and it's not a series of major changes over time.
That was Bed Bath & Beyond CEO Mark Tritton. All right, well, coming up next, we are going to discuss the business of the British monarchy and specifically the uncertainty that the royal family faces over where the institution goes next. We're going to unpack all of that right after the break.
A lot of focus on bank earnings and what happens as people go back to work from the pandemic. Stifel Chairman and CEO Ron Kruszewski joined Yahoo Finance earlier today to discuss why he is bullish on returning to the office and the implication of President Biden's infrastructure plan.
Your previous guest talked about all the things that are happening in the economy and the stimulus, and we have over $2 trillion of excess savings. We have almost $1 trillion of excess business investment opportunity. You've seen all the numbers come in, and it points to a very strong 10% GDP in the second quarter. Yet on top of it, we're talking about $2 trillion in additional infrastructure spending. And that is going to have a real impact on the unemployment rate. I think it could push it to sub 3%. And then the real question is while all this is going on, you have real interest rates that are negative. And while the Fed is on one hand trying to get inflation back to over 2%, I personally believe that these set of financial conditions are creating some asset bubbles. I hate to use that word because no one ever knows when they're in a bubble, but we're really pushing some asset values when you look across the board with what I think is a suppression of interest rates and done so really by the Fed on purpose.
Ron, to that point, do you think we're now at the point where investors would be wise to reassess valuations and maybe stocks do pull back from here?
Well, I'm not. I think that we're in one of those periods, and no one ever rings a bell to either tell you to buy stocks or to sell stocks, and I'm not trying to do that. What I understand, and I think investors need to understand, is what happens to very, very high PE stocks when real interest rates, if real interest rates start to rise. There's convexity to that curve, and you can see some of these PEs get halved. I mean, it halved easily. And I'm just not sure that investors are really focusing on the correlation between low rates and these high growth stocks. And, I think you sort of ignore that at your investing peril.
Ron, it's Miles here, and this gets to something you were writing about in your annual letter about the role that Reddit and some of these social trends have played within the market, and you guys have seen that play out a certain way in your business. It seems like some of that steam has come out of the market just in the last few weeks. But what do those trends signal to you about this phase of the cycle in the context, certainly of everything we've just chatted about?
I was more talking about almost convergence of social media and investing, and I see a lot of good things about that. Certainly, investor education, getting people into the market. There's some good things, but there was a time there when these certain stocks were really just trading with no basis in underlying fundamentals, and my comment was that our investors should be careful to not have a fear of missing out on, like the GameStop just frenzy. So it's here to stay. I do think it's calmed down a little bit, but there'll be another one. Make no mistake.
And Ron, you also write in the annual letter, and your peers in the financial services industry have weighed in this as well. You're bullish on the return to the office. You view it as important. Why is that?
First of all, we have successfully been able to work remotely. There's just no question that the technology and what we were able to do. We had a record year last year, record revenue, record profitability. I do feel fortunate about that. But with at times 90% of the people not coming to work. But I noticed rather early on the cost of that in the reduced level of collaboration, esprit de corps, training. In our business, we're an on-the-job training shop. That's how you learn the business. And we have lost a lot by not being together. So I said in our letter that we will come back safely, but make no mistake about it, other than a few situations where we might be able to accommodate someone, one-off situations working at home, we're coming back to work. I think that is in the best interest of everyone, and I look forward to that. We're not doing it today, but we're close.
And Ron, in that vein, we've seen some competitors of yours in the investment banking industry have let's call it upheaval among their junior staff and thinking through what people want to do with their careers. And I'm just curious how you've communicated with your staff and where you guys are at today with, again, what's been a challenging period, but one that is hopefully normalizing soon.
Yeah, well, I think that is certainly I've read some of the stories about the 100+ hour weeks, and I'm certainly hoping that we're not driving our staff, to those levels. That said, most of the people in our investment bank aren't working 40-hour weeks right now. We are very busy.
We're going to turn our attention to a different kind of business, not one that reports earnings every day or every quarter, but the monarchy, the royal monarchy. Now, tomorrow is a very sad day, as Prince Philip will be laid to rest after he died on April 9th. But we invited into the stream Ariel Shapiro. She is a reporter, a media and entertainment reporter at Forbes, and along with her colleague Denise Cam, who I think has the best, byline in the business. It says she gets to cover billionaires and the richest people in the world. The two of you did an incredibly deep dive into the royal family and their worth and how the firm makes its money. What jumped out to me was the $28 billion in assets, but they don't get to pocket that, do they?
No, they don't. And thank you so much for having me on. So yeah, the $28 billion is tied up in all kinds of assets that they technically own, but are not legally allowed to sell. It's comprised of lots of real estate. It's comprised of revenue generating businesses like wind farms. The Crown Estate makes up the biggest chunk of this. It's $19.5 billion. And the money from that actually goes into the British Treasury, and then the royal family gets 25% of that back in the form of a sovereign grant. So the royal family is seeing money from it, but it's a little bit trickier than just having, $28 billion worth of business.
Sure.
And taking a look just at the impact that the royal family has on the UK economy, is it mostly through tourism? How exactly does that break down?
So tourism is obviously a really big part of it. In a non-pandemic year, they generate $2.7 billion worth in the economy. A lot of this tourism, but some of that is also media coverage. Some of that is merchandise. It really does kind of have a pretty wide reach.
If there are any people who are English watching, I'll do it a lot cheaper. I can do the wave. I am curious, though, there is this, when you hear from friends who might be English or from the UK, that there's this perception that the royal family gets taxpayer money and that's what sustains them. And that doesn't appear to be accurate. And also the family has cut down who gets a piece of the pie, right?
Exactly. So that's been Prince Charles's real project, is winnowing down how many working members there are of the royal family, because those working members do get money. That being said, the idea is that the money that they get from the Treasury is money that they put into the Treasury in the first place. So part of the decision to control the number of family members who are official working members is really to kind of cut down on the perception that, this wealthy family is just being lavished with British taxpayer money. So, it's also a means of reputational control. Like, this business does not exist unless the people want them to be there, right? Like, right. They need to maintain a certain public perception in order to keep that tourism going, and in order to do certain things like issue royal warrants to brands within the UK, which can add a significant amount to their revenue once they have it.
And speaking about that, part of the thing about keeping their public reputation intact is also their relationship they have with the British tabloids. And we know this was brought up in the interview with Meghan Markle just around a month ago, but can you better explain to us, if you know, the relationship that the royal family does have with the British tabloids and whether or not they are beholden to them?
I can't speak quite as much to that. My understanding is that the So there's the firm in terms of the family itself, right? And then there's the operation around them. And the operation around them does necessarily have to deal with the tabloids. Whether or not they're beholden to these tabloids is not really something I'm able to speak to. But they definitely need to keep coverage positive in order to keep up this business.
Got to say thank you so much. But if you want to read, it's an incredibly well-written article. Ariel Shapiro is one of the reporters from Forbes, along with Denise Cam, who wrote this deep dive. It was just at the end of March you guys published this thing, and you can see just where the money is going to the royal family, how they generate it and what they do with it. Ariel, all the best to you, and we look forward to reading more from you. When we come back, we're going to see what's going on as we get ready for that meeting between President Biden and the Prime Minister of Japan.
President Biden hosting Japan's prime minister at the White House today. A news conference is expected to get underway any minute inside the Rose Garden. Jess Smith has a closer look at what we can expect. Jess?
Yeah, Shauna, the two leaders were in meetings this afternoon. We did see them briefly as they started one of their meetings. We saw them there alongside the Secretary of State, Secretary of Defense, and Treasury. Both leaders at the top of that meeting just expressed how important the relationship between the U.S. and Japan is. We know that this is the first foreign leader to be at the White House in person during President Biden's administration. And the White House is really trying to send a message just how important this relationship is. We are expecting the two leaders to announce a $2 billion 5G initiative, according to a senior administration official. We are waiting on the details of that push, but of course, 5G is a key area of competition with China. We are expecting China to be a key part of this press conference, a key part of the meetings earlier today. The administration had planned to talk about human rights issues, tensions in the region, and economic competition. The president is also set to meet with the South Korean president in the coming weeks. And of course, this is all a part of that broader effort to strengthen relationships with allies in the region. The administration has talked about how important it is, why they are choosing the South Korean and Japanese leaders to come to the White House first. Other topics that likely came up in the meeting today that the administration said they were going to address include North Korea, climate change, and the Summer Olympics that are set to be held in Tokyo, all issues that we expect the two leaders to address. Again, they are expected to come out and have a joint press conference at any minute now, so we'll have to keep you updated on what we learn about that 5G initiative and some of the other issues that they're going to tackle today.
All right, Jess Smith, thanks so much. And of course, we will be watching for any of those headlines. Again, the news conference expected to get underway any minute. Let's take one more look at how the market settled today. Again, it was a record day on Wall Street. Dow, S&P, and Nasdaq 100 all closing at record highs. You can see it on your screen. The Dow closing up 164 points, the biggest gainers in the Dow today. Cisco, Home Depot, and Johnson & Johnson. Cisco closing up just around 2%. J&J and Home Depot both up over 1%. Sector-wise, materials, healthcare, financials, consumer staples, industrials, technology, all closing at record highs today. And again, with the gains across the board, all three of the major averages up now for 4 weeks in a row. Well, that does it for us today on Yahoo Finance. Thanks so much for joining us. Have a great weekend, and we'll see you back here on Monday.